that. You saw this massive uptick in prices, up almost 400% on the day yesterday. The market loved it. So this is a shoe factory, essentially a shoe manufacturer that is becoming an AI company, and the market can't get enough of it. It's AI euphoria in shoes. Okay, now let's go back to more conventional markets. Winnie Su is in Hong Kong for us. Winnie, walk us through the price action in Asia today and specifically what we got out of China with those numbers.
Yeah, morning, Jomana. As you mentioned, sentiment is pretty uplift here in Asia, given that traders are now looking past the Iran war and also expecting further de-escalation with the U.S. And here on the chart, you can see that the MSCI Asia up more than 1% for a third day. And we do have quite a few key benchmarks hitting new milestones as well. That includes Japan's Nikkei 225 here, headed for a fresh record close, with the Taiwanese TAIEX index also extending those fresh highs. Also worth noting that we do have TSMC's earnings later today, so we will watch out for those AI euphoria to see what the company and the meetings will be mentioning. And with the onshore benchmark, we're looking at the CSI 300 still holding up to its gains as we have that set of positive numbers from China's eco data. As you flip the board and we take a closer look at those numbers, now the big one here is the first quarter GDP year numbers with 5% increase. That's better than expected of 4.8%, showing that there is limited impact from the Iran war, and also the support also coming from the manufacturing side of things. As you can see, industrial production year over year jumping 5.7% for March. That's also beating expectation. Now, the weaker side of the story still is in the domestic demand side of things. As you can see, retail sales at 1.7% increase versus the 2.4% jump that was expected. Back to you, Jomana.
Winnie, great stuff. Thank you for breaking it down for us. Winnie Su in Hong Kong. So Asia setting the tone. Let's go back to the geopolitics. Bloomberg has learned the U.S. and Iran are considering a 2-week ceasefire extension to allow for more time to negotiate a peace deal. It comes despite an intensifying standoff over the Strait of Hormuz.
I saw some reporting, again, bad reporting this morning, that we had formally requested an extension of the ceasefire. That is not true at this moment. We've remained very much engaged in these negotiations, in these talks. You heard from the Vice President directly and the President this week that these conversations are productive and ongoing, and that's where we are right now.
Let's now bring in Bloomberg politics editor Laura Davison and Stephen Sichinski, who leads our Asia energy coverage. Laura, let's start with you. So we heard from the White House press secretary over there, Caroline Leavitt, saying that the U.S. had not formally requested a ceasefire extension. However, there's rampant speculation that another round of talks are going to be held as soon as this week. What do we know on that front?
Yeah, that's a little bit of posturing there from the White House of they don't want to be seen as asking for something, but we know that talks are ongoing about having this second round of talks, in addition to having an extension of a ceasefire that would put, a delayed expiration in sometime in early May to give a lot more time for these talks to play The other sort of sign for optimism that happened in the past 12 hours or so is this understanding of agreement, or this sort of framework in principle that came together. None of these things, both the ceasefire extension talks or sort of this loose agreement, represent a major breakthrough. But all of these together suggest that there are good vibes, there is negotiating in good faith, and each side is looking to get to the table to have some sort of broader conversation. There's still a lot that they need to figure out, particularly with the Strait of Hormuz, as well as the future of Iran's nuclear program. But we've seen over this week, really, that both sides are continuing to talk, continuing to operate in a way that would suggest that they're going to be moving towards peace, if not slowly.
Yeah. Stephen, let me ask you about what has been going on with the Strait. CENTCOM once again saying that they have asserted full maritime control, full maritime authority around the Strait of Hormuz. What have we actually seen in the last couple of days?
We're not seeing a whole lot of transit at the Strait of Hormuz, which is continuing what's been the case for weeks. In the last few days, we've seen maybe, according to Bloomberg, ship tracking, about 10 or more vessels go through on a daily basis. Not all of these are oil ships. There are other kinds of vessels as well. But it does indicate that not only is the Iranians' effort to control the strait reducing flows through that key waterway, but also the White House and Trump's blockade as well is reducing ships from the Iranian side, right? The U.S. has come in to set up their blockade because they don't want the sanctioned Iranian fuel to get out. They don't want the shipments to fill the coffers of Tehran, especially as they want to gain a better hand in negotiations. And we have seen some ships filled with Iranian oil U-turn, according to ship tracking data. Again, this is an imperfect science because some ships turn off their ship tracking data and their AIS signal, so they could be going through dark. But at the moment, we're seeing just a trickle. So 10 vessels a day compared to more than 135 before the war began. So it's basically nothing.
Yeah, and Stephen, I was checking the price of Brent, obviously, at the top of the show today. We're still sitting at around $95. How should we read the existing premium, or the premium that still exists, I should say, in the price of oil versus other markets like equities that have completely shrugged off the losses around the Iran war?
I mean, we have come off quite a bit from the highs of the early days of the war. Brent was trading above $110 a barrel at one point. And when you think about it theoretically, if you're looking at the Strait of Hormuz, which supplies 20% of seaborne oil and 20% of LNG to the global market, and if that remains shut for over a month and a half, there's some analysts saying that oil should be even higher. So the fact that we're at 95 does indicate a sense of relief to some, and perhaps also that the market is pricing in a de-escalation. We're still up about a third, about 30% from pre-war levels, but you could probably see things quickly deflate. And you have seen over the last week or so prices really kind of ease a bit. So I think oil is also going in the same direction with that, with the green that you're seeing in equities. Now, this could unwind very quickly if there isn't a peace deal. I think people are trading the headlines and the expectation that something can be agreed upon between the Trump administration and Tehran. But again, it's unclear at the moment, especially since we're getting quite mixed signals from the White House.
Yeah, well, Laura, let's turn back to the White House, because the Treasury Secretary Scott Bessent seems to imply that the price of gasoline, or retail gasoline, will go back to $3 by September. On what basis are they making these claims?
It's really not clear, though it's clear that that's at least politically what they would like to see happen. So by giving that deadline and giving a specific price target for $3, the White House is a little bit boxing themselves in because they don't control global oil markets, and they don't necessarily have full control over what happens in this conflict. But it's important to note that that's a target date that they're looking at politically, because it's typically kind of around these deadlines is when you see some more erratic behavior from the president. So it can be important to note that if we're well into the summer and even into the fall, and gasoline is still quite high, why this conflict still persists. That's where you could see Trump start to do some things that are even outside the box, even for him, just because he needs to kind of meet these domestic political targets ahead of the November midterms in the U.S.
Bloomberg Politics editor Laura Davison and Stephen Tuchinski leading our Asia energy coverage. Thank you both so much. Well, Donald Trump has also posted in the past hour that he is now trying to get a little breathing room between Israel and Lebanon. The U.S. president says it's been a long time since the two leaders have spoken and that it will happen tomorrow. Technically, he posted that yesterday, so it would be today. Now, to unpack all of these developments, joining me now is Sorana Paravelescu, a partner EMEA at Control Risk. So, we're trying to piece together all of the various signals that are coming through from Pakistan, the mediator, from various Iranian officials, from the White House. It seems as though they are readying for another round of talks here. But how confident are you that we can get a definitive end to this war in the coming days, Serrano?
Thanks for having me, Kumana. Not that confident. If we think about how long it took, if you cast your mind back to the 2010s when the first nuclear deal was negotiated, it took years to negotiate in the absence of hostilities and in the more international environment, if you want. We're not there then. Of course, there is some pressure from the military threats and the deadline looming on the end of the ceasefire. But there are the issues that need to be resolved and the trade-offs that need to be had between the U.S. and Iran to get to a comprehensive deal are well far, I think, are far out for now.
How should we read the continual military buildup in the region? Yesterday, Washington Post reporting that thousands of more troops are going to be arriving in the region in the next couple of days. How should we read that juxtaposed with the possibility of a second round of talks later this week?
Yeah, the military buildup is certainly part of the posturing to force a deal and create urgency around the deal vis-a-vis Iran. Whether Iran really reads into that or sort of will heed into that is not. I'm not so sure. But also it presents an option for the U.S. if the talks fail to do another to resume hostilities, probably at sea around the Hormuz.
Yeah. Let me ask you, do you think that there is a likelihood that we just end in a sequence of ceasefires that just keep getting pushed back, i.e. a never full definitive end to the war or some diplomatic resolution that solves all of the outstanding issues, but rather just ceasefire after ceasefire? And if that does happen, what are the types of risks that presents to the region?
Yeah, I think we're moving into the longer the ceasefire takes, the closer we get to a scenario where you have a sort of stalemate or frozen war, if you want to call it, without even calling it that, in which you have these ceasefires extended, maybe the occasional small escalation, but also some talks going on in the background. And that's becoming more feasible, one, because there's clearly no good military option on the table right now for the U.S., and because the deal is probably going to prove itself more elusive than meets the eye right now. That would be quite the risk of that. Of course, the main one is what happens to the Hormuz. Do we have a long-term disruption of the Hormuz? And we can talk about months or maybe more. And if that's the case, we're talking about sort of shifting supply chains, like really structural changes in the global economy around moving supply chains away from the Gulf, sort of global energy market change, structural changes, and so on. So that's where the risk is, and I think this is where some of the parties to the conflict or on the side of the conflict are very worried about.
Would you characterize the U.S. blockade, or at least the first couple of days of it, as being successful so far in what they're trying to achieve, which is essentially cutting off a key oil lifeline for Iran?
Well, I mean, we have seen some tankers with Iranian oil turn around, and I think that's an indication that Iran doesn't want to sort of push or test the red lines of the ceasefire. So you could call that effective in some ways. It is also very expensive, both to the U.S. for bringing all of this naval capability in the region, but also to the world, because it ends up with even less oil on the market. But also, the question, the interesting sort of test will be, and maybe this is what Iran is quietly waiting for, is if you have a Chinese-owned ship trying to pass the Hormuz with Iranian oil, because Chinese ships are considered Chinese territory under Chinese law. So that would be, I think the CENTCOM, the US, will find it very difficult to try and stop that type of transit.
Serna, earlier we were talking about President Trump putting up a post suggesting that the two leaders, he used the word leaders, so we don't know who he's referencing in Lebanon, but we think he probably means the president, between Lebanon and Israel will have a call at some point today. And overnight also, I noted that the Iranian Speaker of the House, Ghalibaf, who's really emerged into a very prominent role in these negotiations, has once again linked the Lebanon file to the broader regional ceasefire with Iran. To what extent do you think is the U.S. going to be successful at separating those two issues?
Yeah, that is another point of potential escalation or breakdown of the ceasefire that we're watching alongside the Hormuz. Iran cannot afford to allow for it not to be part of the conversation around the future of Lebanon, right? Hezbollah has stepped in to support during the last 6 weeks, and it is kind of existential for Iran's influence in Lebanon to maintain that influence and that power. So a conversation between the Lebanese president and Israel, or any potential deal there that essentially excludes Hezbollah and Iran from the table, is I think is a red line for Iran, but also probably for Hezbollah itself. So there are concerns, even if this would happen, that if this would happen, that it could create significant rifts within Lebanon itself. Now, I don't know if we're taking this as highly likely. The sounds, I'm sure that U.S. President Trump wants to sort of find a ceasefire or some sort of even temporary deal vis-a-vis Lebanon, Israel. I'm not sure Israel is actually prepared to do so.
Sorana, thank you so much. Really good to chat to you today. Sorana Parvulescu, partner of EMEA at Control Risk. Thank you. Now, Asian shares are rallying as investors pile into equities amid signs of a diplomatic push for a second round of talks between the U.S. and Iran, and a whole bunch of other factors, I would say, as well. Joining us is Chief Market Strategist at Equity Group, Nooraldeen El Hamouri. So, well, we just had maybe a more realistic conversation with our geopolitical guest, but markets seem to be behaving as though the war is over.
That is absolutely correct, as if the war is over, and you have to give that credit maybe to the U.S. administration this time, because they played a crucial role in their contradictive messaging to keep the hopes up in the market. In addition to that, of course, we had the Big Bang Q1 results this week, where also a textbook example of the resilience amid the early quarter energy shock. JP Morgan, Citigroup, Wells Fargo, and the rest posted solid beats. JP Morgan also saw record markets revenue. Net interest income held nicely, and investment banking fees basically jumped on a deal actively that was already in the pipeline before the Iran flares up. So the real watchdog remains now is the forward guidance. With Hormuz blockade still in place and oil still placed around the $100 or the $100, banks are signaling sort of they can pass through higher funding cost, but any prolonged disruption could crimp loan demand and credit quality in the back half of this year.
Yeah, assuming there is a ceasefire extension, would you say that now, looking ahead, the biggest driver for markets are going to be earnings and what we get out of company earnings? I mean, it sounds obvious, but it wasn't obvious a week ago.
That's correct. I mean, at least from what we saw over the past couple of days, banks, if you might say, just delivered the goods, but the blockade keeps the second half outlook cloudier maybe than the street wants to admit. In addition to that, I think yes, but this time, even if a deal is announced over the next couple of days or maybe the next couple of weeks, because we still don't know if this ceasefire will last or if there will be an extension. But I think the market already priced in a lot already ahead of this negotiations, because I think at some point, in addition to that, we know for a fact the global economy can't handle another 3 weeks of this war and another 3 weeks of the blockade and another 3 weeks of higher oil prices, especially that we're pulling out of reserves. The demand is much higher, and also the supply has been disrupted marginally, I would say, at least from the biggest producer. So I think at some point, if we are in any shape or form very near a ceasefire, maybe the top would be in, but at the same time, this will be also a delayed effect, which I think everybody knows that the stagflation risk is now much higher than before, and we've seen it at least if you look at in the U.S. The ISM services. Now we have higher prices, but on the other hand, we have a shrinking, or not shrinking, a slowing down in services.
So I want to come back to something you said there, which is maybe we get a ceasefire extension, right? And in the absence of a full reopening of the Strait, yes, we see a de-escalation in terms of hostilities, but you still haven't solved or resolved the energy issue. And you just said that, in another 2 to 3 weeks, we are going to start to see the physical impact being felt across markets. Once again, could that not come back to haunt certain parts of the market that are turning a bit too complacent about the end of this war and the real possibility that it's definitive?
Absolutely, because once again, markets have been trading on hopes, not on facts. The only thing that we've seen maybe on facts based on the bank's earnings, but oil is still all about hopes. And the possibility of a peace that might include or might not include reopening the Strait of Hormuz. But I think, everybody's wise enough to understand that without the Strait or without a peace deal that can actually restore the flow of oil freely, despite the fact that, again, the numbers that we're seeing online or the general numbers are still showing there's about maybe between 4 to 7 tankers are flowing through the Strait. Now, in addition to the non-official numbers, it's showing that it's much higher. Now, at some point, if this deal doesn't go through, I think this would be the biggest effect that we'll see in the market. We'll see much higher oil prices, yes. Another correction, which I believe that it would be a significant correction in equities across the board, but this is still contingent because for the past full month, the mixed messages from the White House, from also in addition to Iran and Israel regarding this war that is going to continue for 3 weeks, it's going to be it will end very soon. Yeah. We have a deal, we don't have a deal. This basically played a huge role when it comes to kind of sustain and contain the damage. But now, if this hopes basically get destroyed or the negotiation stalls, I think the market will be basically forward looking that there's no deal, and this is when we will see the biggest effect.
Noordine Al-Hamouri, Chief Market Strategist at Equity Group, thank you so much for coming on the show. Well, some sad news for the world of finance. Emerging markets investing pioneer Mark Mobius has died at the age of 89. A partner at Mobius Investments says he passed away in Singapore. Mobius spent over 30 years with Franklin Templeton, championing opportunities in Africa, Asia, Eastern Europe, and Latin America. He founded Mobius Capital Partners in 2018 and continued to seek out investing opportunities in recent years, including setting up a new venture in Dubai. And just before we head to the break, this is a look at markets. Things are leaning towards positive, but coming up, we're going to be talking about the economic impact of the war. The Iran war has created some clear winners and losers across the Middle East. We'll break it down country by country and what the latest IMF forecasts are suggesting from the world economic outlook as well. Stay with us. This is Bloomberg.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the rice air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top to the bottom, make the sushi shape the more beautiful. 3. Then, I'm not, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is the 1 to 6.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Good morning. This is Horizon's Middle East and Africa. Our top stories this morning. Asian stocks rise after a record-breaking rally on Wall Street as optimism around a potential U.S.-Iran peace deal and strong corporate earnings lift sentiment. Washington and Tehran are said to consider a ceasefire extension to allow more time for negotiations, even as a standoff over the Strait of Hormuz intensifies. President Trump also saying he is trying to get a little breathing room between Israel and Lebanon. And Saudi Arabia's sovereign wealth fund releases its plans for the next 4 years with a major focus on domestic strategy. That is as the kingdom is also said to be considering ending funding of Live Golf. It has just gone 8:30 a.m. across the Emirates. I'm Versace in Dubai. Well, record high for the S&P, record high for the Nasdaq. Most Asian bourses have fully recuperated the losses sustained throughout the course of the war. And so equity markets are really jumping to the conclusion that the war, the hostilities in the region are over. But again, as ever, word of caution, we are in a state of a ceasefire, and it is still, as of now, a temporary ceasefire. And there's a blockade still ongoing at the Strait of Hormuz. So that's what I'm going to say on the geopolitical front. Anyway, the handover from Asia Pacific, positive today, up 1.1%. And we got some more positive data, surprising to the upside, from China, as we spoke about in the first half of the show. S&P futures leaning towards positive as well. And they're also taking their cue from better earnings. Obviously, we're in the thick of earnings season now as well. Morgan Stanley, Bank of America posting solid results, and most notably in their equities trading business. It's been a better quarter for equities trading than it has been for fixed income, evidently. And then Brent trading just shy of $95 here, so flattish on the day, still a significant amount of premium in the oil curve. And then gold, we have it 4,830, slightly firmer this morning, up 0.7%. Switching over, just a flag, NASDAQ is at an all-time high, Magnificent 7, not quite there yet, but they're charging upwards. So we'll probably get there in the next couple of days if sentiment continues like this. But I just wanted to showcase that we have come a long way since the lows sustained throughout the course of this war. So quite the rebound for anyone invested in Magnificent 7. And then my other favorite chart of the last 24 hours, this is Allbirds. And for anyone who knows Allbirds, they are a sneaker company. They make trainers, they make shoes, and they weren't doing very well. And so yesterday they announced that they're rebranding to an AI company, and the stock shot up 400%. So I guess that tells you a lot about sentiment, and that people really still are very excited about the prospects that artificial intelligence and what that can mean for companies, even if their basic bread and butter business isn't a successful one. So Allbirds, one of the big moving stocks yesterday. Okay, let's also dig a little bit deeper into how some of these individual stock markets in Asia are faring. Winnie Su is in Hong Kong for us. Winnie.
Yeah, morning, Jomana. As you mentioned, we're seeing sentiment really improving in Asia, with expectations rising that we will have further de-escalation between the U.S. and Iran, and potentially a resolution within the foreseeable future. Now, when it comes to the MSCI Asia, you mentioned up more than 1% for a third day. Now, we are seeing key benchmarks in the region erasing losses since the war began, and that includes Japan's Nikkei 225, now headed for a record close. Now, when it comes to Chinese stocks onshore, a CSI 300 here holding up on around 1% gains, and that's coming after those positive numbers, as you mentioned, that we are seeing a economic growth rebounding, with the first quarter GDP numbers also beating expectations, showing limited impact from the Iran war. Now, you flip aboard, I want to draw your attention to this interesting chart, as we're seeing here market cap of the Taiwanese stock market actually overtaking that of the UK, and now at $4.14 trillion, making it the 7th biggest market in the world right now, thanks to that boom in AI. And that's exactly why we will be taking a very close look at the earnings from TSMC within the next hour or so. Back to you, Jomana.
Wow, that is quite the chart. Market cap quadrupling in the last few years for Taiwan. Interesting. Okay, for more on the state of markets, let's bring in Bloomberg MLive executive editor Mark Codmore. So don't call it a comeback, but it actually is, Mark. S&P, NASDAQ, all-time record highs. Do we just keep going from here?
I think absolutely we do in the short term. I think that this positivity and this optimism is justified right now until we either get a complete escalation in the conflict again, or until we get a deal, ironically enough, because then we'll move on from that. As long as it's kind of talks, it doesn't really matter. And I know it's a difficult kind of thing to kind of discuss and phrase. I mean, you're based in Dubai, Jomana, and you're very aware that in the region, we're a ceasefire that's kind of seems to be very tenuous. There doesn't seem to be close an agreement. But from a market's point of view, and away from the humanitarian point of view, from a market's point of view, the war is effectively over, and it was effectively over from when the ceasefire was agreed. It basically, what market participants care about is that the big tail risks are getting removed. It doesn't matter whether there are hiccups, and I'm saying again, away from the humanitarian issue, it doesn't matter if there is still some setbacks, if there's still some breakdowns, as long as we don't materially escalate. I think the comparison is the Korean War is still ongoing 70 years later, and I know that's an extreme example, but there was never a true deal reached there. And I think that's the way the markets go. That as long as it's not going to get worse, it's on a better path, and they won't focus on the real economic damage from the war until we've kind of got through those talks and we know what the kind of status quo is. So I think from that point of view, yes, the optimism is justified. We're going to probably continue to focus on earnings. We're going back to the AI theme, and now it's at cheaper multiples than it was only 2 months ago. So people are getting very excited, and there's a lot of euphoria out there.
Okay, there is a lot of euphoria, and I've been flagging my favorite chart of the day today has been Allbirds. Just absolutely astronomical price action yesterday because they rebranded into an AI company. What does that tell you about sentiment in the market right now? It sort of takes me back to the days of, the meme stock hysteria that we saw around the pandemic.
Yeah, and I think that's exactly right analogy. I think we're getting back into that kind of slightly excessive exuberance. But this is one of the first signs we've had. Like, we were not talking about these kind of things a week ago. And if you remember back to the analogy from a couple of years ago in the COVID, the pandemic era, you know, it played out over a couple of months, you know, at least weeks. So I think this is an early sign. We're probably going to get a few more of these stories, but it's an early sign that we're getting towards frothiness. But I think we're at the start of that frothiness. And I think that it also emphasizes that this market is being driven by single name positioning. It's actually been driven by the micro rather than the backdrop macro. You know, the backdrop macro hasn't suddenly got much better. Whatever I may have just said about how market participants view the conflict, oil prices are way higher than they were a couple of months ago. Energy prices are way higher. There's a supply chain problem. Yeah. There's a worse monetary policy backdrop. But from a micro point of view, investors see that earnings are still good. There's short positioning out there they can squeeze. And I think that Allbirds speaks into the idea that the index gains are actually being driven disproportionately by single names doing extraordinarily well. And a lot of them are driven by variations of the AI narrative, and it's a very amorphous beast, so it can take on many forms.
Yeah, it is an amorphous beast. Bloomberg MLive Executive Editor Mark Cudmore, thank you so much for joining our show. Well, IMF Managing Director Kristalina Georgieva is warning that markets should be more cautious when it comes to the war in Iran. She told Bloomberg central banks should resist the urge to hike rates in response to the crisis, as this could damage economic output.
We now have ceasefire. I pray it turns into a durable peace, and in that case, we can see a somewhat faster recovery. But the uncertainty has been profound, and we all need to learn to operate in an environment of high and permanent uncertainty.
But MD, even if there's a ceasefire that stays, okay, and there's some kind of diplomatic resolution, is the market discounting the real impact on the price of oil and therefore inflation?
Well, let me just say that even if the war ends tomorrow, it would take quite some time for the recovery to kick in. Not only because of the infrastructure destruction. Tankers are slow-moving vessels. A tanker that leaves today would take 40 days to reach the Pacific Islands. So we have to keep in mind that the impact is already baked in. Why are markets so optimistic? I think part of the reason is because there is a high concentration of financial assets in the United States. The U.S. economy is doing well. It is relatively not so impacted because the U.S. is an oil exporter, not importer. And that creates that picture of dynamism and vibrancy, but I can tell you that's not the story of the rest of the world. In the rest of the world, already there is a lot of pain.
So, I mean, does that mean that the market is mispricing, that all this market exuberance is actually misplaced?
What it means is that markets are geared by events in the largest economy that are really positive. The United States is the only large economy that has high productivity growth, and markets are seeing that. Technology optimism is here. Markets are rushing on it. But should there be more caution? I would argue yes, because what we are seeing in terms of supply chain disruptions is already quite significant. And with every day that passes, that tanker is not leaving for a destination, and that delays the rebounds of the world economy.
That was IMF Managing Director speaking with Bloomberg's Francine Lacroix. Well, the IMF has sharply cut its growth forecasts for the Middle East and North Africa, warning that the Iran war is disrupting energy supplies and weighing on the region's outlook. The fund now expects growth just over 1% this year, with major energy producers hit by damaged infrastructure and the closure of the Strait of Hormuz. For more, we're joined now by Ziad Dawood, Chief Emerging Markets Economist for Bloomberg Economics. Well, you know, the headline for the region, Ziad, is that we are going to drop more than 2 percentage points in terms of growth. Last year was north of 3%. This year's going to be closer to 1%. I don't think that that is a surprise, but perhaps, if you draw on some of the individual countries, what stood out to me is there's a pretty stark downgrade for the likes of Qatar, no surprise Iran, but also Iraq as well. What do you make of these numbers that have come through from the IMF?
I think the aggregate number is not surprising, as you've mentioned, Jumana. The whole world is getting slowed down in terms of growth because of the Iran war. The Middle East is getting a sharper slowdown given the more direct exposure to the war. But then there are individual sort of countries, individual circumstances. I think if you're an oil-importing country, you're a clear loser from this because the cost of oil has gone up and the cost of imports have gone up. But within oil-producing countries, the exposure is different. Some countries are able to get their oil out and benefit from higher oil prices, like Oman. Others are not able to get their oil out, and the exposure and the hit to growth is bigger. Think about Qatar, Kuwait, or Iraq. But even within these countries that are unable to get their oil out, they have different exposure because they have different sort of wealth to begin with that are able to cushion them from the closure of the Strait of Hormuz and their inability to get their oil out and get the oil windfall that is necessary for them.
Yeah, and the other thing is when you think of the recovery as an economist, again, so much of that is going to be dependent on how long the Strait effectively remains shut for. And we were speaking about it with our earlier geopolitical guests, that even if there's an extension of the ceasefire, so long as the Strait is somewhat blocked or closed, then the economic impact is going to be felt not just for weeks, but for months on many of these countries. So how do you look ahead to the future?
Well, if and when the war ends, you're going to get a bounce back in growth. That's just like an arithmetic sort of reality. If you go from negative growth to zero, that's a bounce back. But as you said, Jumana, the extent of the damage and the extent of the bounce back will depend on the duration of war. And it's not just the damage to infrastructure. It's not just the closure of the Strait of Hormuz, which the longer it lasts, the higher oil prices remain. It's also the fact that some countries are drawing on their savings, and that process needs to come to an end for some countries. It's also the fact that the longer the war goes, debt stress may show up in some countries. And I'm not even talking about second-order effects in terms of higher oil prices leading to higher inflation, higher living costs, and the political consequences of that. So yes, the fact is, the longer the war lasts, the bigger the damage. And if it ends, I think, tomorrow, then I think we're probably going to get a rapid bounce back. But if it lasts for more months, we're going to get lasting damage that will drag on growth for some time.
Ziad, thank you so much. Good to see you. Ziad Dawood, Chief Emerging Markets Economist for Bloomberg Economics. Now for a look at some of the other stories we're following today. Bloomberg has learned that Saudi Arabia's public investment fund is considering cutting off its multi-billion-dollar financial support for Live Golf due to heavy losses and a lack of viewership. An announcement on Liv's financial backing could come on Thursday. The move would mean the end of the Breakaway League and its high-stakes rivalry with the PGA Tour. Abu Dhabi's state oil company says it's open to more deals in Europe despite the region's economic challenges. The company recently finalized a $60 billion deal to create Barouge Group International, the world's fourth largest makers of polyolefins. A downturn has forced Barouge to delay its planned share listing in Abu Dhabi until 2027 due to complications including the current Middle East conflict. Qatar's finance minister has warned of a bigger economic fallout from the Iran war over the coming months if the Strait of Hormuz is not reopened soon.
The impact, it goes way beyond Gulf countries, even to the whole world. And what we have seen so far is really the tip of the iceberg, in terms of impact. Yet the full-fledged impact is coming, and it's not coming far away. I think in 1 month, 2 months' time, you're going to see really a huge, economical impact globally as a result of this war.
Pope Leo XIV, who has been in the headlines a lot this week, is calling for dialogue in Cameroon as he visits the country amid a long-running conflict. His message comes at a time of growing global tensions and has drawn criticism from Washington, with Vice President J.D. Vance urging the Pontiff to be more cautious in his remarks on the Iran war. Our Chief Africa correspondent Jennifer Zabazaja joins us from Johannesburg. So the Pope is making this very high-profile visit to Africa. What is the significance for the continent?
Exactly, Jumana. We're already seeing some of the symbolism of this trip by the Pope to the continent. We'd seen his visit actually triggering a 3-day truce in Cameroon, as you were just speaking out there, which has been in the midst of a years-long conflict. That is just sort of underscoring this message of peace and unity that he has tried to push out there, not just for the continent, but also for a number of global conflicts that he has been publicly outspoken about. So we did see the Pope kicking off his 10-day tour in a Muslim majority nation in Algeria, becoming the first Pope to ever visit that nation. And then, as you were just noting, he is traveling to Cameroon. He's currently in Cameroon and is actually going to be directly in conflict zones where he is again going to be touting this message of peace over unity and potentially even continuing some of the messaging that we did hear from him on Wednesday, which was about really pushing for development and the need to end what he was describing as corruption in a crowd that, I should note, included the president, Paul Biya, one of the world's oldest leader, who recently actually secured an 8th term in power. So the significance really is multiple for not just the Vatican, but also for the continent. We should also note, though, that he moves on from Cameroon to Equatorial Guinea and also to Angola, where they are largely dominated by Catholics. But many observers really see this as a pushing forward of what the Vatican really seems to be shifting towards more of a focus on the global south and really what has become the fastest growing region for this religion in the world.
Yeah, and look, I think we need to address the fact that the president himself, President Trump, has been heavily criticizing the Pope for not being supportive enough, perhaps, of U.S.'s foreign policy interventions. Equally, J.D. Vance also criticizing. And what is the White House risking in the efforts to push back against the Pope?
And you pointed it out there, Jumana. We really saw a lot of this public feud escalating at the beginning of the week, and it didn't seem to tamper down any more so as the Pope has been traveling throughout the continent. So really, if we think about what this represents just for a minute here, the first American-born Pope and the U.S. president publicly feuding, that is setting up quite a showdown and potentially political fallout for the U.S. president. We've already seen that playing out. We should note the U.S. has an approximate population of just over 50 million Catholics, which we should just point out, the last election in 2024, much of the Catholic population was very key for Trump to winning the 2024 election. So potentially we could see some alienation of an electorate that was supportive of him in this last election. Not just from a domestic level, Jumana, we've also seen some of the fallout more from other global leaders. We saw earlier in the week, we actually had Italian Prime Minister Giorgia Meloni calling Trump's comments about the Pope unacceptable. Meanwhile, we've seen the Pope continuing to double down on what he has talked about, which is his opposition to a number of military interventions. And we should note that this is not the first time that we have seen some of this public disputes between these two. This really started last year at the beginning of the administration over immigration policies, and again sort of continued as we saw U.S. intervention in Venezuela, now into the Middle East. And so it seems like there is a bit of a doubling down on both sides. Potentially, though, the fallout, though, is higher stakes for the U.S. president.
Jen, thank you so much for breaking it down for us. Jennifer Zabazaj, our Chief Africa Correspondent in Johannesburg. Now for a look at some of the other stories we're following today. Nigeria says higher oil prices are a double-edged sword for its economy. Finance Minister Wale Eden says while the country stands to benefit as a major crude producer, the Iran war is also fueling inflation and raising borrowing costs. He warns that higher prices could slow investment, even as the government cuts import levies on key goods like rice and sugar to ease pressure on households. Nigeria's monthly inflation has surged to its highest level in more than 2 decades, driven by rising fuel costs linked to the Iran war. Consumer prices jumped 4.2% in March, while annual inflation edged up to 15.4%. Energy costs led the increase, highlighting the impact of global supply disruptions as the war pushes up oil prices and feeds through to the broader economy. Saudi Arabia's wealth fund has unveiled a new strategy focused on boosting returns and turning its portfolio companies into global champions. The Public Investment Fund's 2026-2030 plan comes as the kingdom confronts the economic fallout of the Iran war and with questions swirling over mega projects like NEOM. Nandu Nair, team leader of the Middle East Money and Power, joins us now. So, Nandu, in practical terms, what changes are we talking about with the PIF splitting into vision, strategic, and financial portfolios? What does that actually mean in practice?
Thanks, Jumana. So, and at a very overarching level, strategy is clearly emerging that the PIF wants to really focus on increasing returns and maximizing its strategic assets. So they have created over 100 portfolio companies since its inception, and now they want to look at it and create some of them and turn some of them into global champions. What they want to do also is to try to change its role from being a source of capital to someone who's almost a catalyst for investments into the domestic economy. What they've said is that they will look at all avenues possible, including IPOs, to try to generate returns from the host of companies that they've built across the Saudi economy.
Yeah, I mean, the thing is, the outside world, whenever you talk about Saudi 2030 vision, the number one question they ask is about the mega projects, about NEOM. Did we get any more color on how the kingdom is thinking about the evolution of those projects?
Yes, of course. NEOM, there have been many questions swirling around about the fate of NEOM, and NEOM fits into the first bucket or the first portfolio that they've identified, which is the vision portfolio. NEOM is a separate ecosystem by itself, and what the PIF governor said in the press conference after announcing the vision statement was that none of the projects have been cancelled. There have been some delays, but those delays are essentially for the PIF to be able to focus its attention squarely on the big events that are coming up, which is the Expo in 2030, the World Cup in 2034, and its strategic investments into AI. So the signal coming out from PIF clearly that there is no cancellations, only reprioritization.
Okay, I mean, but let's also not ignore the fact that the war has been going on. I mean, there's a ceasefire now, but it's been 7 weeks since the start of the Iran war. How has that affected PIF's deal making, Nandu?
The timing of this, the strategy announcement is interesting, right? Like you said, it comes in the midst of the ceasefire. And what we have seen in the last month or so is that it has really not, the war has really not slowed the PIF down. It has done high-profile, big-ticket deals, including a $6 billion deal to buy a gaming company. Just this week, it doubled down on its investments into an electric vehicle maker in the US, Lucid Motors. And just a month ago, the PIF governor had said that the wealth fund remains completely committed to its international investments. So it's really looking at these strategic investments globally and saying that they're not going to back down from it and they're going to stick through with them.
Nandu, great to have you on. Thank you so much for breaking it down for us. Nandu Nair, team leader of Mideast Money and Power. And remember, you need to subscribe to that newsletter. It comes out every Monday afternoon from Nandu and the team, Mideast Money. Okay, a quick look at equities before we head out into the European session, and things are green. The market is trading like the war in the region is completely over. brushed past it. S&P, NASDAQ, all-time highs, leaning towards positive as we head into the open. European markets too, up 0.3%. And of course, keep a close eye on earnings. We're still at the very beginning of earnings season in the US. Expectations are high, seeing double-digit growth for EPS. So that's something we're going to watch out for in the coming weeks as well. That is it for Horizons Middle East and Africa. I'm Joanna Bersetchi in Dubai. Stay with us for Daybreak Europe. This is Bloomberg.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Live from London, this is Bloomberg Daybreak Europe. I'm Tom McKenzie with your top stories. Global equities hit all-time highs as investors pile back into stocks on signs that Iran and the U.S. may extend their ceasefire. China's economy expands at its fastest pace in 3 quarters, suggesting limited spillover so far from the war in the Middle East. Plus, AI back in focus as the world's top chip maker TSMC reports this hour. We'll also bring you numbers from French spirits maker Pernod Ricard. Let's check in on the markets then. The Nasdaq 100, an 11th set of days, of gains for the Nasdaq 100. The S&P 500 at fresh record highs yesterday. So in terms of the equity markets, risk on. Oil is below $100 a barrel. The futures then, in terms of European futures, pointing to gains, up 0.3% so far. S&P futures, again, after the record of yesterday, breaking above 7,000, looking to add about 0.1% as we build up, of course, to the European session. US futures also in positive territory, and certainly, and once again, oil and the fact that oil is below $100 a barrel is one of those catalysts, at least, as those talks about extension of ceasefire continue between Iran and the US through their mediators. Currently Brent at $95 a barrel, up just 0.1% in the session today. Here's what to think about in terms of the risk events then this Thursday, 7 a.m. UK time. We're going to get the monthly GDP out of the UK. We'll break that live for you, of course. 1:30 p.m. UK time. Meanwhile, our focus switches to the US and a focus on the labour market with US jobless claims and that data crossing. And at 9 a.m. UK time, we've talked about the earnings story. Netflix updating with its earnings at 9 p.m. UK time. Let's get to the start of the Thursday show. Daybreak is coming up. So risk on. Stocks in Asia are gaining after the S&P 500 closed at that record high. Let's get an update from Winnie Su, standing by in Hong Kong. Winnie, a strong session in Asia as well.
Yeah, good morning, Tom. Indeed, sentiment pretty upbeat in Asia as investors seem to be looking past the Iran war and expect further de-escalation with the U.S. And here, MSCI Asia up for a third day. Today, up more than 1%. Now, we do have key benchmarks in the region all erasing losses since the war began, and that includes Japan's Nikkei 225 here up more than 2%, headed for a record close. Now, when it comes to Taiwan's benchmark, Taiwanese TAIEX index also refreshing fresh highs ahead of the TSMC earnings that we're expecting during this hour. Now, for now, we are expecting a 50% jump in the net income, but the focus will be on the AI demand and the potential impact from the supply chain disruptions. Now, when it comes to Chinese stocks, the onshore CSI 300 still holding on to its gains after that latest set of Chinese eco data showing some resilience in the economy. We flip the board and take a closer look at those numbers because here the biggest one to flag is the first quarter GDP number. We are seeing 5% increase, and that's beating expectation and the prior numbers of 4.8%, showing that there is limited impact from the Iran war, and also supporting the growth still is on the manufacturing side of things. We're looking at industrial production year over year, March numbers up 5.7%, also beating expectation above 5.3%. Still on the weaker side of things, though, we have to highlight is still the domestic demand. Retail sales numbers up just 1.7%, coming as a disappointment versus the estimate of 2.4%. So there still is that the differences that we are seeing on the manufacturing side of things and the domestic demand. Back to you, Tom.
Winnie Su, thank you very much indeed with a check on the Asian markets and breaking down the data out of China as well. Joining us out of Hong Kong, Winnie, thank you. Let's switch focus to the Middle East once again, of course, because Bloomberg understands the US and Iran are considering a 2-week ceasefire extension to allow for more time to negotiate a peace deal. Mediators are said to be seeking fresh talks to overcome the issues preventing a longer-term agreement, including the Strait of Hormuz and Iran's nuclear program. The White House, however, is playing down the reports.
I saw some reporting, again, bad reporting this morning, that we had formally requested an extension of the ceasefire. That is not true at this moment. We've remained very much engaged in these negotiations, in these talks. You heard from the Vice President directly and the President this week that these conversations are productive and ongoing, and that's where we are right now.
Let's bring in Bloomberg Horizons anchor Jemana Besetchi live from Dubai. Jemana, what more do we know then about a potential return to the negotiating table and maybe an extension to this deadline that was set for April the 22nd?
Yeah, that's right. Well, there's rampant reporting suggesting that the diplomatic channels are being worked very actively to make sure that the second round of negotiations does take place. We just heard from the White House press secretary over there, Caroline Leavitt, and she said that the U.S. has not formally requested an extension to the ceasefire, but our understanding is that, and this is our own Bloomberg reporting, that they are considering a 2-week extension to the ceasefire. That has not been confirmed by either side, though. However, we know that from Caroline Leavitt that if another round of discussions is held, likely venue will be Islamabad. And to that point, I would just say it's unlikely that happens in the next couple of days because the Pakistani Prime Minister is undertaking a diplomatic tour around the region. He met with the Crown Prince of Saudi Arabia, MBS, yesterday afternoon in Jeddah. He's going to continue his travels on to Turkey and to Egypt as well. So that puts us back to perhaps April 18th. At the same time, the chief of army, the Pakistani chief of army is in Tehran. One of the key mediators, of course, reaching out to some of the Iranian negotiators on that front. And then also of note, and this was quite interesting to see, the first call has taken place between the Iranian Speaker of Parliament and the UAE Vice President yesterday. And remember, UAE obviously has received the lion's share of incoming projectiles and attacks coming through from Iran. So all of this, Tom, suggests that the diplomatic angles most definitely are being worked very aggressively in anticipation of what could be a second round of talks. But the question is whether these talks will actually yield to a longer-term cessation of hostilities or whether it's just another extension of ceasefire that is on the table, because the key crucial issues between the two sides remain, and mainly those are to do with the fate of the Strait of Hormuz, the nuclear file, and more recently, Iran had been pressing quite aggressively for war reparations and the lifting of sanctions as well.
And Jemana, given the centrality of the Strait of Hormuz, as you say, in these negotiations, and that being a major sticking point still for these two sides, talk us through the market reaction to the developments that we've seen up until this point.
Yeah, I mean, you look at the price of oil, it's still trading $20, $25 higher than where it was before the war started. Take a look at S&P and NASDAQ, and they're at all-time highs. So equities are telling you a very different story from energy markets, and that is valid because even though the ceasefire is still being upheld, number one, we don't have a full cessation of hostilities, and number two, we do not have a full reopening of the Strait. We essentially have two blockades in place now, and we've been monitoring micro movements of vessels that are getting through or not getting through, but ultimately our own reporting suggests that in the last couple of days, only about a dozen vessels have made it through the Strait. Compare that to the volume of around 100 to 150 that used to go in on a daily basis before the war even started. So for all intents and purposes, the Strait is still effectively closed. Now, we know that the US has introduced this blockade as a means of extracting some of Iran's leverage out of the equation in anticipation of what could be the second round of talks. The CENTCOM, once again, asserting overnight that they have full maritime superiority over the region, over the Strait, I should say, and that the blockade is successful. But for energy markets, unless you start to see a full unconditional rite of passage for all of those ships passing through, you're unlikely to go back to pre-war levels. And at the same time, the market is also accounting for the time it's going to take for the energy infrastructure that was damaged to get fixed. Yesterday, we heard from the Qatari finance minister in the IMF, and he was saying it's going to take months, number one, for the world to feel the full effects, the physical effects of the supply disruption. And number two, it might take years for Qatar to restore capacity to what it was before the war started. So perhaps for energy participants, they're a bit more cautious about how this is all going to play out in the coming weeks.
Yeah, that was a stark warning, wasn't it, from the Qataris. Bloomberg Horizons anchor Jemana Besechi. Jemana, thank you for that update live for us out of Dubai. So that ties in to how central bankers then are reacting to the oil and energy price shock out of the Middle East. Central bankers have indicated they are in no hurry to raise rates. Sources at the ECB say policymakers are leaning towards holding this month, while the Bank of England's Megan Green says relevant data will take a while to come through.
Unfortunately, we won't have definitive data on whether there are second round effects or not for months, and if we wait until we see it, then it will be too late. So for me, I'm looking at inflation expectations, certainly. I'm also looking at the pay settlements as they actually come in, but I'm looking at some forward-looking indicators as well. So we run a survey of businesses. We ask them all kinds of questions, but they talk about their year ahead price expectations and their year ahead wage expectations, and so that will be important too.
OK, let's bring in Bloomberg M-Live strategist Mark Cranfield. Mark, from what you've heard then from central bankers gathering in Washington, how does that change your view in terms of the shape of the yield curve and how bond market participants should be factoring this in terms of their positioning, as it seems those dynamics around growth versus inflation seems to be, that pressure is still there?
I think what you're going to see is a continuation of the curve flattening theme, which we've had for a little while now. In addition to all those comments that you just heard there, also the Japanese finance minister has said that she sees central banks in a wait-and-see mode. She was in the same meetings as the others there, and that's filtered through to Asian markets today. We've seen Japanese bonds outperforming some of their peers in the region. And it's clear that people want more time to assess what's going on here. Now, as Giovanna was saying, that what will happen here in terms of the markets is because people will continue, that premium for the oil in the market will need to stay there. The risk that something could go wrong, even though there was a ceasefire at the moment, it doesn't mean we can't completely rule out the possibility there will be backtracking somewhere down the line. So people will want that premium priced into the market, maybe $20, maybe a little bit more. That will keep upward pressure on short-term interest rates. Central banks will be very reluctant to do anything about it. The market will price as though they're going to hike interest rates. They may delay it, but it will be there in the market for some time to come. In the meantime, there are growing risks to economic slowdown. The longer that we keep oil prices high, that will be reflected in the longer end of the curve, so those yields can come down a little bit further. So generally a flattening of the curve. If we keep the same kind of situation, again, as Giovanna was saying, we would need to see completely free-flowing ships through the Straits of Hormuz. Then people would get excited about being able to bring oil prices right back down again. That doesn't look likely in the short term, so that means that short rates stay high, longer rates can come down a little bit further.
Bloomberg M-Life strategist Mark Cranfield. Mark, thank you on the implications, of course, of what we're seeing out of the Strait of Hormuz and what we've been hearing from central bankers as well in terms of their thinking about where the rate trajectory goes from here. Still ahead, the world's top chip maker reporting. We'll focus in on the conglomerate and the company at the heart, of course, of producing the AI chip story. We're going to focus on TSMC as it rides the way for those AI chips. But first, China's economy rebounding faster than expected. We're going to dig into the data next and what it tells us about the resilience of the world's second largest economy. That is coming up. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
From the beating heart of global finance, economics, and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacqua, and this is The Pulse, every weekday only on Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Earnings season is here.
Certainly valuations have shifted quite significantly.
Maybe a bit of optimism.
Bloomberg is first to break the numbers.
We're talking about a move away from U.S. assets.
So much corporate issuance.
Let's get the reaction and context.
With the smartest insights.
We're observing what's happening in the Middle East.
The situation is volatile.
We're closely monitoring the impacts on supply chain and logistics. Cross-border M&A, still such a difficult thing to get done in Europe.
Continuing coverage on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, China's economic growth rebounded more than expected in the first quarter of 2026, suggesting limited impact so far from the Iran war. Let's bring in our chief North Asia correspondent, Stephen Engel, with the details. Stephen, you've been going through the data in the context, of course, of the Middle East conflict in Iran and China's exposure, particularly to the energy part of that story. Yeah. Stephen, what for you stands out from the data set that we got today from China, and how much resilience is there now in this economy?
Well, clearly in the first quarter, it's still early to say because we don't know how long the war will potentially last and the lasting impact of the oil shock that right now China seems to be weathering quite well because of their reserves, sure, but also their diversification of their energy mix, much more into renewables, and also the tried and true old cocktail of relying on coal. That is something that the officials in Beijing talked about, that they didn't have to rely as much on the oil and natural gas that they get from the Middle East, even though that is quite a large chunk that has to go through the Strait of Hormuz. That is not necessarily arriving in China. But again, the first quarter is not necessarily the barometer for the rest of the year. But resilience is the buzzword that they are saying, and we are kind of mimicking as well, because 5% GDP growth in the first quarter, when it was 4.5%, a nadir, a post-COVID nadir in the fourth quarter, and there was an estimate, a consensus estimate of 4.8%, Tom. So they beat that as well, coming in at the high end of the range that they gave in March for the full year of 4.5% to 5%, despite all the stresses, including domestically, where the consumer, the household, is simply not spending like they haven't done for a couple of years now. Retail sales did not meet expectations, whereas factory output did, and GDP surpassed it.
And given those dynamics then, the competing dynamics that you outlined for us there, Stephen, the household is still under pressure in China. Retail and the consumer is not coming back yet, but the export engine seems to be ticking over relatively healthily. What does that mean for Beijing's response, for regulatory, for lawmakers' response in terms of trying to rebalance that economy, trying to support that economy, trying to support the consumer? Do we get more or less stimulus on the back of this data?
Well, everybody that we've talked to says it's not necessarily going to give the impetus, because the numbers beat expectations, for more that we're not going to get more stimulus is the bottom line. And that is something we heard at the National People's Congress, the annual session of Parliament in early March. They were going to withhold a stimulus until they absolutely need it. They surpassed expectations on growth. The manufacturing sector has held up. Yeah, it dipped back a little bit, but it's still very strong. And considering as well, there were more days that factories were idle in the last couple of months because the Lunar New Year aberrations, it came later in the year. So all that combined, the economy is doing well, absent the household spending and consumption. So I think it's steady as she goes on any kind of stimulus until they absolutely need it, Tom.
OK, Bloomberg's chief North Asia correspondent, Stephen Engel, with the data and the context. Stephen, thank you. Now to some other stories that we are following this Thursday. Bloomberg learning that US investigators are looking into suspicious trades in the oil futures market that were made ahead of recent policy pivots by President Trump on the war in Iran. Sources say the Commodity Futures Trading Commission is leading the investigation into trading of oil futures contracts on platforms belonging to CME Group and Intercontinental Exchange. They're focusing on at least 2 recent instances where trading volumes surged shortly before major announcements. And Bloomberg has learned that Saudi Arabia's public investment fund is considering cutting off its multi-billion-dollar financial support for Live Golf due to heavy losses and a lack of viewership. The move would mean the end of the breakaway league and its high-stakes rivalry with the PGA Tour. Coming up ahead of the IMF, warning that markets need to be more cautious. More from our interview next. This is Bloomberg.
up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Welcome back to Bloomberg Daybreak Europe. The head of the IMF has warned that markets should be more cautious when it comes to the war in Iran. Kristalina Georgieva has told Bloomberg that central banks should resist the urge to hike rates in response to the crisis, which could damage economic output.
We now have ceasefire. I pray it turns into a durable peace, and in that case, we can see a somewhat faster recovery. But the uncertainty has been profound, and we all need to learn to operate in an environment of high and permanent uncertainty.
But MD, even if there's a ceasefire that stays, okay, and there's some kind of diplomatic resolution, is the market discounting the real impact on the price of oil and therefore inflation?
Well, let me just say that even if the war ends tomorrow, it would take quite some time for the recovery to kick in. Not only because of the infrastructure destruction. Tankers are slow-moving vessels. A tanker that leaves today would take 40 days to reach the Pacific Islands. So we have to keep in mind that the impact is already baked in. Why are markets so optimistic? I think part of the reason is because there is a high concentration of financial assets in the United States. The U.S. economy is doing well. It is relatively not so impacted because the U.S. is an oil exporter, not importer. And that creates that picture of dynamism and vibrancy. But I can tell you that's not the story of the rest of the world. In the rest of the world, already there is a lot of pain.
So, I mean, does that mean that the market is mispricing? That all this market exuberance is actually misplaced?
What it means is that markets are geared by events in the largest economy that are really positive. The United States is the only large economy that has high productivity growth, and markets are seeing that. Technology optimism is here. Markets are rushing on it. But should there be more caution? I would argue yes, because what we are seeing in terms of supply chain disruptions is already quite significant. And with every day that passes, that tanker is not leaving for a destination, and that delays the rebalance of the world economy.
The IMF's Kristalina Georgieva speaking with Bloomberg's Francine Lacroix. Here are other stories that we are monitoring this Thursday morning. Shares of Blue Owl Capital posting their biggest 2-day gain since November of 2022 as risk-on sentiment fueled a rally in stocks, and Wall Street bank chiefs quelled fears, at least for now, about private credit. Blue Owl shares had dropped to a record low on Friday, hammered by fears around the $1.8 trillion private credit market and its exposure, of course, to software. Investors were reassured, though, by US bank executives this week who stressed their exposure to the market was manageable. And Bloomberg has learned that Elon Musk's lieutenants have reached out to chip industry suppliers, including Applied Materials and Tokyo Electron, for his envisioned terafab. Early steps in an audacious and likely arduous attempt to break into the production of cutting-edge chips. We're told staff working for the joint venture between Tesla and SpaceX have sought price quotes and delivery times for an array of chip-making gear, suggesting Musk is pressing ahead with terafab in the face of skepticism from the broader semiconductor industry. And Alphabet's early investment in Elon Musk's SpaceX has positioned the company for a massive windfall. New filings show Google owned just over 6% of Elon Musk's rocket company at the end of last year. At a targeted $2 trillion IPO valuation, that stake would top $100 billion, even after dilution from SpaceX's merger with XAI. The listing would also cement Musk as the world's first trillionaire. Good news then for Google and for Musk himself, of course, if that IPO comes to pass. Let's check back in the markets because it's risk on today on expectations, at hopes at least. These markets continue to look through the close of the Strait of Hormuz and all the sticking points that remain between Iran and the US, and are looking through to a period where there's a prolonged ceasefire. There are negotiations maybe about extending that by 2 weeks. You're seeing oil still, as you see, under $100 a barrel. That is also part of the catalyst. European futures pointing to gains of 0.3%. S&P futures after a fresh record high, pointing up by 0.2%. Got more earnings coming up. Stay with us. This is Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate.
More than what you need to know, it's what you need to think about.
Live from the City of London, this is Bloomberg Daybreak Europe. I'm Tom Mackenzie with your top stories. Global equities hitting all-time highs as investors pile back into stocks on signs that Iran and the US may extend their ceasefire. China's economy expands at its fastest pace in 3 quarters, suggesting limited spillover so far from the war in the Middle East. Plus, AI back in focus as the world's top chipmaker TSMC reports shortly. We will also bring you numbers from French distiller Pernod Ricard. So the earnings story is part of the mix today, but really the driving catalyst are reports that the US and Iran are looking to extend that ceasefire that was expected to end the deadline, April the 22nd. We're hearing from reports that could be extended by 2 weeks. We'll see how that transpires at least. But that, at least for now, is enough to lift these markets. You saw record highs for the S&P 500 yesterday, breaking above 7,000. US futures today looking to build on that, pointing higher by 0.2%. European stocks ended down about 0.4 yesterday, but today the picture is different. A strong session in Asia, and that is the handoff for European futures, currently pointing up by 0.4%. Brent crude currently just below $95 a barrel. It's the comfort level below $100 a barrel within the context, of course, of what we've seen in terms of the run-up of prices. And the focus remains on the Strait of Hormuz and the fact that very little is getting through there. But again, markets, in terms of equity markets, looking through that for now to focus on ceasefire extension expectations. Let's bring you a roundup now of what we're seeing on the front pages of some of the key newspapers, with a focus, of course, on the Financial Times and the Wall Street Journal. We're going to start with the FT this morning then. It opens with President Trump renewing his threat to fire the Fed chair. We've heard this before, he's renewing it now. And the context is he's saying if this doesn't leave, if Jay Powell doesn't leave when his term ends on May 15th. The president is also refusing to drop a criminal probe into Jerome Powell over renovations of the central bank's Washington headquarters. That on the Financial Times. The Wall Street Journal, meanwhile, leading with the headline, "A private equity billionaire mounts his biggest takeover yet, the Pentagon." Stephen Feinberg, the Pentagon's second-in-command and former private equity boss, facing the task of persuading Congress to approve the Trump administration's $1.5 trillion military budget. And over in Spain, El País opening with a headline roughly translating to Iran and the US seeking to resume dialogue amid threats over Hormuz. The Spanish newspaper writing that a delegation from Pakistan is visiting Tehran in its role as the mediating country. That visit, we are reporting, is happening today as well, over the prospect, of course, of a second round of talks. And market expectations, of course, that there will be a second round of talks. That hasn't yet been confirmed. There are talks about the talks. You can get a roundup of the stories you need to know to get your day going in today's edition of Daybreak. Terminal subscribers can go to DayBGo or DAYBGo on the terminal. Let's get back to the earnings story. We talked about the AI catalyst and the demand picture that we're seeing, particularly for those exposed to actually building out the infrastructure and particularly those AI chips. So the focus right now is on TSMC, of course, the main fab based over in Taiwan that actually produces, of course, the chips, not just for AI, but also for the likes of Apple. TSMC's first quarter net income coming in above estimates, 572.5 billion Taiwanese dollars. The estimates had been 542 billion, close to 543 billion. Again, it's a comfortable beat in terms of the estimates in the first quarter, TSMC. The gross margin coming in above the estimates as well, 66.2%. That is the gross margin for TSMC in the first quarter. It's the AI demand story that is front and centre once again for this fab. TSMC's net income then coming in above the estimates. It's a beat. And first quarter capex as well. That's an important number for TSMC, how much they're committing to continued build out as they try to meet that demand. First quarter capex coming in at just over $11 billion US dollars, 11.1 billion US dollars. So a reminder then from these numbers coming through from TSMC that the demand around AI infrastructure and particularly AI chips continues to be strong and continues to propel TSMC. That stock as well has helped to lift the Taiwanese stock market above that in terms of valuation for the UK and for the FTSE as well, for the London Stock Exchange. So that's the broader dynamic as well. So TSMC is in focus for us today. Turning to a very different part of the earnings story, and this is Pernod Ricard, of course, the distiller listed over in France, coming through with top line. Pernod Ricard sees full-year organic net sales contracting 3 to 4%, so minus 3 to 4% as a result of the conflict in the Middle East. Let's get more context right now on the Pernod Ricard numbers and bring in Jennifer Creary, Bloomberg's global business reporter. Jennifer, what stands out to you from these Pernod Ricard numbers?
Yeah, so the headline is really the outlook for the year, so declining as much as 4% for the year. And this is really the first time that Pernod has given very specific guidance for the year. It previously said that it expected sales to improve towards the back end of the year. I mean, but clearly it's citing the conflict in the Middle East as one of the main drivers for that sales slump. And we're expecting other companies in the consumer goods space to reflect that as well. One thing I think is worth noting is that for the third quarter, Pernod did beat analyst expectations. So sales grew 0.1%, and that is in contrast to analysts expecting a fall of just over 1%. So the market could react positively to that. But certainly the headline really is that negative guidance.
Yeah, OK. So the first, to your point, the third quarter coming in healthier than maybe expected, but the guidance of a contraction of 3 to 4%. And again, that ties into the Middle East. So to your point, to what extent is this replicated? To what extent do we hear this from other corporate leaders and other companies as they, of course, digest the impact of the conflict in the Middle East? Maybe this has an impact on Tesco's. That's the UK retailer, of course, the supply chain challenges there, the cost of labour here in the UK, the weak UK economy. What are you going to be looking for when it comes to Tesco's numbers later?
Yeah, Tesco's a very different story, right? It's a supermarket, and we're expecting to see some impact from the Iran conflict on particularly food prices, commodity prices, also fuel as well. So the headline here will be adjusted operating profit for the full year. Now, analysts are putting that at £3.2 billion. So let's see if there is a beat or a miss on that. We are looking for any commentary on expected price rises and whether or not that will be passed on to consumers. One tool, I think, in Tesco's locker is the loyalty scheme and also its price matching scheme with Aldi, the discount supermarket. So potentially that's one way that Tesco can defend its market share. It does have the dominant market share in the UK. But certainly we'll be looking out for commentary from Ken Murphy, the CEO, on whether it'll have an impact on prices from the Iran conflict.
So on the question of prices, central bankers in Washington at the IMF and World Bank meetings have been warning that the markets are getting ahead of their skis, that they're not taking on board the economic impacts longer term of this conflict. So my question, I guess, is around pricing and what you're hearing and what the analysts are saying about whether or not we are going to be seeing higher prices from some of these retailers and whether or not the consumer can absolutely absorb that. During COVID, there was an ability for these companies to kind of preserve their margins to a larger extent than many had expected because the consumer and that cost was passed on. The consumer was in a different place then versus where it is now. What is your understanding of kind of price pressures and how that washes out?
Well, the harder thing to measure is how this will impact consumer sentiment. Now, over the past few years, particularly after COVID, a lot of these retailers have been struggling to bring consumers in, particularly getting them to trade up. And in fact, consumers are trading down, and that's why Tesco has that price matching scheme. A retailer that we can point to is perhaps Next in the UK, the clothing retailer. It said that if the Iran conflict will last more than 3 months, that it expects to accrue about just over £15 million worth of costs.
50, 50?
15.
15, okay, 15.
And also in the UK, the Chancellor of the Exchequer, Rachel Reeves, has been meeting with supermarket bosses, including Tesco, including Ken Murphy, the CEO, to discuss the impact of cost inflation from the Iran war on prices. And so, the UK government is trying to keep prices down because Tesco, of course, impacts consumers around the country. So there is that very conscious effort to keep prices down, but there's only so much that retailers can swallow before they pass on costs.
Jennifer, thank you very much indeed. Breaking down the Pernod Ricard numbers for us and looking ahead to Tesco's as well, but that broader view on the retail space and the consumer and prices. Bloomberg's global business reporter, Jennifer Kruery, thank you. Back to TSMC right now. Let's bring in Bloomberg Asia Equities reporter Charlotte Yang with the context on that story as well. Charlotte, what do you make of these results from TSMC?
Yeah, so looking at the results, the first impression that it is a clean beat. So the world's largest contract chip maker has managed to deliver, again, another quarter of strong earnings growth. So we're looking at 58% of growth in net income, and that is ahead of consensus estimates. Also, for gross profit margin, we're looking at 66.2%, and that's also ahead of what analysts were expecting before of around 64%. So I think with this, the immediate takeaway for investors is that the chip maker hasn't really been seeing a lot of impact from the Middle East war, and also that it has managed to maintain very strong cost control, even with surging raw material cost prices. But with that said, I think what matters more is what the company will say on the overall AI demand they are seeing in the earnings call, especially given ASML's disappointing guidance for the current quarter.
Well, on that point, Charlotte, what will you and the team be scrutinising and investors on that earnings call? Will it all be about how they articulate the AI demand story, or are there other components that are going to be drawing your attention?
Yeah, I think the AI demand is definitely the first and foremost important thing, and that the figures that will matter is what TSMC will provide in terms of their guidance for the sales outlook this year, as well as any capital spending figures, for the coming years to come. So Morgan Stanley is expecting the company to raise its guidance for the sales this year to around mid 30% growth, and also to provide a figure of around $200 billion for the capital spending for the next 3 years. And because of what TSMC sees from all these, big supply customers from Apple to Nvidia, that will be able to provide a catalyst for the broader global AI trade. But besides the AI demand, investors also care a lot about what TSMC sees when it comes to, for example, the demand for consumer electronics, whether higher memory prices may be weighing on those demand, and also back to the impact from the Middle East war. While so far immediately there hasn't been much impact, investors also worry about what kind of delay shock we might see. If you think about the disruptions it has created in terms of from getting raw material and also to logistics, and not to mention that TSMC do acquire a lot of those raw materials that are very essential to chip making, such as helium. So there's a lot of questions a lot of questions on investors' mind about what kind of impact the Middle East war may have on the whole industry in the longer term.
Okay, that earnings call is going to be important. We'll be listening in, of course, as well, and bringing details for our terminal subscribers. Asia Equities reporter Charlotte Yang with the context around the TSMC numbers and looking ahead to the call, of course. Charlotte, thank you. Meanwhile, Bank of America shares closed higher after reporting commodities trading revenue that surged 60% in the first quarter. That, of course, was fueled by wild swings in oil, precious metals, specifically gold. Another major contributor to the trading windfall was the international business, which jumped 23% year on year. Morgan Stanley's stock traders had a record-breaking first quarter, reporting $5.15 billion from equity trading. The firm's wealth business pulled in $118 billion in net new assets, and investment banking fees climbed 36%. Speaking exclusively to Bloomberg, the CEO, Ted Pick, said he wasn't concerned about the firm's small private credit exposure, but added that the sector is going through a learning moment.
When I say adolescence, I mean it's a learning period. It's grown like a weed. And that, as you know, is a function of an asset class that didn't exist 10, 15 years ago. Effectively, the street was replaced on that. It's around $1.7 trillion. High yields at about $1.7 trillion. Levered lending is at about $1.5 trillion, $1.7 trillion. So it's relevant, but the IG stack, as you know, is the investment grade stack is 10 to 15 trillion. It's all credit. It's all credit. So all things being equal, if the economy is growing, credit does fine. It does fine. When there's a recession, credit struggles. And then the question is then, which of the borrowers were really doing the work around what's in underlying portfolios, how quickly was the capital put to work? And I think what we're going to see is we're going to see dispersion of returns among great asset managers who really stuck to their knitting, thought about sector diversification, thought about how long it takes to put those investments to work, and managed to do less well. And over time, I think the alts will find their place as a growing asset class for all kinds of institutional investors.
Okay, from a banking giant on Wall Street to an historic Italian bank right now, Monte Paschi investors backing another term for ousted CEO Luigi Lovaglio, rather than support the bank's slate of board candidates, which sought to install Fabrizio Palermo as the new chief executive. For more, I'm joined by Chiara Albanese, Bloomberg's Italy bureau chief. Chiara, good morning. What does Lovaglio's victory mean then for Monte Paschi, this storied Italian bank?
Good morning. This is a fantastic and stunning corporate turnaround. Lovaglio was seen as being defeated by a new list done by the board. We should remember that the board ousted him and stripped him of all his powers. Nevertheless, he managed to get the backing of sufficient investors to be again the one nominated to be CEO. We are going to see whether this is going to happen today. Already, there is no confirmation yet in terms of like the new name of the CEO.
Does it mark an end to the boardroom drama? Is there more to go? How does this story unfold from here?
That's a great question. It does. I don't think this is the end. Actually, it is the start of a new tumultuous time for the company and the bank. We should remember that both Lovaglio and also his challenger, Palermo, will be on the same board, so the board will be split. So we should expect every decision to be extremely suffered.
Okay, every decision could be fraught going from here, given the makeup of the board. Italy Bureau Chief Chiara Albanese on that story. Thank you for the details, Chiara. Staying and changing tack, in fact, we've been talking about the earnings coming through from TSMC, and that has tied into what's been happening in terms of the broader momentum around Taiwan and lifting the Taiwanese stock exchange. In Taiwan, the island has overtaken the UK now in terms of stock market value. Its market capitalization rising to $4.14 trillion US dollars, making it the world's seventh largest. So just above $4.1 trillion, the seventh largest, so knocking the UK out of that spot. This after the TAIEX index became one of the first major markets to recoup all losses driven by the Iran war to reach a record high. TSMC, we've touched on, also hitting an all-time high as the AI boom boosts strong revenue growth. So that's just one to mark in terms of the history books, and we'll see to what extent that continues. But certainly AI, the TAIEX and the Taiwanese momentum is there. Coming up, the Pope beginning a multi-nation tour of Africa as the pontiff's row with the White House over the Iran war continues. The Pope is in the spotlight, of course, given that fractious relationship now. The details are next. This is Bloomberg.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with another season of The Deal.
With athletes and entrepreneurs who are changing the game on and off the field. Jerry Jones. Some good-looking trophies.
1 and 1 is 3 in sports, not 2. And it's because that 3 is imagination. That 3 is putting yourself in a way, having yourself hit the home run.
Erica Ayers-Badon.
I'm a high-energy board member. I'm very passionate. I have a lot of opinions.
Robin Arzone.
I want to light fires in people's lives, and that is still one of my core mandates for all of my businesses.
Justin Tuck.
I tell all of my friends that play in leagues now, make these relationships now while you're hot. Don't wait till you're like your 12th year in and you're just hanging on.
Stay tuned. You won't want to miss it. Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Sherian in Seoul, and this is Bloomberg.
Welcome back to Bloomberg Daybreak Europe. Now, hours after he was heavily criticised by President Trump and Vice President J.D. Vance for speaking out against the Iran war, the Pope has been backed by African leaders as he begins a three-nation tour of the continent. The president of Cameroon said, quote, "The world needs the message of peace brought by the pontiff." Our chief Africa correspondent, Jennifer Zabasaja, joins us from Johannesburg. Jen, just set out for us, it's a remarkable spat that's taken place between the US president and the Pope. Was it at stake? What is at stake for the White House, for the Republican administration in pushing back and criticising the Pope so strongly?
Exactly, Tom. And we should point out, of course, the first American-born Pope. So that just makes the stakes that much higher, as you were just pointing out there. Look, there could be increased political fallout for President Trump if we do continue to see this public spat growing between the two. And it seems like both are really doubling down on their own words, as it were. Now, if we just take a look at where Catholicism stands, I mean, the Pope really is the leader of 1.4 billion Catholics worldwide. If we take a look at the U.S., the estimates are just over 50 million Americans are considered Catholics, many of whom were very critical to Trump's 2024 win as president. And so this could potentially be political fallout from him from an electorate that was very key for him. And we should point out, this is not the first time that we have seen opposition between the two and the president of the U.S. publicly attacking the Pope. Of course, you're looking at where the Pope has been opposed to war more broadly and military intervention. Earlier this year, he spoke out against his concerns with Venezuelan intervention. And again, we're seeing this really doubling down, and so much so that the Italian prime minister calling the president's comments on the Pope unacceptable. So clearly, this is looking like a continued divisive situation between the two.
And we read out that quote from Cameroon's leader in support of the Pope. Do you expect, Jen, further support from African leaders on this tour for the Pontiff?
It's seeming like so, Tom, and we should just point out earlier in the week we did see the Pope becoming the first Pope to visit a Muslim-majority nation, that was Algeria. He then moved to Cameroon, as you were just speaking about there, talking about his desire to see peace over war, and that really being a hindrance towards development. And a very economically, in a country like Cameroon, which has really seen a hindrance from some of their exports, which are key to economic progress for the Central African nation. The Pope then moves to Equatorial Guinea and Angola, which are key strongholds for Catholicism, but really just another symbolism of what the Vatican sees as a growing Catholic population and a shift for the Vatican to more of the global South, where they do see a doubling down of their own growth and potentially the Pope's own messaging moving forward.
Bloomberg's Jennifer Zabasaja in Johannesburg. Jen, thank you. Now, emerging markets investing pioneer Mark Mobius has died at the age of 89. A partner at Mobius Investments says he passed away in Singapore. Mobius spent over 30 years with Franklin Templeton, championing opportunities in Africa, Asia, Eastern Europe and Latin America. He founded Mobius Capital Partners in 2018 and continued to seek out investing opportunities in recent years, including setting up a new venture in Dubai.
Bringing you up-to-the-minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome back to Bloomberg Daybreak Europe. Happy Thursday, everyone. Let's take a look at what's been happening in terms of the tech stocks returning to value. What we've seen in terms of the Nasdaq 100, then 11 consecutive days of gains for the Nasdaq 100. Yesterday, really interestingly, it was the software stocks that overtook the hardware and the semiconductors. We'll see how long that dynamic plays out. That's a reversal of what we've seen in recent weeks, in fact, in recent months. Mag 7, though, is lagging, and this is what this terminal chart shows. The yellow line is the Bloomberg Mag 7 index. Yes, we've seen that recovery, at least up until this point, but lagging the broader space when it comes to the recovery of the S&P 500 and the Nasdaq as well. S&P 500 is the white line, of course, getting to a fresh record high yesterday. So that's the Mag 7 still playing a bit of catch-up. Let's flip the board and have a look in terms of what's happening on volatility. And volatility has just plummeted as markets again look through the closure of the Straits of Hormuz and start to bet on a more lasting ceasefire between Iran and the US. And this chart just shows where volatility is right now on both of those indexes. We're going to be thinking about the big take today as well. AI continues to be a big part of the story. TSMC's numbers. Anthropic, the race to access and think about the dangers around the Mythos AI model, a big part of our big take. We're going to be discussing that and more. This is Bloomberg.
A cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bringing you up-to-the-minute geopolitical news whenever and wherever it's happening. I'm Anne-Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
Good morning. It's Thursday, April 16th, and this is what is on our minds this morning. Global stocks rally with talk of an extension to the ceasefire. China's economy revs up despite the war. And we hear from Anthropic about its new AI tool, so powerful the company restricted its release.
OK, let's talk about these markets. What started a few days ago as a short covering rally has turned and morphed into this epic chase. Does it continue this morning? At the moment, it looks like it does. Euro Stoxx 50 futures, a little bit of catch-up, but certainly more positive momentum in markets this morning. I was trying to get a handle on what how TSMC is being received this morning. The best I've come up with, Dan came up with, MSCI Taiwan futures up really strongly since those numbers came out. So maybe a positive read despite the fact that TSMC has had an epic rally so far this year. And Brent crude, I'm going to show you Brent crude. Investors don't seem to care anymore as to what is happening with the price of crude. But let me show you anyway. We're down by 0.2%. Seems to be stabilizing at the moment. But the market's looking elsewhere. The countdown to the opening trade starts right now.
Welcome to the programme, everybody. This is the opening trade then, and we have a lot to talk about this Thursday morning. And let's start with the market's narrative around what's going on in the Middle East, but also around the other things that are driving market sentiment right now. So the latest news line out of the Middle East is people familiar talking to Bloomberg saying that there could be an extension of a ceasefire. Does that sound risk on? Does that sound risk off? Certainly doesn't sound as if the Strait of Hormuz is going to be opening up to anything more than a trickle in the near term. But still, we have a global stocks rally underway. And I was thinking about this. Why is the narrative out of Qatar versus the US Treasury so different about the impact of this? I mean, obviously, they have different interests in this. But why does that filter through into something really interesting for stocks? A stock saying that this doesn't matter for the global economy, or a stock saying this does matter, or it might matter, but we've got other things to get more excited about. And all of those things are sort of rubbing up against each other.
The market, it felt like it happened about a week ago. The market feels like it's moved on, doesn't care anymore. Doesn't care maybe is the wrong way of putting it, but has, to your point, other things to think about. This has been a rally that started, it felt like a bit of a short squeeze. Then you got the algos kind of stepping on the gas and the amount of money that's come in. And it's just, this chase has just been extraordinary. Markets usually see these kinds of moves off lows, like off really big lows. This is an equity market that has not gone down by very much and yet has produced this kind of a rally off that. And it just feels, how do you rationalise and make sense of what we're seeing here? Because the move from one side of the boat to the other side of the boat has been so rapid.
So the bull case is that you look through and you look towards an eventual peace between these two sides because both sides are motivated to get there. The bull case is, well, the bull case is also that valuations are looking more attractive. The bull case is that growth earnings expectations are pointing higher. The question is, are those earnings expectations and the growth we're looking at, S&P 500 for the next quarter, looking at growth expectations of 20%, earnings growth expectations, is that factoring in the kind of inflation and growth shock that the likes of the central bank and the IMF chiefs talking about in Washington?
I love what you're saying, because it all sounds kind of fundamentally driven, and we're thinking about this, we're trying to price this in, and we're trying to work out, is this just a positioning story? Is this a market that just, the CTA's got too short, the market was a little bit short, now everybody conditioned by what happened around the tariff story back in April, just wants to get back in, has been itching to get back in, and as a result of which it's just flown back in at a rate that is not commensurate with the reality of the fundamentals that Tom is laying out. It's really hard to judge, but there's so many weird things going on. Did you see Allbirds yesterday?
There's a tech theme, apparently.
Yeah. The memes, so the meme stocks are back. YOLO, FOMO, that's all back now. Yeah. And Allbirds is an example of that, pivoting from making shoes to AI, and the stock popped, I don't know how much percent.
Let's just dive into, break into our conversation, I should say, to talk about UK GDP, because we've just had some data out for the month of February. Just 1 month of data. Would it move the dial? This is before the war, of course, but it is a really strong number, so it is worth mentioning. Remember, the prior number here was 0% growth, so no growth. That was for the January read. The survey here was 0.1%, and we actually got 0.5% of growth in February. I mean, is the market going to look through this, because this is pre-war, would be my question. But it's still worth mentioning.
If you believe the IMF forecasts, it's going to get a lot worse from here. IMF forecasts don't always have the best track record of producing the outcome that actually becomes a reality. Let's talk about China and figure out what is happening there, because this data is extraordinary as well. Q1 GDP growth year on year, 5%.
Yeah.
That's a very strong number. Industrial production, 5.7. That's a very strong number. What's not a very strong number is the retail sales data. And that points to the fact that this is all externally driven. So the good numbers that China is producing now is not driven by a domestic story. So if the rest of the world doesn't hold up, does China hold up? The other thing is that you've got this oil story. We talked to a guest yesterday about this. Nobody knows what the reserve story looks like in China right now. It's very opaque. Can China continue to produce this kind of economic growth if it doesn't have access to cheap energy? Is that going to change?
Yeah, how long is that thread for China in terms of its reserves? It is a more diverse energy mix now in terms of the renewables mix. They're resorting to coal again. They've got plenty of coal in northern China they can tap into with the climate change impacts of that. But they have a more diverse energy mix. But to your point, there is still that dependence to some extent on oil, and to what extent those inventories run dry. This is still, again to your point, this is still a very imbalanced Chinese economy, and this is not a story that's changed in terms of a double-digit contraction for housing and investment. The retail is still looking soft. The consumer's still under pressure. House prices are still contracting. But that export engine is there. And it seems like, according to our own team's analysis, that there may not be additional fiscal stimulus or at least rate cuts coming through from the officials in Beijing, at least at this point, given the numbers we're seeing.
I saw one glimmer of light on the domestic Chinese eco story this morning, and that was, but it doesn't necessarily look like one at first glance. The price declines in the housing market, they've reduced. And so people are asking, are they at the bottom?
Yes.
You know, things have got so bad.
But
they're still going lower, but
rate.
not quite as fast as they were. So have we bottomed out in the housing market? That's all I have to offer on the sort of positive direction. But it's interesting that Xi this week has, the Chinese leadership, really changed the tune. Instead of standing aside from talking about what's going on in Iran, talking about the crumbling world order. And we are heading towards a meeting between Xi and Trump, of course, next month.
And arguably this data puts Xi arguably in a slightly stronger position. The economy of China is holding up, at least on the headline basis. Tech will be part of that conversation between the two leaders, no doubt. Again, we had the numbers through from TSMC suggesting that demand, smartphones is looking soft, but the demand for AI and those AI chips that TSMC crunches out in its foundries in Taiwan is still there. And the capex spent, they expect to spend around $200 billion on capex over the next few years. The margins are around 66% for TSMC. There's no signs that the AI demand, again, it's just another example, that demand picture for AI and the AI infrastructure, and AI chips doesn't seem to be showing any signs of weakening.
I've been trying to work out kind of what the reaction is, because the stock has had an incredible run. And you would have thought, actually, maybe this would be an opportunity to take a bit of profit. Dan and I came up with basically MSCI Taiwanese futures to try and figure out whether there's been a reaction, which I've never done before, but they have ticked quite strongly to the upside. So it looks like at this stage the market reaction to TSMC, because the market's closed, is quite strong.
We'll bookmark that one. It could be useful. We should reflect on the fact that we're going to be speaking to Anthropic. And I do wonder, I was thinking about this over the last 24 hours, whether whilst we've been talking rightly so much about events in the Middle East, maybe we have not talked enough about the latest release, Mythos, from Anthropic, and the extent to which it is being held back, obviously, from release and just given out to a small number of people, to the defenders, to test it, to make sure that it's safe to release, essentially. And we haven't talked much about, but it certainly has got the attention of governments, of regulators, of central bankers, of corporate leaders. This is very quickly getting into the mainstream conversation.
It's so powerful that they have only released it as part of Project Glasswing to a select number of people, as you said. On the day it was released, Scott Besson picked up the phone to CEOs of banks and said, get into the room right now, talk to me about what you're doing to make sure you're filling the gaps and how you're going to be utilising this tool to close those defensibilities in terms of cybersecurity with a model that has cybersecurity risks extreme, but also the potential to close some cybersecurity gaps as well. It's hugely significant, and it's remarkable that it comes down to Anthropic to decide how and when to release this.
Have we reached the point where they're so powerful, they're too scary that we can't release them? And what does that say about the business model? Like, what happens next?
So that is a question we're going to be putting to a senior executive from Anthropic later in the show, next hour.
OK, looking forward to that. What else we got on the show? James Turner, BlackRock EMEA Global Fixed Income Head, is going to be joining us. Karen Georges, EcoFi Investments Fund Manager, joining us as well. We've got some great guests to talk about these markets.
Let's look at what else we are thinking about through today then. 1:30 p.m. UK time. The focus will switch to the labour market in the US with jobless claims. So building out the picture there of a labour market that's been difficult to pin down in terms of whether or not it is seeing significant softness. IMF spring meetings continue. The ECB speakers are on the the docket today. Bundesbank's Nagel and Germany's Vice-Chancellor Klingbeil will be speaking. And later, there's an informal meeting of EU tourism ministers in Cyprus. There's US earnings. This is important. Netflix, of course, coming out later today. PepsiCo and Bank of New York Mellon as well. After a string of banking earnings, we get more later today. Also, Fed speak from Williams and Myron.
Normally, tourism ministers don't interest me, but with the queues building up around Europe, maybe they are. Maybe they will this morning. OK, what else we need to know this Thursday morning? Shares of Blue Owl Capital posting their biggest two-day gain since November 2022 as risk-on sentiment fueled a rally in software stocks and Wall Street bank chiefs created fears around private credit. PIMCO probably helped as well. Blue Owl shares had dropped to a record low Friday, hammered by fears around the $1.8 trillion private credit market and its exposure to software. Investors were reassured by US bank execs this week who stressed their exposure to the market was manageable, their exposure. Bloomberg understands that US investigators are looking into suspicious oil trades ahead of recent policy pivots by President Trump related to the Iran war. On March the 23rd, oil futures worth billions of dollars were traded 15 minutes before Trump said he would delay threatened strikes on Iranian energy infrastructure. A similar pattern was observed ahead of Trump's April the 7th announcement of a two-week ceasefire with Iran. And central bankers have indicated they are in no hurry to raise rates. Sources at the ECB say policymakers are leaning towards holding this month, while the Bank of England's Megan Green told us that relevant data will take a while to come through. A line we also got probably from Bailey as well yesterday, indicating the bank's in no rush. We talked about this yesterday again. The market's already priced out April for the ECB, but June seems to still be a possibility. So are we ruling out rate cuts completely from the ECB or just waiting for more data to show up so we've got a better handle on what is happening here?
Yeah, the ECB narrative, I suppose, as close as you get to being told that rates are not going up in April, it seemed to me. Our reporting was one thing. Even when you got even Isabel Schnabel saying we need to take our time, then you know you're probably not going to get a rate increase, sorry. And Villeroy had said it on the record as well. But the market is still pricing in a couple of hikes. It's interesting that Bailey, yes, was saying the market ran away with itself. I mean, he said that on the day that he last spoke around the Bank of England rate decision. He said the markets have really got ahead of themselves, pricing in all these hikes.
Bank of England speakers have been on that process of trying to walk back some of that expectation that had been built into the markets after their last meeting. We're at 375 right now for BOE rates. The expectation is you get 37 additional basis points by the end of this year. So just over one. Yeah, so that has been that's been walked back.
That was the carried away, I guess.
Yes, that was the carried away moment. 4 25 basis point hikes, which seemed sort of a lot even at the time.
And Bailey referenced that, didn't he? Megan Green saying that the pricing right now seems, for her, I'm paraphrasing, seems about right, is what we got from Megan Green.
With still rate hikes?
Still another hike, yeah. We're fully priced in at least one for the BOE.
We will get to the subject of what's going on in fixed income markets and how that is reflecting the central bank narratives. We will take a look at your stocks to watch as well. Coming up, Pernod Ricard will be in focus, the drinks maker saying it expects the war in the Middle East to hit sales. We'll get some more details on how that's coming to pass. Plus, bankers and businesses weigh the potential impact of Anthropic's new powerful AI model. That's Mythos. We will be joined by Anthropic's Pip White for an exclusive conversation. Up next, we will speak to Bilal Hafiz, Head of Market Strategy at Macro Hive. If you want to get involved in any of these conversations, IB plus BBTV Go is the function to use on the Bloomberg terminal. This is Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin. only on Bloomberg.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg. The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Welcome to Bloomberg This Weekend. I'm David Burrow.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Astonishing day for US technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
This is the opening trade, 7:16 here in London, and this is the picture across European equity market futures. Some brightness factored in at the start of trade. That is our anticipation at this hour. Now, Bloomberg understands the US and Iran are considering a 2-week ceasefire extension to allow for more time to negotiate a peace deal. Mediators are said to be seeking fresh talks to overcome the issues preventing a longer-term agreement, including disruption to the Strait of Hormuz and Iran's nuclear program. Let's bring in Jumana Basechi, of course, who's in Dubai, can take us through the latest news lines here. What do we know then, Jumana, about when we might get people around the negotiating table, about the extension to a ceasefire, because everyone's very focused on what this has to do with the Strait of Hormuz, how quickly it can open up the strait?
Yeah, that's right, Anna. Well, no date has been set. There's no official confirmation yet that these talks are happening. And actually, the White House Press Secretary Caroline Leavitt said yesterday that the U.S. had not put in a formal proposal to extend the ceasefire by 2 weeks. But she did say if another round of talks are going to be held, they would likely be held in Islamabad in Pakistan. And Pakistan, for their part, I will say, are working the diplomatic channels aggressively. The army chief, Saeed Asim Munir, is in Tehran for ceasefire talks, meeting with some of the chief negotiators on the Iranian side. The Iranian state media reporting that the U.S. have relayed a message via the Pakistani mediators to the Iranian side. So we'll see what their response is going to be. At the same time, of note here in the UAE, a very high-level call took place yesterday between the UAE Vice President and the Iranian Speaker of Parliament yesterday. This is the first time they've spoken since the start of the war. So again, significant because it suggests that even as far as UAE is concerned, because they've received the lion's share of all of these incoming attacks, they're willing to start speaking to Iran. And then the Pakistani Prime Minister continues his tour around the region. He was in Saudi Arabia yesterday. He's going to Qatar today. He's going to go to Turkey. And so if there are talks, it will likely be held at some point in the next few days. We're still waiting for confirmation. Remember, the ceasefire technically expires on April 21st, which is April 22nd in the region. One last thing I would point your attention to is the question of Lebanon and whether Iran are going to once again link a Lebanon ceasefire to the success of these upcoming talks.
Jumana, thanks for the update. Appreciate it. Jumana Basechi joining us out of Dubai. Let's turn to the market narrative and what is happening here, because the market appears to have moved on from what is happening in the Gulf and is focusing on other things. Normally, you don't get the kind of rally that we've seen over the last 10, 11 days unless you've hit a kind of major low. The move has been huge. The question is it the right move? Is it just started as a little kind of short covering and then a massive chase? What is going on here? Bilal Hafiz, Head of Market Strategy at Macro Hive, joining us around the table to try and answer that question. do you have a handle on why we have seen this huge rally in equities over the last few days? Is it just a relief rally off what's happening in the Gulf? Is it something else? What's going on?
I think it's more than that. I think one interesting thing we found is that we have an affiliate market, macro markets trading platform now, where we can see clients' activity and so on. And there's been a noticeable shift in terms of the types of activity clients are now doing. And these clients are like top hedge funds around the world. Previously, it was all defensive. Now, the narrative all with them is what's the post-war trade that we should put on. So that there's this shift that's going on now that the base case is it's over, let's look beyond. What are the fundamentals? What's the US equity story like? What's the Fed going to do? All the narratives are turning very, very quickly. So that's the view amongst investors. In terms of the risks, I think one of the concerns many people had was that the US blockade would lead to a breakdown in the ceasefire itself, that somehow there'd be some kind of intervention by the Iranians. It didn't happen. So people are viewing that, okay, that was just posturing ahead of negotiations. So at the moment, the way investors in the market is looking at everything is with a very sort of positive tinge.
Do you think people were conditioned by Independence Day, the whole story around tariffs and what happened in that dip and how quickly it came back? Do you think there is a lasting memory of that event that is now conditioning the response that we are seeing from some of those hedge funds now?
I think absolutely. I think that, and also COVID as well. You know, if you recall with COVID, people talked about all sorts of supply chain issues, and then the rally was really quite rapid, spectacular. And so again, these two sort of parallels people are using. The other point I'd make about COVID is, and this is something we pointed out a few weeks ago, was that with COVID there was the spread of the virus and there was the reopening, and at some point the market decoupled the two, saying okay, the spread is one thing, but the reopening is something separate. So something similar is happening now, where people are saying, okay, we've got visibility now that the Strait could be reopened and there could be some continued military conflict, and so they're kind of decoupling the two from each other.
Okay, yeah, that's a nice, interesting parallel to draw, Bilal. So if the market is trying to move on, and we've talked about that in terms of probably stocks there, and what does that mean for the dollar? Because we saw it flexing its safe haven status at the start of the war, certainly, didn't we, in March, even though many had doubted, does it still have safe haven value? And now we're through that, we're back to a different phase. So what is happening with the dollar right now for you?
Yeah, I think there's been an amazing shift in the behavior of the dollar. Back in March, the dollar would clearly go up sharply whenever there was an escalation of the war. This time, over the last 4 or 5 weeks, even when oil goes up, the dollar doesn't necessarily go up. Often it falls, and then it falls by even more when oil goes down. So there's this shift that's going on with the dollar, and I think that's important, where we've moved from this period where it was like just massive uncertainty in every possible scenario, which really helped the dollar. Now it's more like, okay, there's this scenario, and that's really hurting the dollar. So my view is that this is the return of dollar weakness.
Is that because we're back to thinking about Kevin Walsh? Is that the key driver?
That's kind of part of it as well. One is that the Fed will be more dovish than the Europeans. That's one part of it. Another part of it is that the magic that the US had around tech stocks, that's kind of gone as well to some extent. So when people look at the relative equity story, it's not necessarily as favorable to the US anymore. So again, that hurts the dollar. So the question then is, why would you buy the dollar? It's not the safe, we aren't in a safe haven environment right now, dynamic. And so as a result, why hold the dollar?
If you're not buying the dollar, are you buying the Chinese yuan?
I think so, yeah. For me, that's one of my sort of favourite calls right now, is that dollar-China will head down towards 640 over the course of this year. Because China has done incredibly well. The currency has done incredibly well during the war. Now the war risks are declining. China should do as well going forward. And if you look at flows going into China, the trade flows are very strong, exports are very strong. Today's data showed that, China, although the domestic story is weak, it's still the manufacturing powerhouse of the world. And the world just needs manufactured products right now. Everyone's going to be, demanding different kind of hardware in different ways. And so that really puts China in a very good spot.
Okay, so 640 on dollar yuan is your target. And we think about hardware, we think about what's happening in terms of the tech story, and you're making the case that US tech exceptionalism is no longer there. At a time when we're kind of obsessed, the tech ecosystem is obsessed with Mythos, which is Anthropic, of course, when the NASDAQ 100 is having 11 straight days of consecutive gains. But you think there's more value to be found elsewhere when it comes to the tech story?
Yeah, I think there's kind of two dynamics here. One is that we're at the stage of the US AI story, or the global AI story, where it's kind of eating itself up now. So now AI, as we saw earlier this year, hit SaaS stocks, so it's not uniformly positive. And then also we have to remember we had this massive data center building program, that got announced last year. All of those, a bunch of those data centers come online in the next 3-4 months. So now that's going to be the proof is it in the pudding in terms of the return on investments, and that's when stock valuations may start to get hit by that. Then on top of that, the icing on the cake is that if you look at the performance of European tech stocks, they've outperformed US tech stocks this year, and they've also outperformed Chinese tech stocks as well. So paradoxically, so there's a European tech story that's picking up weirdly. Yeah,
weirdly. So you're not convinced that the data centers are going to cover their costs?
I think they will cover their costs, but the expected returns will be much lower. Yeah.
Okay. So that's two different things.
Yeah.
Because expected returns are up here at the moment.
Yeah. Yeah.
Is it going to be commoditized? Is it going to kind of how much danger is there that if we come? There's a big reckoning coming if we're only covering the cost of capital.
Yeah, absolutely, yeah. So I think the expectations sort of ran ahead of themselves. The one positive thing one could say is that if you look at the more frontier tech models, which are going more towards world models, where you start to collect more data from the physical environment, that will actually require huge data sort of needs. Now, we aren't at that stage yet. That could be a 2027 story. So there is something, further ahead which could sort of show us that there could be that demand. But in the short term, at least, it looks like expectations have run ahead of themselves.
We haven't talked earnings at all, Bilal. That not?
Oh, yeah.
I suppose that is part of the European tech story, though, isn't it? That
Yeah,
it's going to be in the bottom line somewhere.
Exactly, yeah. So the European tech story, I think, the earnings should, although actually some of the recent announcements weren't as strong as we, as expected. But I think in the end, the issue for the European tech side was just valuations just weren't as good as the US side, and now the story's kind of catching up there.
Bilal, thank you very much indeed. As ever, always a pleasure. Bilal Hafiz, Head of Market Strategy at Macro Hive. Coming up, we're going to talk to James Turner, EMEA Head of Global Fixed Income at BlackRock, as ECB policymakers lean towards keeping rates on hold. That is next. This is Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
Reduce the opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
The phone is, what's great about it is it's a well-developed gaming ecosystem, right? So, folks know to find games there, but it's also a highly competitive gaming ecosystem. So its developedness gives you both that upside and that downside. But what's exciting is that now we are moving beyond the phone to the TV. So I mentioned one of the big gaming areas we're going after. One of the big gaming areas we're going after now is social gaming experiences that will show up on your TV. So we are now announcing, we're going to announce here actually, that we're going to have these social party games that you can play on your TV with your phone as the controller. And it's things like, recognizable games like Boggle, you got Pictionary, we've got a Lego party game. We, basically are going to unleash this with a bunch of creators, and they're going to go figure out stuff that we didn't even imagine that they can do with that interactivity.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. and rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Welcome back. 30 minutes to go until the start of cash equity trading here in Europe. The futures picture, though, looks like this. Still very positive. We're still on. The rally is still on. Take a look at NASDAQ futures, up by 0.5% this morning. So the rally, the momentum is still there right now. European bourses are generally higher as well. It'd be interesting to see what kind of TSMC effect you see into the market this morning. Certainly the AEX is significantly outperforming this morning. It is up by 0.7% on the futures versus the FTSE 100, with oil prices doing nothing, which is absolutely flat as a pancake right now, if a little negative.
Yeah, absolutely. And the Nikkei closing at a record high, raising its Iran war losses. So joining the S&P, the NASDAQ, the Taiwan Exchange, the Singapore Exchange, the CSI 300. Have I missed any? Not sure. But there were lots of exchanges, lots of markets that have already recouped their losses from the start of the war. Let's have a quick look at where we are on bond markets, though, because that's an interesting dynamic to watch as well. PIMCO says they see opportunity in European bond markets. They're probably not alone, given the volatility we've seen. And we are seeing buying today. And that seems to be the narrative. We're down by around 2-3 basis points on European bond markets right now at the 10-year horizon. The ECB Governing Council member Joachim Nagel says that the global economic outlook hinges on whether the current 2-week Middle East ceasefire holds and reopens the world's most important oil artery.
This has to be resolved. And I believe this is ongoing, this uncertainty. And this will trigger also uncertainty regarding oil prices. Everything what is going around in the world is dependent on that question. This is a bottleneck. And so I believe 2 weeks can bring a lot of new information, and we will take that into account.
Nagel speaking to Bloomberg on the sidelines of the IMF spring meeting. Let's bring in James Turner, EMEA head of global fixed income over at BlackRock. James, very nice to have you with us. So we see yields coming down today. We see PIMCO talking about buying European bonds. We see the ECB signalling it's kind of on hold for now. What kind of opportunity do you see in the European bond space?
We've seen some wild swings, clearly, in pricing, both in Europe and the US on the back of this. And I think that immediately people, I suppose, look to the 2022 playbook and inflation as the issue. But I think we have to remember that it's very much a supply-side shock. It's not really demand-led, quite different to 22, where actually we had quite a lot of pent-up demand, I think, and we're reopening from COVID. We couldn't get hold of cars. Very different in terms of its pricing environment. So first of all, I think the inflation impact might be a little bit more muted, but also I think we have to have a look at the growth element of it as well. And I think often that was a little bit neglected in the first stages of this. So actually, from the point of view of rate rises, I would lean a little bit towards the more dovish end of that in terms of expectations going forward, which creates opportunities when you've seen the yields go up. I think that creates opportunities for us. I don't think, for example, we're going to see 3 rate rises from the ECB this year. I'm not even sure we'll see 2. So I think that provides an opportunity there in terms of that extra yield and income we can get.
OK, and so what are you watching? What's the difference between 1 and 3 rate rises at the ECB? Because we talk to people from the East, from European central banks, but also other guests who tell us, you know, a spike in oil prices is not enough. It needs to be seen to be filtering through into other parts of the economy.
Yeah, and I think that's right. And I don't think we've seen evidence of that. And I think quite rightly people are taking a sort of wait-and-see approach. And really also the effect it actually has on the economy in terms of, I don't think we're going to see necessarily, we've seen credit spreads behave extremely well from the point of view of this. We've seen things, spreads come back to really where they were before, and in some cases actually even tighter. And I think that market is actually being able to look through things. And I don't think when we get to the end of 26, we'll actually think this is even the biggest issue for credit. It's really going to have been, I still think we're going to revert and we're going to look through this and we're going to find out that actually it was still the AI themes and that are bigger themes for this year.
Does it suggest you're more worried about growth versus inflation, particularly how that reads across to the bond markets?
I think we have to be more concerned about that actually, because this is, assuming that we're on a de-escalatory path, which I think actually we are, I'm sure we'll see some bumps in the road, but I actually think we're on a de-escalation path now, and it seems as though every side is willing to go down that route. Then at some point we will see the strait reopened, and at some point I think we'll view this as a temporary shock. So then we have to, I think, look through to the growth aspect of it and take that into account. And I think quite rightly central bankers are taking a sort of a much more wait-and-see approach than actually the market was, and that's the sensible approach to take. And it could be that we actually don't ever see the need to rate rises, because in some ways the talk that they have is actually doing the job for them in many ways as well.
What's looking most mispriced then in terms of the bond markets and where you want to be sitting on the curve?
I think it's that 2 to 5 year range where we see the most opportunity. We still are not so keen on very long duration because the term premiums are a much more important aspect, but actually in this shorter dated 2 to 5 belly of the curve, I think there's an opportunity there to get those higher yields, higher income, which is what everyone wants at the moment.
Do you think consumer expectations of inflation have become de-anchored? Because that's got to be the big fear now, isn't it? We go through inflation shock after inflation shock, and central banks they just keep looking through it. Like, what's to worry about?
I think they're very aware of what happened in 22, and arguably they're a little. We looked through it a little bit too much, and inflation was regarded as transitory. But again, I think we are in a very different environment where we don't have stronger growth, we don't have such strong employment numbers. If we recall back then, we couldn't get hold of a car for 6 months. Second-hand car prices were raising very quickly, and the hospitality industry was short of staff. I think we're in a very different environment now, whereas actually I think there's much less chance of that inflation, especially if we do see a resolution of this conflict quite shortly. We'll see that actually those expectations never filter into the longer economy. The other thing is when we had 22, we had gas closed off for a much longer period of time, and clearly it wasn't going to come back.
If governments decide to protect consumers, would that change that argument?
I think that's one of the concerns as well, but so far the government policies have been very well targeted, not wholesale. I think that would change the argument a little bit, but having said that, we see fairly limited actions to help consumers from the government point of view.
Yeah, sorry, you finished that. Yes, that's certainly something that markets are alert to, isn't it? I wanted to ask you, James, about the IMF. Yesterday, warning that treasuries were in danger of eroding their safety premium and suggesting that actually, so we're looking at low corporate bond spreads and going so far as to say that these low corporate bond spreads that we're seeing in the United States, they are a gauge of the vulnerability of treasuries rather than the safety of corporates. I mean, how do you look at the tight spreads that we have in the corporate landscape in the United States?
I think we need to look at the lens, and when we look at corporate spreads generally, I think we need to look through the lens of the fact that actually corporates have entered this period. I think partly because of some of this volatility we've experienced over the last few years, they've actually adopted quite a cautious approach to their balance sheets. So in most cases, they're in very good health. They've refinanced when they need, they've long-termed out their debt. Generally, margins have held up and they've been in quite a healthy state. And I think that's why corporate spreads and indeed high-yield spreads overall, I think it's highly unlikely we'll see from this a wave of downgrades because of the Iran crisis or conflict. I think, similarly, I don't think we'll see a wave of defaults in the high-yield market. So actually, it's fair that spreads have not really reflected any of that and they've come back to normal. And I actually, although having said that, below the hood on this, I think we've actually got a lot of dispersion as well. And so AI is still going to be the biggest theme, I think, between the winners and losers, and we're going to see some segments do well, we're going to see some segments do poorly, and I think that's why it's such a time for this credit selection and where really most bond managers are going to generate alpha from that credit selection rather than beta.
Is it the right time to think, though, given the amount of issuance we're seeing from the Treasury in the United States? I mean, governments in developed markets generally, but including in at the Treasury, is it right to rethink what spreads tell us, I suppose, about safety and security?
I mean, I think the default expectation, if we're looking at it as a risk premium versus governments, that there's an argument that governments are not as safe as they once were, and we can see that in some of the term premiums. So perhaps that actually pushes people. I think, again, it's been a theme of ours for actually the last years that actually, in some ways, corporate spreads offer you a better way of getting extra return than it does pushing out your duration and taking long-term bets on government bonds. And so we'd rather take that corporate risk for exactly the reasons you're saying. I think that corporates are actually been, as we've seen government debt rise, corporate debt has actually come down in aggregate, and that makes it a more attractive environment or a more attractive source of income.
Private credit, is that behind us now as a risk factor? Is any contagion into public credit?
I think the reality is there wasn't really much risk of contagion. I don't think necessarily the issues with private credit are necessarily behind it, but having said that, do I think it's a systemic risk to the public credit markets? I don't think so. It's an important area, but it's not so large that it's going to disrupt the public credit markets. The other thing is that should, for whatever reason, the private debt markets not necessarily be so willing or able to finance leverage buyouts, we have the high yield market and leverage loan markets fully open, fully able to finance, and they operate really as three markets that are available as a choice for private equity sponsors.
How do you think the market would react if President Trump tried to fire Jay Powell?
I mean, really, that's in the, I suppose, in the line of hypothetical and stuff. I think we see a lot of things that are mentioned in the press, but really not something
But if you see turbulence around, at the moment there is a probability that Walsh does not get the gig anytime soon because of what is happening on the Senate Finance Committee. What happens if he doesn't get the green lights until the midterms and we end up in this kind of hiatus period? President Trump's expecting rates to go lower. Is there any risk priced in right now around concerns around the Fed? I guess is the real question that I'm asking.
I don't think it's a possibility that the market necessarily looks at the moment, or something that we necessarily consider. I don't think it's necessarily priced in, because I think that actually the course of I don't think there's any real possibility that that's going to happen.
Okay.
It does suggest that maybe the markets could be wrong-footed if Trump follows through with these threats that he's come through time and time and time again. He said he's not dropping that DOJ probe, which goes to your point. Till is sitting on the committee, has said that is central to him. He needs to see that DOJ probe before he approves Kevin Walsh.
It is a massive tail risk in terms of it's far out. It's kind of all the way over on the left. But I guess it's one of those events that if it were to happen, it would have an extreme consequence. So it is an unlikely but highly impactful event that is really hard to price and deal with. Anyway, nice to see you. Thanks for coming to see us and dealing with that question. James Turner, EMEA Head of Global Fixed Income, joining us from BlackRock. OK, Qatar is warning that this worsening crisis in Hormuz will be a problem if it stays closed.
It goes way beyond the Gulf countries, even to the whole world. And what we have seen so far is really the tip of the iceberg, in terms of impact. Yet the full-fledged impact is coming, and it's not coming far away. I think in 1 month, 2 months' time, you're going to see really a huge, economical impact globally as a result of this war.
That was the Qatari Finance Minister speaking at the IMF Spring meeting. This is Bloomberg.
Everybody has a moment where they put into action all they've practiced, where they step up to a challenge and either succeed or fail. But what are those moments for some of the world's most influential leaders?
It was a rough and tumble world, and I thought, okay, I can rise up, I can play this game, and I did play the game.
It was great, and it was depressing, and it was disappointing.
My chair at the time sat down with me and said, succession starts now.
I'm Francine Lacroix, an award-winning journalist. For the last 25 years, I've interviewed world leaders, bank bosses, even fashion icons. I'm often asking about the news of the moment. But I've always been curious, who are these people as leaders? Join me for the podcast version of Leaders with Francine Lacroix. I'll start your week with conversations that explore what drives the world's most influential people, how today's leaders got to where they are, where they're going next, and how they've transformed their organization in the process.
Make decisions. A poor decision is always better than no decision.
You have to have truth tellers around you, and you have to be willing to listen.
You don't want to be setting strategy in the middle of a transaction, that's for sure.
Do it for the right reasons. Don't do it because of FOMO.
We'll also learn lessons which we can apply to our work and daily lives. Tune into the podcast version of Leaders with Francine Lacroix. Listen and watch on Bloomberg Television or wherever you get your podcasts.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Earnings season is here.
Certainly valuations have shifted quite significantly.
Maybe a bit of optimism.
Bloomberg is first to break the numbers.
We're talking about a move away from U.S. assets.
So much corporate issuance.
Let's get the reaction and context.
With the smartest insights.
We're observing what's happening in the Middle East.
The situation is volatile.
We're closely monitoring the impacts on supply chain and logistics.
Cross-border M&A, still such a difficult thing to get done in Europe.
Continuing coverage on Bloomberg.
Even if the war ends tomorrow, it would take quite some time for the recovery to kick in. Not only because of the infrastructure destruction. Tankers are slow-moving vessels. A tanker that leaves today would take 40 days to reach the Pacific Islands. So we have to keep in mind that the impact is already baked in.
The IMF's Managing Director, of course, Kristalina Georgieva, speaking to Bloomberg in Washington. Let us turn now to today's markets in 3 minutes on the opening trade with Adam Linton from the Markets Live team. Adam, let's start with stocks, because seemingly all over the world, not in Europe, which is perhaps notable, we seem to be going back to levels in stocks that we were at before the war started. Stocks really trying another day where we're trying to move on. I've been looking at the latest news lines, an extension of the ceasefire for 2 weeks, possibly. That's what people familiar are telling Bloomberg. Does that sound risk on, or is it risk off because the Strait of Hormuz stays closed for longer? I'm still scratching my head about that one.
Yeah, it's interesting. I think there is a large part of this which does feel like the market has moved on to some extent from the war. We saw that to some extent on display yesterday. So we saw some relatively negative headlines about troop movements in the US, some threats from Iran, and the market was relatively unfazed by this. So the market is still continuing to run with the optimism. I think as Mark was on your show saying yesterday, there may be a potential economic reckoning whereby the economic impact becomes apparent, and that could become a factor for equities. But in the interim, we do have this kind of almost void, and it does appear that the AI trade and tech is filling that void. US tech is up about 13% month to date. We've just seen TSMC earnings, which are very positive. That's also helping prop things up, and that's kind of helping some indices to kind of reach pre-conflict levels and go beyond. As you say, things may become a little bit more regionally selective, and as you say, Europe is an interesting one on that front. Economic exposure doesn't have this big tech sector, and what we have seen from the tech sector, ASML, they were marked down yesterday despite good earnings, and then the earnings we have seen, okay, some of it may be idiosyncratic to the luxury sector, like sort of Kering and Hermes, but ultimately there is a high bar for European earnings to impress.
Are bond markets listening to central banks telling them they're wrong?
Well, there was the Bailey comment about them being wrong, and that was, I think, when markets are pricing about 100 basis points of hikes, and we have come down since. I think with bonds, more generally, they're going to be a lot more cautious in pricing out the impacts of the conflict. And we saw that on display yesterday. Bailey said the length of the war will be important, and that reminds us there is still the conflicts going on. ECB, they're going to look like they're going to hold in April. They feel like financing conditions are doing some of the heavy lifting. So we've kind of gone gone back to 2 rate hikes price for the ECB, a little bit less for the BOE. I think we'll probably kind of stay there for a little bit until we get more clarity on the impact of the war, and that'll probably see that gains in short-term bonds are probably less pronounced than what we've seen in the equity market.
If the equity market is looking through this current conflict towards a ceasefire and a resolution, does that mean you get a further unwind of the hedging around the dollar?
It does feel like the dollar downside does have some more room to run, definitely. But I think, in terms of calls for the likes of euro dollar at 120 seem a little bit stretched. Either the ECB doesn't hike, we unwind some of that. Either the growth implications, if they do hike, come into view. I think you say a similar thing for the pound. And if you look at the yen, BOJ is caught between growth and inflation. If the BOJ don't really hike, then if you're a yen bull, that's obviously a problem.
Adam, thank you very much indeed. Adam Linton from our Markets Live team, of course, with some analysis across different asset classes, with equities pointing higher again today. Remember, you can get up-to-date analysis and insight, of course, from Adam and the rest of the team. Just go to MLive Go on your Bloomberg terminal. Let's hit your stocks to watch for this Thursday and bring in Chloe Melly. Chloe.
Good morning, Tom. Let's start with Pernod Ricard this morning because it issued quite a gloomy outlook, and that is because, of course, of the war in the Middle East. So it expects the Iran war to drive down sales by as much as 4% this year, and that's actually compared to a previous expectation that sales would pick up in the second half. So walking back some of that previous outlook, and essentially the added uncertainty from the conflict is compounding existing challenges for the company, including lower alcohol consumption globally, but also lower demand for premium brands. And so we have seen Pernod Ricard already underperform its closest peer, Rémy Cointreau, for a while now. And so this weakness could continue today on the back of this outlook. Moving on to Tesco, which is also being quite cautious because of the same reason. So the operating profit actually beat estimates for this year. But then for the year ahead, the guidance is quite conservative because of the impact of those higher energy costs on household budgets. And so this is something that we'll be thinking about this morning, even though Tesco has been doing very well. Its strategy is really one of maintaining lower prices to try and retain that market share, and is probably going to have to continue doing that. And finally, Flutter is also in focus today after the gambling company was double downgraded by Citi analysts, with analysts saying that there was now lower conviction in the growth prospects for the company in the US, and also that there was the problem of higher regulatory scrutiny. And so that could put additional pressure on those shares, which, as we can see, have been taking quite the beating recently. But it is worth noting that it's the only sell that we've got on that stock, and there's 27 buys. So there is still some confidence in Flutter.
OK, thanks very much, Chloe. Chloe Melly with the latest on those stocks in focus. Still some minutes away from the start of the European trading day. We just wanted to correct something earlier from our programming. In Daybreak Europe, we mistakenly showed images of Blue Owl during a story about the US probing suspicious oil trades. We want to make clear, of course, that they are in no way related to that story, and the images should have been shown for a different story. We apologise for the error and for any confusion caused. Thinking about confusion takes me to the GDP story out of the UK, because it's completely irrelevant, really, what happened in February as far as what happens in March is concerned, because there's been a war. But I'm still amazed that the economist community could have so underscored the UK, I suppose, on growth for that one particular month. 0.5%, I mean, it's nothing to write home about in certain nations, but that's quite a big deal for the UK, and the market was expecting 0.1%. It seems the services sector actually did pretty well. It won't matter to gilts, probably.
Probably won't matter to the gilts, probably won't matter to the Bank of England, but it just shows the challenges of trying to understand the UK economy right now. There's a huge data issue. Trying to just get a handle on what is happening here remains really problematic.
It's so opaque.
And I think that's just showing up in the volatility that we're getting in rubbish in, rubbish out. If you don't have good data going in to the model, you're not going to get a particularly good read on the way out. So we're just getting some real kind of variation in terms of expectations.
The gilt markets may move on the comments from Andrew Bailey. There's been a little bit of repricing around that, still expecting one additional hike later this year. It's interesting, James from BlackRock saying he actually doesn't think there's going to be, he thinks the BOE could end up cutting. He thinks that could change. It could be cut actually later this year.
Across Europe, he's much more focused on the growth story, isn't he?
Yes.
Which seems to be where the market's thinking is right now, if that's what we're seeing happening in bond markets at this point, because we had been very preoccupied with inflation. Maybe we're starting to think more about growth.
The message from the ECB officials seems to be, though, that we're still thinking about hikes. There's still kind of one, maybe two on the table, and that's kind of what the market is now seeming to price. But basically the message is, though, we need more information. We don't know yet what's going to happen here. are they going to be willing to look through? It seems they're going to be less willing to look through than other central banks.
On the stock side, are we going to see TSMC have an impact on what's going on in here in Europe? You've been trying hard to find, live prices that are moving on this.
The read across obviously would be to ASML, so we'll see if there's...
Yeah.
Which we heard from yesterday, which complicates it, doesn't it?
Yeah, but ASML was already up. So I'm struggling with kind of cause and effect here in terms of understanding what's happening with these markets. But futures look broadly positive at the moment. We're a couple of minutes away from the opening trade. That's the picture right now. The FTSE's a little bit of a laggard. Anyway, we'll show you more data in just a moment. We'll get real pricing and figure out what's happening on cash in just a second.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning. This is
Welcome back to the opening trade.
Watch Bloomberg 10.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television. Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Join me each week on Wall Street Week for stories of capitalism from business, markets, economics, tech, and climate. More than what you need to know, it's what you need to think about.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Welcome back. A couple of minutes to go until cash trading here in Europe. This was the picture yesterday over in the United States. Just look at this chart. It tells a very, very positive picture. Stocks are on a tear. Huge tear right now. You don't see moves like this, of this kind of length. The Nasdaq's been up, 11 days. It's a huge move. Why, I think, is a different question. We can debate that ad infinitum. But if you look below the surface, actually there are other things going on. The RSI has gone from kind of all the way over there to all the way over there. We're north of 70. It looks very extended, particularly for the Nasdaq. You look at breadth, it's not particularly good. But just focus on this. It basically goes from left to right, on the up, looking pretty good. And we've got to price some of that into Europe this morning, Tom.
Yeah, a solid session in Asia as well, so the handoff is there for Europe. Futures here pointing to gains of 0.3%, looking to add 20 points across the benchmark. When it comes to the UK, FTSE 100 pointing lower by 10 points, just a little softer by 0.1%. We continue, of course, to watch the oil price story, currently below $100 a barrel. DAX futures pointing to a pretty decent session as well, pointing higher by 0.3%, looking to add 69 points for the German futures. Anna, what are the individual names that you're looking at?
Yeah, we've got a few of those this morning, and a sector to watch, that's technology. We'll watch that because we had those TSMC numbers earlier on, lifting their sales growth outlook to more than 30% this year. AI leading the growth story there as smartphones, of course, that segment is waning a little. We'll also watch Pernod Ricard in the drink space. They're expecting disruption from the war in the Middle East. They say that that will contribute to a slump in annual sales of as much as 4% due to volatility and uncertainty. Also citing the war and the clouding of the outlook as a result is Tesco in the grocery sector in the UK. Their full-year adjusted operating profit came in above expectations, but it's the forward-looking stuff that everyone seems to be focused on this morning, Guy.
Absolutely. OK, here we go. Market open is upon us. Looks like the FTSE's going to underperform. The AEX may outperform. Let's show you some numbers, give you an idea of what is happening here, and talk a little what we are getting. So the FTSE 100 not expected to do much here. All prices have stabilised, and as a result of which you're not getting the lift we've seen over the last few days. Plus also maybe there's a bit of pound strength coming through. Anyway, FTSE 100, as expected, a little soft. Stock 600 not telling us much yet. I want to see what happens with the AEX this morning. I want to see what happens with the ASML. Is the ASML tied to TSMC, or is it just an echo of what we saw in yesterday's session over in the United States? The CAC had a terrible day yesterday. Luxury had a terrible day yesterday. Today we are stabilising a little bit. There you go. Some outperformance from the Amsterdam market. Clearly nothing's happening in Germany. It's up by 0.2%, but a little bit of outperformance. Let's see how much we get out of ASML this morning, out of that tech story that we continue to see driven higher in the United States and in Asia. Now here in Europe, the AEX is up by 0.4%. The stock 600 is up by 0.2%. So a little bit of outperformance, Tom, coming through
in
from
answer
that
to your question, that read across is there, up 2.8% right now for ASML. So given the weighting, of course, for ASML, and as Guy was saying, lifting the broader AEX index over in the Netherlands, lifting the tech sector to the top performing sector across the European space right now. So tech up 1.5%. Basic resources, you're seeing gains for the likes of copper, gold and silver in the session today. Basic resources is the second best performing sector, at least for now. Gains of 1.2%. On the downside then, on a risk-on day, travel and leisure is down 0.9%. Telecoms a little softer by 0.4% as well. You've got about, what, 7 indexes in negative, 7 sectors in negative territory. The majority are still in the green. Technology leading, followed by basic resources. Tech up 1.4%.
Yeah, absolutely. So the ASML story does stand out, and that's probably reaction to TSMC. It's probably also because it was sold off a lot yesterday on its own numbers. Interesting that the Tesco story also moving to the upside. So grocery stores is one of the sectors that's not doing too badly this morning, and Tesco's up by 1.5%. So there was the earnings story, but also the outlook, talking about that being clouded by things in the Middle East. Pernod Ricard not doing quite so well on the back of its numbers, though. That particular stock is down by 1.1%. Food, beverage and tobacco is an area that's underperforming this morning. Pernod Ricard is down, and that's taking some of the other drinks makers down with it as well. But the balance of sectors is to the upside as we stage a bit of a rebound from the selling of yesterday.
10 stocks XD, so just bear that in mind. Some of the airlines are under a bit of pressure this morning. Ryanair's down a little bit, but the oil stocks certainly are under quite a lot of pressure. That's what we're seeing.
Yeah, absolutely. We've been reading and talking a lot about jet fuel, haven't we? We'll keep that in mind. Let's get to some market analysis. Karen Georges joins us, portfolio manager over at EcoFi Investments. Karen, nice to have you on the programme. Thanks for joining us. Do you think that the stock markets globally are kind of taking a lot on trust right now? They're wanting to move ahead, wanting to move back to other themes such as AI, and concluding that they've heard enough about the Strait of Hormuz, they've got conviction that it will at some point be reopened and therefore can move on?
But there's a kind of FOMO in the market. That's definitely true. That's why the market is up today. The hope of a prolonged ceasefire, and also eventually the meeting of Trump in China. So there is a lot of FOMO in the market, and also expectations of solid earnings, especially in the US. And obviously investors are waiting for comments on the impact of the Middle East before taking a very clear direction. That's why there is a a kind of floor, very short term, on equity markets, and that we have almost erased all of March's downturn, contrary to oil that has erased half of the increase.
I was reading a note from a fixed income manager that was talking about a lot of dry powder and a lot of people sitting on the sidelines waiting to see how this plays out. Doesn't maybe look that way from where we are on global equity stories, Karen, but what are you seeing? Are you seeing investors having pulled back and waiting, or happy to jump back in on these AI themes?
Well, positioning is still very high. Really retreated their equity exposure. Some hedge funds have put shorts in place, and they have obviously removed them very quickly when there was the announcement of the ceasefire. But there is a clear mismatch between bond investors and equity investors. I mean, I'm talking really about yields and not about credit. There is this mismatch, and the AI narrative will be really dispatched into two clear narratives. So the AI enablers and obviously this disruption. So the market is waiting for more information on how AI can disrupt. Every news flow on Anthropic or other themes like that can have a very big effect. The software and IT services is already down around 25% year to date. So that will be a clear issue, obviously, with the impact of the Middle East for the earnings season.
Karen, are you feeling the FOMO? Would you chase the rally from here? How are you feeling about what you've seen thus far and what comes next?
Well, from an index perspective, it's really hard to chase the rally when we're at 17 times for the Eurozone, 25 times for the S&P. But this market, contrary to last year and the year before last, has much more divergence between stocks. So there is less concentration for active equity managers. So this is what investors need to chase. It's stock ideas and not passive investment into the index or other kinds of sectors. Okay. It's really a market of stock picking.
What's still under-owned then?
Probably defensive stocks, because a lot of defensive names have even become value stocks, which is very odd because historically they've been growth stocks, for example, consumer stocks. But it's really hard to chase those stocks today, given the fact that there's going to be an impact of oil on COGS for most of these stocks. So it's hard to chase those names. But defensive stocks have had a very big lag against cyclicals recently. So short term, maybe there's an idea to go and find value there. And on cyclicals, it's really important to be positioned on those who have very solid end markets. For example, electrification, renewables, so themes that have very strong growth drivers today. And so it's that positioning, so the end markets, that is key, more than the style, more than value against growth or cyclicals against defensives. It's really the end markets that count.
Karen, on earnings, are the earnings growth expectations underpricing the supply chain impacts from the Middle East?
Today, earnings are probably mismatching that impact because they have not been revised down. They have even been revised up for the S&P. So there is a clear risk of disappointment on that front. The thing that can balance that disappointment is the fact that at the beginning of the year, we had very cautious guidance. So even the luxury names that you mentioned before, they had cautious guidance in January. That's why the reaction was not that harsh on LVMH, because they already were cautious before the war. But there is clearly lack of information for most companies on what the impact will be, oil and other commodities, on their COGS. Companies are already saying that they cannot put price increases like they did in 2022 because the inflationary context is not the same. So it will be harder for them to be able to pass a price increase for a lot of companies.
You touched on tech and on AI, and at least in the session yesterday, you saw this reversal of a trend that we've seen, which is that software stocks actually outperformed the chip stocks yesterday. Are you finding any value in software and in the IT space, given the sell-off that we've seen?
There is a clear value, so I'm going to be very affirmative, on this point, because of passive investment, and there have been baskets and ETFs on AI risk names, so everything is being thrown out in a very harsh way. But there are clear winners in that space. Companies that are not disrupted by AI, and AI will be a key growth driver for them, especially software companies that are on critical markets such as infrastructure, construction, for example, also on defense, on auto, airlines, etc. So it's not everything is the same. Some companies have true competitive threats, but others will be able to outgrow expectations and to prove that AI is not a disruption risk for them. So there will be clear differences between those stocks in that area, and we are positive on some of those stocks here at Equifax.
Karen, let me ask you about I was going to say the aviation sector, but I'm just going to quote what we've heard from EasyJet this morning and ask a broader question about what visibility we have here. EasyJet basically giving some guidance about how much they're impacted by the war in the Middle East. They're saying that the booking curve has shortened as expected, resulting in lower than normal forward visibility. And I wonder how much you're thinking about that, the really reduced visibility from certain corporates, and yet stock markets that seem to want to find the positive often. How much are you thinking about these pockets of weakness that maybe are not fully priced in yet?
I totally agree. So you mentioned before I came on air that the real issue now is probably growth more than inflation. People have been focused on inflation since the beginning of March, but the area of worry is more on growth. And as you said, demand will probably take a hit because of the situation, and very few companies have spoken about this. So EasyJet obviously is a loser airline companies of the situation today. As I mentioned about price increases, a company like Procter & Gamble mentioned that they cannot pass on price increases. They can only reduce promotional activity. So you have a double problem. You have a lower demand, so lower volumes, and you don't have the capacity to increase prices. So there will be probably a squeeze on margins for many companies, and there is an issue on volume, and as you said, also reduced visibility. So for even B2B stocks, so industrial companies, there is also a risk on backlog, so on orders for the next quarter. So this is going to be an issue not only for airline companies, but for many stocks. We are also, we share that worry on demand, on volumes, and the market is still a bit of complacent because of that FOMO theme that I mentioned earlier, the fear of missing out if there are good news on Iran, on the Hormuz issue. So this is going to be a driver very short term, but earnings will differentiate stocks, and we will have a very strong divergence.
Okay, so that's the margin erosion story. Where are you finding, Karen, margin resilience in this environment?
Margin resilience is, for example, companies that also have clause indexes in their contracts. So, for example, some utilities or industrial companies, when for example, the copper price is up, they can increase prices, so they have protection on that front. And obviously, companies have strong pricing power. They have a leadership in a very tight market. So when I mentioned electrification, some cable companies have a very strong pricing power. Some industrial companies also have pricing power, given the strong demand. I was talking about electrification, for example, electricity, which is now 25% of energy demand in Europe, will reach 50% in 2050. So there is a clear growth increase for that theme, and so those companies, for example, have strong pricing power, and obviously other companies in tech, in the tech area, can have pricing power when they have leadership. So those companies will have that protection, and obviously those who are not sensitive to oil and derivatives on their costs.
Karen, great to catch up. Really useful insight as to what is happening here. Karen Georges, portfolio manager over at Equifax Investments. Let's talk a little bit about what's happening, big picture with these markets right now. ASML is, as you can see, up quite nicely. Is that a reaction to TSMC or just yesterday's move over in the United States? Defence stocks are down a little bit. Defensive stocks are also down a little bit. LVMH bouncing back just a touch. The chip story is absolutely front and centre, though, for global markets right now. Let's get some more details as to what is happening there with Chloe.
Good morning. Indeed, we are seeing green across the screen for that chip sector after TSMC raised its revenue outlook. And so this really shows the resilience of this AI chip demand despite the macroeconomic impact of the war in the Middle East. And so this is driving those stocks higher across that chip sector this morning, with ASML in particular benefiting. On the other hand, Pernod Ricard is not doing so well this morning. It has warned about the impact of the war in Iran on those sales for this year, despite the fact that it had said earlier this year that sales would actually improve in the second half. And so we are seeing that driving down the stock this morning. It's really compounding existing challenges around lower alcohol consumption and lower demand for premium brands for the alcohol sector as well. Moving on to some boardroom drama, and Monte Paschi shares are up this morning after investors backed another term for CEO Luigi Lavaglio after the board had tried to get rid of him. And so this is a triumphant return for the CEO, and we are seeing shares react quite positively to that, with Paschi shares up 3.5% this morning. On the airlines and travel front, we're seeing a little bit of weakness this morning, with EasyJet down 4% after guidance disappointed. So the outlook has been hit, of course, by flight disruptions and those higher fuel costs because of the conflict in the Middle East, and is dragging down the rest of that travel and airline sector, with Ryanair and TUI also weak this morning. And finally, let's end with Mighty, which is a facilities management company listed in the UK. It said in a trading update this morning it expected a double-digit profit and revenue growth for this year. So quite a bright outlook for the company, and we're seeing that reflected in the shares this morning. We're up almost 4% for Mighty.
Chloe, thank you very much indeed on some of the stocks on the move in this Thursday session. Chloe Melly, thank you. Coming up, we're going to get the latest on TSMC's surge in profit as the war in the Middle East fails to dent AI demand. That is next. This is Bloomberg.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
Bringing you up to them in the news whenever and wherever it happens. I'm Shevrian in Seoul, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jumana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance.
flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Bringing you up to the minute space news whenever and wherever it happens. I'm Ed Ludlow at NASA's Kennedy Space Center in Florida, and this is Bloomberg.
Earnings season is here.
Certainly valuations have shifted quite significantly.
Maybe a bit of optimism.
Bloomberg is first to break the numbers.
We're talking about a move away from U.S. assets.
So much corporate issue.
With the smartest insights.
We're observing what's happening in the Middle East.
The situation is volatile.
We're closely monitoring the impacts on supply chain and logistics.
Cross-border M&A, still such a difficult thing to get done in Europe.
Continuing coverage on Bloomberg.
Welcome back. You're watching the opening trade. 19 minutes into the session. This is what the picture looks like. We're holding on to gains. It was a decent session yesterday, really decent session over in the United States. You are seeing definitely the chip story on the front foot this morning. The AEX has been outperforming. There are other sectors that are certainly under a little bit of pressure. Travel and leisure in particular is certainly seeing some downside on the back of the update we've had this morning from EasyJet.
All of this, of course, as TSMC raised its revenue outlook for 2026 and an upbeat forecast, underscoring the resilience of AI chip demand despite concerns about the economic fallout from, of course, the Middle East conflict. For more, let's bring in senior strategist Neil Campling is going through the TSMC numbers for us. We're seeing the read across to ASML. That stock is up as a result of the demand that we're seeing, the capex spend. Margins are looking healthy for TSMC. There's no suggestion, it seems to me, from the initial look at these numbers, that the demand around AI and its chip production is slowing.
No slowdown at all. We are seeing demand high. We're seeing supply constraints. We're seeing pricing strength. We're seeing the most leading edge of their fabs now 25% plus of revenues. They've raised guidance again, even though they've already raised guidance this year. So, I mean, every time we think it's as good as it gets, it still gets better. I mean, the demand trends are off the charts. So it's as strong as can be. So TSMC is up triple digits over the last year. It's led AI winners gains. It's one of the three kind of global key enablers of AI, alongside NVIDIA and ASML, I'd argue. So everything is bullish in the AI camp for sure.
Everything's bullish. The hopes and fears of what AI can do for us, very much demonstrated by the latest out of Anthropic. And whilst we've been busy talking about rightly the story in the Middle East, Neil, maybe we haven't talked enough about the new release from Anthropic. Tom's going to be speaking to the management from Anthropic shortly. But this is quickly becoming a preoccupation, isn't it? Mythos. Of governments, of central bankers, of regulators, everybody either wants to use it or is a bit scared of it or wants to stop people using it. I mean, what's your take?
Well, we get those scares around every new big technology leap for sure. And the fact that the cybersecurity angle of this is that sometimes a flaw or an issue that takes 10 to 20 years to discover now takes mere seconds. So it's kind of this paradox for any kind of new technology, that the risks are there alongside the big technology gains. The big thing with this particular product set from Anthropic is the kind of size of the revenue potential that we're seeing. There are some suggestions that by the end of this year, the revenue run rate for Anthropic could be 13 times bigger than Salesforce and Adobe and ServiceNow and Workday combined, for massive SaaS companies that are well established. So the numbers are just huge.
Elon Musk is struggling to get what he wants, which doesn't often happen.
Couldn't happen to a smarter man. Yes. Clearly, what's happening here is a chip equipment war in terms of trying to get access to the chip equipment. And
he wants to build his own fabs, doesn't he?
He wants to build his own fab, the Terra fab. Now, it could cost up to $13 billion to build this particular fab. Big numbers again. The key thing for me in this exclusive overnight that we had was the fact that Musk is prepared to pay over the market price for the chip equipment. That tells you there's massive high demand for the equipment, for the fabs. So who's going to build this? Who's going to build this first? There's only limited enough of machines from ASML and Applied Materials around to fit these out. But it's a massive war going on in terms of the chip equipment race to get to the AI leadership that Musk and everyone else is after.
Yeah, every now and again we go round in circles, don't we, and rediscover the limitations that there might be around the AI build-out, and they're not always in the places that you thought they might be. Neil, thank you very much. Senior strategist here at Bloomberg, Neil Campling. Thanks for joining us this morning. Let's check in on the grocery sector in the UK then. We have the Tesco share price going higher this morning. That's as Britain's largest grocer gave a conservative guidance as it faces uncertainty over costs and the impact on households due to the war in the Middle East. For more, we're joined by our consumer reporter, Maddie Parker, to talk us through the Tesco numbers and some other consumer-facing stories. Good morning to you, Maddie. Nice to have you with us. So what have we learned from Tesco's and the earnings story this morning?
Yeah, so Tesco kind of sort of joining this kind of growing chorus of retailers who are warning about the kind of impact on both their costs and on UK households following the outbreak of conflict in the Middle East. They weren't quite as forthcoming as some other retailers in terms of saying this is exactly how much it's going to cost us. Having said that, as you say, they have been cautious. They've given kind of wider guidance than they would have previously wanted to do. That's between £3 billion and £3.3 billion for the current year. Ken Murphy, Tesco CEO, this morning was very keen to emphasise that they're yet to see major supply chain disruption, saying their suppliers have not yet communicated that to them. But they also confirmed, and we've heard from the UK government this morning, that they are kind of working with the government on contingency plans if there are to be any food shortages, if there are going to be any sort of fewer supply and variety on shelves going forward. And they've also seen, of course, an increase in demand for their fuel and their forecourts and their supermarkets.
OK, Tesco stock is up 3.2%. It's giving a lift to the likes of Sainsbury's. M&S is up 1.7%. Sainsbury's is up 1.8% as well. So we'll see if they communicate similar relative resilience in terms of the supply chain story, at least for now. It's a bit of a different story. It's a different business, of course. Pernod Ricard, the drinks maker, they have seen a hit as a result of what's happening in the Middle East. It's a demand picture, it seems, rather than necessarily a supply chain story for them. What stood out to you for Pernod Ricard?
Well, Pernod, they also gave a very cautious update. They actually think their organic net sales could decline 4% this year, and they've said that is exactly because of the conflict in the Middle East. They've also, having said that, they did beat analyst expectations this quarter, but they are seeing demand problems, as you say. I mean, China was a bit of a problem child for them for a long time. It seems that the US now might be another issue. They're seeing kind of persistent weakness around there. And just on Pernod, another thing that everyone's looking out for is some talk about a potential deal they might do with Jack Daniels maker Brown-Forman. There's yet to be any word on that this morning, but we'll see what happens.
Maddie, great stuff. Thank you very much indeed for joining us, updating us on a couple of key stories this morning. The other one we're watching in terms of the European equity story is what's happening in the airlines. EasyJet's come right back. It started off, I think, down 7. It's now only down by 1.2, 1.3.
And it pulled the broader sector down.
It did pull the broader sector down. A couple of stories here, one of which is kind of what is happening on fuel costs, which they're kind of having to factor in and talking about the impact that that's going to have on the losses, and also what consumer demand is, the point that you were making about the fact that it's being pulled in a little bit, the consumer being a bit more cautious. If you have to pay more at the grocery store, are you going to pay less on holidays?
Yes.
Kind of how these things, kind of what do you do with your money?
And if you see all these stories about how, yeah, sure, there's enough jet fuel for April, May, we'll get back to you. We're not quite sure. It's not going to, maybe that weighs on people's thinking as they consider what to do with their cash.
Also, do you want to stand in a big long queue at a European airport at the moment?
Yes, for other reasons. Nothing to do with jet fuel, but to do with
That's biometric data. Biometric data challenges, so long queues, concerns about whether or not your flight... On the flight fuel question, it's that you book your holiday in the summer, and there's concern that, well, will it actually fly, and will I get my return?
Staycations all round.
Excellent. How do you get to the staycation?
Coming up, as businesses, as Anna thinks about her holiday and her staycation...
I nearly said EV, but I thought that might be a bit triggering. So.
Governments weigh the potential impact of Anthropic's new powerful AI model. This might make you want to stay in your basement rather than go anywhere on holiday. Mythos. We're going to speak to Pip White, head of EMEA North at Anthropic. That exclusive interview is next. This is Bloomberg.
about 80% of projects will find it difficult to secure financing. And this is really all because of the level of readiness or preparation. As you know, for investment to occur, you need well-prepared, technically prepared projects, but they must also demonstrate economic and financial impact. So one of the major challenges is the stock or availability of bankable projects in countries. Almost all countries have got good plans and ideas, but when you look at the readiness of those projects, that's a major obstacle. And that is why the African Development Bank, through the African Water Facility, invests heavily in upstream preparation of projects to enable countries to have a large pool of investable projects. The second element that is an obstacle is the institutional and regulatory environment in most countries, which make it difficult for investment to happen.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Anand, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Welcome back. This is the opening trade. 30 minutes into Thursday's session, and this is a picture across European equity markets. Then we're up by 0.3%. Another day where FOMO, in the words of one of our guests, is causing equity market investors to try and look through what's been happening in the Middle East, or at least not take a negative interpretation of reporting around the extension of a ceasefire, and decide to focus on other things. And technology is one of those things. Meanwhile, we have grocery stores cushioning the impact on the FTSE 100 and helping that one go higher. So the FTSE is up by around 0.25%. But broadly speaking, Guy, we're making modest gains across this market this morning.
Modest gains. Let's talk about what the internals look like. 2-to-1 in terms of the ratio. 300, let's call it 400 stocks up, 200 down. The internals don't look quite so good, though, if you look at some of the other metrics. And volume is one of those things you want to look out for. Breadth is another one that you want to focus on as well. So while you've got this kind of FOMO rally on, there are internals that you want to pay attention to which aren't telling you quite such a positive picture. OK, let's break it down. Let's talk about where we are seeing some gains this morning. TSMC numbers were good. You also saw a strong session yesterday, which is going to lead into ASML. So there's two factors which is driving the lithography equipment company. SMI is also tracking higher as well. Another factor lifting the FTSE 100 is some of the metal stocks, which are up. Metals are having a better day today. So Rio is up by 2.2%. On the downside, some of the consumer-facing stocks are not looking quite so good. Pernod is one of them. It's down by 1.1. Ashmore's down by 5%. But EasyJet was the one that initially looked really bad, but has come in really quite considerably since then. You're seeing a ripple effect into names like Ryanair as well. It's warning on a couple of things, one of which is the kind of demand visibility. The other factor is the impact that we're seeing from higher jet fuel costs. Both of those impacting the EasyJet numbers this morning. The stock is now down by, let's call it 1.5%, Anna.
Let's talk about technology, Guy, because it is a conviction around AI that is helping markets to regain their positivity. Now, the AI frontier lab, Anthropic, is the focus of attention across boardrooms and governments after the partial release of its most powerful model to date, Mythos. Now, warning of cyber attack risks if it got into the wrong hands, the company has limited the release to a handful of major firms. It's quickly gained the attention of governments, regulators and industry leaders.
The issue is, to what extent is this new version of their product going to be able to, in a sense, identify vulnerabilities in other systems which can be exploited for cyber attack purposes. We've all got to get to the bottom of this.
The impact of it can be so disruptive for good or for bad. I think the development we've seen with Anthropic and Mythos is a good example of a responsible company that is suddenly thinking, that could be really good. But if it falls in the wrong hand, it could be really bad. We need to do something about it.
The way the compounding of these models learning works, this Anthropic Mythos model was a step function change in abilities, learning, capabilities. It's all logarithmic. You go from x to the 10th power to x to the 12th, and then very difficult to catch up.
Now, this comes as demand for the company's initial AI model, Claude, has spiked, and the company's annual recurring revenue has topped $30 billion. Now, as Anthropic's growth has surged globally, Europe has emerged as its fastest-growing region. To capitalize on this, it's been expanding across the continent with 5 offices now established. Here in London, Anthropic is doubling down on its operation with a new 158,000 square foot office with capacity for around 800 people. So let's talk about the opportunities and excitement around this product and also some of the vulnerabilities. Tom.
Yeah, Anna, thank you. Very pleased to say that we are joined now by Pip White, head of EMEA North at Anthropic, who joins us for an exclusive interview. Pip, thanks for joining us in the studio this morning. Let's start with the London office then, and what that tells us about Anthropic's ambitions for the UK and for Europe.
Yeah, I mean, thank you very much, Tom. It's great to be here this morning. Yeah, I mean, I think we have seen unprecedented growth here from our enterprise customers. At the end of 2025, our revenue was at around 9 billion revenue run rate, and as you just said last week, our revenue has now hit 30 billion in run rate. And we're seeing really significant demand from customers in 3 key areas. Firstly, in terms of how customers are thinking about transforming their general day-to-day employee work, how customers are thinking about transforming their knowledge work, so automating a lot of that through an agentic process, and then how customers are thinking about building products on top of our large language models to kind of accelerate innovation and bring that innovation to life. So customers like Spotify, Lovable, for example, that are really using and harnessing the power of the technology to really accelerate their growth and demand. We've also seen a significant growth, even in just the last 2 months, around customers using Anthropic above $1 million. So in 2 months ago, we had 500 customers that were spending over $1 million with us. That's doubled in size just in the last 2 months. So we're really seeing a lot of amazing growth. And I think as a result of that, we're delighted to announce the opening of our London office today, which will open in Q1 of next year. Yeah. And that's really a detriment of the opportunity that we have for our customers, the opportunity for growth, and the excitement that we have in this marketplace.
What does that mean for headcount for Anthropic here in the UK?
Yeah.
And what are you targeting in terms of adding headcount over the next 12 to 24 months?
Yeah. Currently, we have around 200 employees in London right now. 60 of those are members of technical staff, and the rest are a wide variety of roles, particularly in go-to-market. Our ambition to fulfill in terms of the new office is that we will have the capacity to get to 800 employees in that time. So, as I say, the office will open in Q1 of next year. We're really excited about the opportunity as well to attract the best talent across Europe here. We've always been very thoughtful about, we want the best talent, but we want talent that really are very thoughtful about the way in which we collaborate with our enterprise customers and how we think about deploying AI in a safe and responsible way. So we want that kind of bridge of talent, but that really believes
Does Europe and the UK have that talent still?
I certainly believe that, yes. I mean, we have a fantastic team already who are hugely passionate about working with customers and collaborating with our customers. and helping our customers on this journey.
Yeah.
But also, I think, we want to make sure that we hire employees that are really aligned to the importance of thinking about this in a safe, considered, and a very responsible way.
Well, talking about being responsible and safe and considered,
Yes.
I mean, Anthropic's making headlines almost on a weekly basis,
Yes.
and most notably now around Mythos, of course. We know that some US banks have had access through Project Glasswing to this latest model for testing.
Yeah.
Have you released it to UK financial institutions?
Yeah.
Where are we on that journey?
Yeah, so great question. And I think where we are on this journey is that, as you're right, we've opened this out to a number of organisations, including Microsoft, AWS, some financial institutions, a very small cohort. And essentially, Mythos has really showed us that there are a lot of very severe vulnerabilities right now. Mythos found vulnerabilities in every single operating system and in every single web browser. And so we wanted to build this small cohort first, to basically learn from what they found in a very contained and controlled manner. But you're right, our intention is definitely to expand this out in a very intentional way.
To be clear, it hasn't been expanded to UK financial institutions yet?
No, but I think that is in the very near term, like in the next
weeks away?
In the next week.
In the next week?
In the next week, yeah.
OK, and these are top UK financial institutions?
Yeah, we've been, I mean, as you would expect, the engagement that I've had from CEOs in the last week in the UK has been significant. Customers firstly want to say that they appreciate our very thoughtful approach to the way in which we have released Mythos. But secondly, of course, they want to understand the opportunity to be considered to gain access to that model in a controlled way. And so we've been having a lot of conversations with CEOs about the reason why, firstly, we did Project Glasswing and the way that we thought about that intentionally. And then secondly, being very clear and to understand exactly why they want to get access to Mythos, and then working in partnership with those customers to think about the next kind of phase 2 and 3 and 4.
Does the system of release from Frontier Labs need to change? Some will be looking at this and thinking Anthropic has made this decision to limit the release of a model that can prove very dangerous.
Yeah.
There's the upside, but there's also clearly the dangers that you've articulated and that the team have articulated. It's come down to decision-making at Anthropic as to whether or not and how to release this. That has to change, doesn't it?
I think where I would position it is that this model in particular, we saw a significant leap in cyber. And as a result of that, we were very concerned about a mass release and made the decision not to do that. And obviously, I've already articulated our kind of approach with Project Glasswing. I think labs have to take a responsibility for thinking about safeguards, for thinking about safe and responsible AI as it gets into the hands of the enterprise, particularly highly regulated organisations like financial services.
We don't release a new car onto the market if it hasn't and doesn't meet the regulatory safety tests of a particular nation, and the same with airlines, whether it's Airbus or Boeing or Embraer.
Yeah.
We need a system like that for AI, do we?
Well, I think what I would say is similar to how we've approached it now. We are being very thoughtful and intentional about our release. We have not released this in GA, and we don't have any ambitions right now to do that. We are essentially putting our own safeguards and our own limitations around the release of this product, because we know how powerful that it can be. And I think, I'll just say back to the customer meetings and conversations that I've had, they are very grateful for our very considered and intentional approach in terms of this release.
What is it? The models only get better from here, presumably. What does it mean for the business model of Anthropic and others if you have to, they're getting so good that you have to constrain their release?
I think Dario has always gone on record to say that if we have to slow down the release for the safe and responsible development of AI, and that has a commercial impact, we will do that. Because our most important mission here is getting this technology into the hands of employees, into the hands of customers, into the hands of enterprises in a safe way. And so I don't think that we will change anything to do with our approach here. I think we will always have a safeguard approach, we will always have a safety approach, and we will always make sure that we're doing it in a very considered, intentional way.
Are you building out your data centre capacity in Europe?
Yeah, so I think this is a great question. And actually, we look at capacity globally. We're always looking for opportunities to grow capacity. And actually, only last week, we announced a multiple gigawatt capacity with Google and Broadcom. And so how I think about this, particularly in the UK right now, is we have fantastic relationships with all three hyperscalers, with AWS, with Microsoft and with Google. And we continue to partner with them in a meaningful way in the UK to release safe, responsible technology.
You haven't directly answered my question as to whether or not you're building out more data centres, more infrastructure. Is that in the pipeline, or are there hurdles?
Yeah, I mean, I don't know that. I don't believe there are any hurdles. I think right now we look at it from a global perspective, Tom, quite honestly, and we consider that in terms of a global outcome. Right now, our relationships with the hyperscalers allow us to scale very quickly and to meet the 11x demands of our European customers in order to serve the requirements that they expect of us.
There are reports that the valuation for Anthropic, which could be listing later this year, we'll see, the IPO, is now around $800 billion US or thereabouts. Does that seem reasonable to you from your position, Pip?
I mean, I think I would just say we have been, so privileged to be so engaged with customers in the enterprise. There has been so much demand, as I said from the outset, $9 billion at the end of 2025, just over $30 billion as we sit here today. The level of demand has been unprecedented, and we feel very privileged to be in that position to help serve our customers on this AI transformation journey.
And that you talked about that 30 billion annual recurring revenue, which is remarkable.
Yeah.
What is the cadence going from here? What are you projecting out in terms of where the upside is to that over the next, say, 12 months?
Yeah, I mean, I think we have a significant amount of opportunity still to bridge into the enterprise. I don't like to say we're only getting started, but
do you feel like you've won on enterprise versus OpenAI?
I think we have always maintained a very clear focus in the enterprise. We've never been distracted by building a consumer model or a consumer product. Our intention for the last 5 years since we started this business has always been that our focus is the enterprise, and I think that really resonates with customers. We're not distracted by other ideas or other desires. Our focus very much here is like winning in the enterprise, helping our customers on this transformation journey, and being a true partner of choice.
Pip, thank you very much indeed for your time, for coming to the studio. Pip White, Head EMEA North at Anthropic. Bloomberg is going to be hosting, by the way, a live Q&A on Anthropic's Mythos model tomorrow. It's open to everyone to listen in. Terminal clients and digital subscribers have the opportunity to send in questions for the team to answer in real time. So take that opportunity. That's Friday, 6:30 p.m. London time. Coming up, we're going to switch our focus back to the banking space. Morgan Stanley CEO Ted Pick telling Bloomberg he's not concerned about the firm's private credit exposure. That also partly links, of course, to AI. We're going to bring you more of that interview next. This is Bloomberg.
You don't think the court was hurt by the perception that it was a political decision?
The court's always hurt, it seems to me, if they
if we look political. One of my concerns, my present-day concerns, is there's too much partisanship. It's true historically that most presidents have appointed justices to the Supreme Court who are members of their own party. The partisanship should not be an overriding factor. What you look at is temperament, learning, background, reputation, whether or not you have those qualities of independence and caution that make for a good judge.
Increasingly, you see dissenting opinions in the Supreme Court aren't quite as civil as maybe you might prefer, and is that of concern to you?
Yes, it's of great concern to me that our civil discourse, our civic discourse, is not civil enough. Aristotle said that a democracy depends on an open debate. You respect the dignity of those with whom you disagree. He said democracies only live if they are sustained over a period of time by a thoughtful, rational discourse, a discourse in which you respect the dignity of those with whom you disagree.
The countdown is on. Everything you need to get the edge at the end of the market day. Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything.
Bringing you up to the minute geopolitical news whenever and wherever it's happening. I'm Anne-Marie Hordern in Caracas, Venezuela, and this is Bloomberg.
Welcome back. This is the opening trade. Now, Morgan Stanley stock traders had a record-breaking first quarter, reporting $5.15 billion from equity trading. The firm's wealth business pulled in $118 billion in net new assets, and investment banking fees climbed by 36%. Speaking exclusively to Bloomberg, the CEO, Ted Pick, said he wasn't concerned about the firm's small private credit exposure, but added that the sector is going through a learning moment.
When I say adolescence, I mean it's a learning period. You know, it's grown like a weed. And that, as you know, is a function of an asset class that didn't exist 10, 15 years ago. Effectively, the street was replaced on that. It's around $1.7 trillion. High yields at about $1.7 trillion. Levered lending is at about $1.5 trillion, $1.7 trillion. So it's relevant, but the IG stack, as you know, is the investment grade stack is 10 to 15 trillion. It's all credit. It's all credit. So all things being equal, if the economy is growing, credit does fine. It does fine. When there's a recession, credit struggles. And then the question is then, which of the borrowers were really doing the work around what's in underlying portfolios? How quickly was the capital put to work? And I think what we're going to see is we're going to see dispersion of returns among great asset managers who really stuck to their knitting, thought about sector diversification, thought about how long it takes to put those investments to work, and managed to do less well. And over time, I think the alts will find their place as a growing asset class for all kinds of institutions and investors.
Morgan Stanley CEO Ted Pick talking about private credit being kind of like a teenager. You know how that ends. Anyway, let's talk more about what we are getting out of Wall Street right now. Bank of America's stock trading desk also set a record, riding a wave of volatility that has helped push the bank's earnings to the highest level in nearly 2 decades. We're joined now by Philip Richards, team leader for financials at Bloomberg Intelligence. Joining us around the table. Good morning.
Good morning.
Can I draw a line between what is happening with the Iran conflict, the volatility that we're getting off it, and what is happening on Wall Street in terms of trading?
Well, clearly there's been a boost this quarter, and that's why we have hit a record 20-year high, you said. But also this time last year was also a record quarter. Recall Donald Trump coming into power, about deregulation, tariffs was quite a big theme at the time. We all recall. So yes, it's been on a trend of basically a 2-year path of a big improvement for the banks overall.
How much exposure do they have to private credit? How concerned are CEOs of these banks
They're rightly concerned, as we heard there, that the losses are not coming through yet, but we haven't gone through a whole cycle yet. And that's always the case with banks. You can't look at the times when they begin to slow and say, have we got losses, yes or no? Until we've gone through that whole cycle, we won't know for certain. And that's the case, what might be coming in the future.
Yes, I mean, bank CEOs want to talk about growth. That's not necessarily coming with new jobs, or maybe it is, but just different jobs. Wall Street banks cutting about 5,000 jobs in the first quarter. What's the actual story there, then, Phil? What do we need to know?
Well, some of what we've looked at, we actually think is short term it might be a pick up in terms of employment at the banks, because as you bring in AI into the banking, you need people who know how to work the processes, and it takes time. So yes, there might be job cuts coming through, but actually might be a bit more delayed than many are thinking.
Is there a read across from what we're getting on Wall Street to what is happening, what will happen in terms of the European bank reporting season?
Definitely, I think so. And obviously, a lot of what they're working in very similar markets, and for the outside the US banks support about a 17% rise in trading in the quarter. That's about 4% beat versus consensus. For European banks, we're expecting about a 10% rise. So if they're in the same markets, there's a chance they'll also do better as well.
Philip, how are they looking? How's the banking sector looking at all of the innovation coming out of the likes of Anthropic? Tom was just talking to about. Well, even Claude, nothing to do with Mythos, but Claude, you know, how nervous are they about what can be provided by some in the tech space?
Well, they're certainly telling us that there's risks coming, but there's also opportunities too in terms of how they can implement the new rules, new changes, and the new technology. So yes, there are challenges, but it could be positive as well.
Okay. Philip Richards, thank you very much indeed. Team leader for financials at Bloomberg Intelligence. Let's look ahead to what else we are watching throughout this Thursday, 1:30 p.m. UK time. We're going to get US jobless claims. IMF spring meetings continue, of course. The ECB speakers today include the Bundesbank's Joachim Nagel and Germany's Vice-Chancellor Klingbeil. And later there's going to be an informal meeting of EU tourism ministers in Cyprus. Guy Johnson's very excited about that. Travel and leisure, airlines, what happens in terms of the disruption around that. US earnings, Netflix, PepsiCo and Bank of New York Mellon, speaking of the financial space. And when it comes to Fed speak, we'll be hearing from Williams and Myron as well.
Absolutely, yeah.
Yeah. Let us find out what is on the minds of the Markets Live team. We're joined now by Skylar Montgomery-Koning, Markets Live strategist, with us on set this morning. Skylar, good morning. There's a lot happening in markets right now and a lot to keep track of. What are you chasing?
Yeah, I mean, I think right now the high-level idea that I'm thinking about is kind of timing the pain in terms of right now the market's rallying very aggressively, and so the pain is to be short. But in the medium term, we're going to have a stagflationary shock. So I am still worried about this idea that oil prices are too optimistic when you look at the curve in terms of the decline that's expected. We haven't priced the kind of growth downgrades that will likely come at some point. And by that I mean, you know, you see the inflation impulse before you see the growth decline. And so it's really all about timing. So, you know, eventually we will have that data come in weaker, but it used to be you'd get an early warning signal from soft data, but soft data is very partisan now. It's also negatively correlated with inflation. So since COVID, it's done a really bad job of showing you that. And so it's not the data that's really going to get the market to turn. It's unlikely to be earnings season, given that that timing impact is relevant there too, in terms of it's more likely to come through in 2Q earnings than 1Q earnings. So maybe it's a ceasefire, but again, we've already seen that pushed out potentially from next week. And then that just brings you to kind of over-exuberance. Our team has done some work on liquidity tightening post-taxes. Also, the strength of the rally that we've seen points to some frothiness, but there's also still evidence that there's money sitting on the sidelines that can be put to work.
Back up a little bit. Is the oil market not telling me the truth?
It's interesting because there's been some commentary from an energy CEO overnight that essentially is saying the futures curve doesn't really tell you where prices are going, and that backs up analysis that I've done as well, where when you have steeply backwardated curves, that's more of a relevance to incentivize inventories to be drawn down now. And you can actually have a profitable systematic trade by buying steeply backwardated commodity curves that have positive momentum versus selling steeply contangoed curves that have negative momentum. And the idea is that usually supply constraints stay around longer than you think. So oftentimes you roll up that forward contract rolls up into spot. And then the other bit is that the curve isn't exogenous, right? So the fact that future prices are lower tells energy companies that they shouldn't invest. If you look at U.S. rig counts, they haven't risen since the conflict began. And so because they're worried about prices being lower in the future, they don't do investment now, which means there's not more supply in the future, which kind of means that it becomes self-reinforcing.
So on the earnings story then, in that scenario, do you need to be screening out the companies and the corporates that have overexposure to those energy inputs? To what extent, how do you think about factoring that in to the earnings calls and whether or not that is priced in?
Yeah, I mean, this is the interesting component, is that I think you likely see two waves in terms of right now you will see an impact from directly impacted companies that have energy exposure. So, EPS expectations for energy have risen in first quarter, they've risen more in second quarter, but that will definitely have an impact versus your input cost. And then the second wave is we've not had energy prices high enough for first quarters, and we've had 1 month, March of the war, to see broad-based demand destruction. But eventually you will get some kind of demand destruction. That means, cyclicals underperform defensives, and you need to consider that as we head further into the conflict with energy prices staying elevated.
Okay, Skylar, thank you very much indeed. Bloomberg's MLive strategist Skylar Montgomery Koenig, thank you. Before we go, we want to take a moment to mention that emerging markets investing pioneer Mark Mobius has died at the age of 89. A partner at Mobius Investments says he passed away in Singapore. Mobius spent over 30 years with Franklin Templeton, championing opportunities in Africa, Asia, Eastern Europe and Latin America. He founded Mobius Capital Partners in 2018 and continued to seek out investment opportunities in recent years, including setting up a new venture in Dubai.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Astonishing day for U.S. technology.
Shaping the region's technology ecosystem.
Asia's biggest tech news and innovation.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jemana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Global stocks to record highs on signs that Iran and the US may extend their ceasefire. UK monthly growth smashes expectations. Meanwhile, China's GDP also tops forecasts, signaling limited fallout from the Iran conflict. Plus, European chip makers rise after TSMC lifts its full-year outlook, pointing to strong AI chip demand despite geopolitical uncertainty. Good morning, everybody. Let's have a look at what's happening on these markets then. Here's a host of assets for you. Stocks Europe 600 trying its best to once again move through the tensions in the Middle East and think about earnings, think about tech in particular, up by 0.25%. S&P futures also a little bit stronger this morning. The French 10-year yield, we put this in here. PIMCO expressing a lot of interest in European bonds right now as we pivot from thinking about inflation to maybe thinking about growth. That was the BlackRock view a little earlier on. And Brent crude still keeping that in focus under observation. 96.35 is where we trade up 1.5%, not quite commanding the attention of the European markets as that has done in recent weeks, of course. So we see a higher oil price, but we don't see weaker stocks. We've got the UK market up by 0.25%. The CAC doing pretty well as we see some recovery after the sell-off yesterday of luxury. That market and the FTSE MIB both up by around 0.4%. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is The Pulse.
Good morning. Welcome to The Pulse, everybody. I'm Anna Edwards, in for Francine Lacroix here in London. Now, Bloomberg understands that the US and Iran are considering a 2-week ceasefire extension to allow for more time to negotiate a peace deal. Mediators are said to be seeking fresh talks to overcome the issues preventing a longer-term agreement, including disruption to the Strait of Hormuz and Iran's nuclear program. This comes as President Trump says the leaders of Israel and Lebanon will speak tomorrow after the first high-level talks between the two countries in 3 decades. Let's bring in Bloomberg Horizons anchor Jumana Basechi, who's in Dubai, can bring us up to speed on all of these fronts. And what more do we know then about the potential of returning, Jumana, to the negotiating table?
Yeah, well, certainly there's a lot of chatter about the possibility of a second round of talks, but I should say that neither the time nor the venue had been set at this point in time. Caroline Leavitt, the White House press secretary, strongly indicated that she's optimistic that another round of talks will take place. If they do take place, that will likely happen in Islamabad. But she said also that the U.S. did not formally extend or ask for an extension of that ceasefire. And remember, the ceasefire is set to expire on April the 21st, at technically 22nd over here in the region. So the clock is ticking when it comes to the actual ceasefire. Now, in terms of the diplomatic channels, there has been a huge effort in the last 24 hours. The Pakistan chief of the army is in Tehran, visiting some of the key representatives of the Iranian delegation over there, and the Iranian state media reporting that a new message has been passed from Pakistan, from the U.S. to Iran, yet to hear a response from them. At the same time, the Pakistani Prime Minister is also doing a trip around the region. He was in Saudi Arabia yesterday. He's making his way to Qatar today. Will be heading on to Turkey. And then over here in the UAE, I will say it was quite notable yesterday that a call took place between the Vice President of the UAE and the Speaker of the Parliament of Iran. This is the first call that has taken place since the war started about 7 weeks ago. And of course, UAE received the lion's share of most of the attacks and the projectiles that came through from Iran. So another indication that perhaps things are moving towards the diplomatic angle. Now, one thing you need to be mindful of is there is no ceasefire as of yet in Lebanon. And once again, overnight, Iran has reiterated, the Iranian Speaker of the House, Mohammad Ghalibaf, put up a post saying that the Lebanon ceasefire is an important part of the discussions. And the view here is that there is a potential for the lack of ceasefire in Lebanon to derail the potential for the second round of talks. And equally, overnight, President Trump has now posted that the two leaders of Israel and Lebanon will be holding a call today that has not been confirmed yet by the Lebanon side. But it does tell you that there is an intention from the U.S. side to keep the channels separate, i.e. to continue the discussions between Iran and the U.S., but then also have parallel discussions between the Lebanese state and Israel about the potential for a ceasefire and perhaps a more broader peace agreement there. So something to bear in mind as we head into the weekend.
Jemana, thank you very much. Bloomberg Horizons anchor Jemana Bersetchi. Now, let's pivot to the Chinese growth story. China's economic growth rebounded more than expected in the first quarter of 2026, suggesting limited impact so far from the Iran war. Let's speak now with Bloomberg's Laura Davison, who's in Hong Kong and tracking the story for us. What stands out to you then, Laura, from the data out of China? How much resilience is there now in the economy? Quite the divergence between the domestic and the global story, perhaps.
Yeah, this 5% GDP growth is really a surprising number, was at the far upside of what the estimates were. Again, it continues to be the story of really strong exports, industrial growth, and manufacturing at the expense of weaker retail sales, weaker consumer spending. And this is a dynamic that has dogged China for some time now and continues to be part of the trajectory, but clearly being able to buoyed by the manufacturing side. In particular of note on some concern are the unemployment rate, as well as that wage growth and consumer spending are at some of their lowest levels since the pandemic and some of those really COVID zero lockdowns. However, there was lots of concern that China, being one of the most exposed in this Iran conflict, that is not showing up in the data yet, though I'll note that this quarter only covered about 1 month of the war, 2 months of more normal times. So there's still a lot to be seen here, but for right now, China has proven to be resilient.
Laura, thank you very much. Bloomberg's Laura Davison in Hong Kong for us. Now, central bankers have indicated that they're in no hurry to raise rates. The Bank of England's Megan Green says relevant data will take a while to come through.
Unfortunately, we won't have definitive data on whether there are second-round effects or not for months, and if we wait until we see it, then it will be too late. So for me, I'm looking at inflation expectations, certainly. I'm also looking at the pay settlements as they actually come in, but I'm looking at some forward-looking indicators as well. So we run a survey of businesses. We ask them all kinds of questions, but they talk about their year-ahead price expectations and their year-ahead wage expectations, and so that will be important too.
Meanwhile, Bloomberg understands that ECB policymakers are leaning toward keeping rates unchanged this month, delaying assessments of the war's impact. The Bundesbank President Joachim Nagel weighed in on the impact the Middle East conflict is having on monetary policy.
I would say we are somewhere in between our baseline scenario and our adverse scenario. Now we have to find out where it's going. It's going back to the baseline scenario. I'm a very happy person. But as I said, we should keep our flexibility.
European stocks are up this morning as investors focus on a flurry of earnings and signs that the US and Iran will extend a ceasefire by 2 weeks. So there's a lot to unpack, a lot to put together. Let's talk about where we in the markets conversation. Claudia Pansari joins us, France CIO at UBS Wealth Management. Claudia, thanks very much for being with us. So we do see markets pretty risk on. There's an argument that maybe that's about AI and it's about earnings, but maybe it's also about the ceasefire. I mean, do you see an extension to the ceasefire as being a risk-on dynamic for markets? Is that how we should think about it? We haven't had confirmation that that's going to happen, but it is certainly possible. I guess it wouldn't be war, but it also would not be a reopening of the Strait of Hormuz. Help us understand how we should interpret these latest news lines.
Good morning, Anna. Thank you for having me this morning. I think we should probably interpret thinking the market and investors are looking forward. So we know that the time horizon of investment is always longer than few weeks. And for me, the market is already pricing that some negotiation will come to a positive end. I have to say that there is this discussion around conflict, but also in the meantime, the market is driven up essentially by AI stocks. This passion is still very high, so all the sector and companies which are still linked to conflict, higher energy price, are still under pressure, and we have seen some consumer name yesterday to be down quite a lot. So the dispersion is high. Only part of the market is repricing, and this repricing is also due to the earnings season, I think.
Do you expect there to be some sort of reckoning for the global economy on the effects of this, Claudia? I mean, we still don't know how long the Strait will be closed for. It's still not open. Some vessels trickling through, of course. Is there going to be a reckoning for the global economy? And if so, will that need to be priced into stocks?
Yeah, I think we haven't seen yet the impact of a rise in energy price in the economy. We just see this morning strong data out of China, strong data out of UK, and all the lead indicators, essentially even in US, are holding up quite well. So it takes time usually to have an impact on consumption, and usually have a time take times also on corporate earnings. But I think if we have this conflict to get to a negotiation in the coming, let's say, 2 weeks, we may probably have a reducing impact on the economy. We know we did some text and some scenario analysis a few weeks ago, and we realized that to have a big impact on the economy, on inflation, you need to have a rise in energy price for an extended period of time. An extended period of time is more than 6 months. If the energy price stay at current level for a few weeks, then the impact on the economy, even on the economies which are the more sensitive to the high energy price, will remain contained. So I think in that case, the market can continue to run on the positive side.
So if higher energy prices don't necessarily mean tighter monetary policy, Claudia, and we'll take on board the timescales you're talking about there, where does that leave you on European bond markets? We've heard from BlackRock this morning saying that the market is pricing in too many hikes. We've heard from PIMCO overnight saying that they like bond markets as we rethink inflation versus growth, perhaps. So what are you thinking about the European bond space?
Yeah, I think it's a good opportunity to re-enter the market for everyone or for every people which are not invested. I completely agree. Investor and within the future, we see too many rate hikes, not only on the ECB, even on our central bank, on the Bank of England, for instance. I think the ECB will make a pause. We'll continue to watch the inflation data. Market is expecting by the end of the year 2.5 rate hikes. We don't expect the ECB to move into 2026 and early 2027. So I think when you have like 50, 60 basis points of rate move and the translation of the yield curve on the upward side, you have opportunities. Opportunities, however, I think are more related to the short term of the yield curve, not the long term. The short term, I'm thinking about duration between 3 and 5, 6 years, no more. So clearly, the movement we had on the bond deal is a great opportunity for investors which are not exposed to fixed income yet.
You mentioned the positive data we had out of the UK this morning, Claudia, and you've also said that you think too many hikes are priced in for the BOE. So give me an update on your thinking there. The number on GDP for February was really much higher than expected, 0.5% versus an expectation of just 0.1% higher for the GDP rate. But of course, the market is entirely discounting this and ignoring it, really, because this is for February and so much changed in March.
Exactly. So I think our thinking is rather that the Bank of England will cut interest rate later this year. The market is repricing too many hikes. It's just focused on inflation. The gilt has been moving quite a lot, probably one of the markets which has moved the most in terms of yield change. I think there is still some pressure on the upside on inflation, and the Bank of England will make clear that the rate cuts are not coming very soon. But at the end of the day, the level of interest rate is still very high. And as you mentioned, we haven't seen yet the disruption coming from higher energy price. It's not only higher energy price because we only think about higher Brent, but the financial conditions have tightened quite a lot. When you look into the bond yield rise across sovereign, especially within Europe, the movement has been so hard and credit spread has been widening as well. So you have a sort of, multi-factor element which are tightening financial conditions, which will have an impact on consumption. So I think it's still too early to think that we will not have any disruption on the economy in the coming weeks or months.
Okay, too early to think that. And investors are keen to move on to other themes, perhaps, Claudia, including AI and investment around tech. What is the best way to get exposure to the AI theme right now? Is it over in the United States with some of the businesses that are rolling out data centers, for example? Or is it in Asia? We had numbers out of TSMC. Is it the European space? Where do you see the opportunities?
I think the biggest opportunity are across the world. We are essentially more exposed to US and China to be exposed to AI. But the way we are exposed today is very different from the way we were exposed 2 years ago. 2 years ago, we were fully invested in IT, all the segment within IT, from semiconductor to communication services. Today, our exposure, I will say, is probably more specific. So we are not buying the overall indices, not buying the overall sector, but we are more selective. So the way we are looking to AI today is searching for companies which are invested, but companies which will see a monetization of the current investment. We also prefer companies which are still investing using cash rather than companies then issuing bonds and trying to fund the CapEx with debt. And within the global exposure to AI, semiconductor is still very present in our allocation.
Claudia, thank you very much. Thanks for your time. Claudia Pansari, the France CIO at UBS Wealth Management. 16 minutes past 9 here in London. Coming up on the programme, how debt markets have reacted to a series of shocks in recent years. We will discuss the latest OECD report on global debt markets with its Director for Financial and Enterprise Affairs. That's next. This is Bloomberg.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Every weekday, Bloomberg puts the spotlight on a different aspect of global finance. Flows, funds, and the forces shaping markets on ETF IQ. The future of money with Bloomberg Crypto. The players behind major transactions on Bloomberg Deals. The stories informing finance with Bloomberg Markets. And rates, risk, and the cost of capital on Bloomberg Real Yield. A different topic every weekday, only on Bloomberg Television.
Welcome to the world of decentralized finance.
Why is it that NFTs have not recovered in the same way that, say, Bitcoin has?
Bloomberg is covering all things crypto.
It's a pretty spectacular story.
The people.
This is the future. This is the 21st century economy.
The transactions.
It snapped up nearly $1 billion of Bitcoin.
And the technology.
We need to build a digital Fort Knox.
That gives people financial freedom, and that's a wonderful thing.
That's extraordinary.
We ride the wave that is Bitcoin.
Bloomberg Crypto, only on Bloomberg.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
You're watching Bloomberg Deals. Welcome to Bloomberg This Weekend.
This is Bloomberg Television.
Welcome back. This is The Pulse. I'm Anna Edwards, live in London. Now, the head of the IMF has warned that markets should be more cautious when it comes to the war in Iran. Kristalina Georgieva also told Bloomberg that the length of the war will determine the impact on the global economy.
Even if the war ends tomorrow, it would take quite some time for the recovery to kick in. Not only because of the infrastructure destruction. Tankers are slow-moving vessels. A tanker that leaves today would take 40 days to reach the Pacific Islands. So we have to keep in mind that the impact is already baked in.
Yeah, talking perhaps of physical and metaphorical tankers. Now, a new report from the OECD reveals global debt markets proved resilient in 2025, despite borrowing levels reaching record highs. So even as markets grapple with geopolitical tensions and trade disputes, the OECD's latest global debt report says the landscape is showing few signs of strain. To discuss, I'm joined now by Taiming's who's Director for Financial and Enterprise Affairs at the OECD. Taiming, nice to have you with us. So there's lots of news coming at markets all the time right now, Taiming. So do you see few signs of stress in a good way, or you see a few signs of stress that we need to worry about?
Well, thank you, Anna, for having us here. We just issued our global debt report. Actually, on the 1st of March, the new war just started, so we had also a stress test of our conclusion. I mean, obviously this situation is increasing. Market volatility is also is increasing. The risks and expectation of higher inflation. But I have to say, and this is the message of the report, and also I think we are testing now. Resilience is there. Structurally, I have to say last year volatility was reduced. Now this period is higher, but always less on financial markets than on energy prices. Also liquidity is there, and governments are on tapping the market even in these weeks. Without particular problems, including UK, Italy. Italy was that week on the market. But it's true that we are seeing more and more what was already structured into 2025. So the fact that issuance is more on the short-term side, yes. This is due because high yields, already also allowed, government want to save in a sense money, so going short-term. Other things being equal, these may increase refinancing costs. Right, yes. So I want to ask you about some of these areas of vulnerability then in the global debt markets. And we'll start with that shorter maturity. I mean, how worried are you that governments, and to some extent corporates, but certainly governments, are increasingly tempted to issue at the short end rather than the long end? On the one side, it's true that we have long-term demand that for positive reasons have been reducing, for example, in many countries due to, pension reform, so there is less long-term demand. On the other side, other things being equal, if you go short-term, again, you may in the short-term, save some money. And, yields were so high that already we had the move from corporate. In the report, in Chapter 1 is sovereign, Chapter 2 is corporate. And the two markets are strictly linked. And many, investors, they went, typically you go to corporate to get higher yields, but the yields were so high on the sovereign that actually we had a lot of movements there. So, but with these high yields, high volatility, then is obviously you are tapping the market. You are a price taker from in a sense, from the primary market point of view if you are the government. So in a sense, you tap the market, you try to get quantity, but you have also to adapt to the condition. On your question, I think the second part is who is buying. And yes. This is also another part of the report. This is Chapter 3. So we have more and more price-sensitive investors buying both sovereign and corporate. Because this is central banks are buying less, so others are buying more. Yeah, this already started with monetary tightening, so they are buying less, they're even selling. So a central bank is keeping, sovereigns for monetary policy reasons, so until, maturity. So I would say it's less price sensitive with respect to what happens in the market. Others are more price sensitive. They're not bad. So we have a lot of leverage investors, asset managers, hedge funds. They give a lot of liquidity on the market. If you talk with public debt managers, they like it. But obviously they are more, I would say, volatile. The issue is that what you need on the market for having strong and consistent liquidity is try to tap the market with different class of investors. So it's important that they are there. Obviously, international tension may increase volatility and market movements. Markets are more integrated than what people think. Okay. You've mentioned the corporates and the governments and the relationship between the two. I wonder how you're interpreting tight spreads right now. Yeah. Because the IMF had this interesting take yesterday talking about tight spreads not as an indication of strength from corporates, but of weakness from sovereigns. Is that something that that you've been reflecting on as well? Yeah, I'm happy IMF is following our analysis. We published on the 4th of March, but it's also on date of last year. It's very interesting. Now, the spreads are reducing. I would say it's a mix of corporates going down and sovereign going up. But the corporates going down is, okay, corporates more or less were doing well, okay, but really this is not exactly the reason. The reason is that on market microstructure, more and more bond market are more electronic, bid-ask are reducing, so these other things being equal going down, more liquidity, then more people go on the market, and so there is more liquidity, and bid-ask is going down. And then, again, it's the high yields of sovereign. So that's why spreads are reducing. And also, these also may go to the topic we analyze a lot of bond market more equity-like.
Okay, yes, indeed. And talking about corporates and where they're raising money, when people ask questions about whether the AI boom is a bit like 1999 and 2000, people point to the difference being, but that was all done on debt. Whereas now we're seeing big corporates use a lot of cash. Are you concerned that tech companies, the AI build-out might lead corporates into taking on more debt?
Anna, this is very important because, in the past, also in the recent past, I would say, AI companies typically were funding also their needs, through cash flows. It was easy also because big, revenues, profits, and so on. But now the order of magnitude of the investment that they need is huge. So already we saw last year what we call our 9 hyperscalers, the 7 US plus Alibaba and Tencent. They issued 122 billion of bonds, okay, which is half of the global tech supply last year. But they are all listed. They represent 12%, these 9 of global market cap, and we know the story. They are big. Market cap is big, but also their weight in all the indexes is MSCI and the others is big, and so passive investing ETF. Now, they forecast $4.1 trillion US dollars in capex in the next 5 years. Now there is no cash flow, no bank that can fund this. So we make some estimation. Even with, if you estimate that 50% will be funded by bonds, now this will represent basically 15% of the global issuance of all the markets. So this makes bond market similar to equity market. This is a feature, could be also change the dynamics in the market. Typically you hedge the equity with a bond, but now they are more and more alike. So this is something that we should keep into account.
Certainly something we should keep in mind in 2026. Carmine de Noia, thank you very much. Thanks for joining us. Really good to speak to you. Director for Financial and Enterprise Affairs over at the OECD. Coming up on the programme, former Secretary of State John Kerry says the war with Iran could have been avoided. More on that interview next. This is Bloomberg.
This is a 15, 16 grams tuna. Then sushi rice is still a little bit warm. So take one, like a very, don't make it too tight. So from now, and very light, like a ball. Put wasabi in the middle. Then my process 1 to 6. 1. This is putting the between the lights air. Then make the 4 fingers curl. Make sushi shape. Then touch this. 2. Then turn. Now these 2 fingers, top of the bottom, make the sushi shape more beautiful. 3. Then, looks like pushing, not pushing. 3, 4, turn, same way, 5, and 6. So this is the 1 to 6.
key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
Trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Only on Bloomberg.
Bringing you up-to-the-minute political news whenever and wherever it happens. I'm Tyler Kendall in Washington, and this is Bloomberg.
Good morning. Welcome to The Pulse. I'm Anna Edwards in London, and these are your top stories. Global stocks surged to record highs on signs that Iran and the US may extend their ceasefire. UK monthly growth smashes expectations. Meanwhile, over in China, GDP also tops forecasts, signalling limited fallout from the Iran conflict. Plus, European chip makers rise after TSMC lifts its full-year outlook, pointing to strong AI chip demand despite geopolitical uncertainty. Welcome back to the programme, everybody. Now, the former US Secretary of State John Kerry says the war with Iran could have been avoided. Speaking to Bloomberg, he reflected on the former deal that he helped broker during the Obama administration.
Well, obviously, it's not the picture that any of us wanted, point blank. It makes the world more dangerous. But it really underscores that the agreement that we had back in 2015, 2016, that agreement was the strongest nuclear agreement on the planet. It absolutely allowed us to see anything they were doing, any program, to have challenges, inspections, put back the sanctions. There were so many options, and ultimately even the bombing. So rather than renegotiate that agreement, if President Trump came in and said, hey, I don't agree with this or that, they could have renegotiated. And we had moved the breakout time to more than a year. So you had this whole year where if we suspected, oh, they're doing something, we don't like it. And by the way, we didn't do trust but verify. We did don't trust but verify, which is why we had the most exhaustive inspection scheme you could possibly have. And every intelligence entity, China, Russia, Germany, France, Britain, the United States, our own intelligence said, we will know what they're doing. They can't break out. There is not a risk.
But is it realistic for, President Trump now to demand limits on Iran's ballistic missile program and support for proxies, or is it wishful thinking?
Well, it's legitimate to be concerned about the missile program and to decide we want to make that part of a negotiating process. But our decision under President Obama decided, look, if we make the missiles and Hezbollah and Houthi, all those issues are on the table, we're never going to get to the nuclear. Because one will become the pawn and trade to the other, and there wasn't any room for trade. So we pursued the nuclear precisely to take the nuclear potential weapon off the table completely. And then we did agree with them. We said, then we go to the missiles, we go to these other issues. I think for some of the demands of the president are just unfulfillable. They can't do it, and they won't do it for various reasons. And what's happened is a war that had been certainly postponed and probably avoided, most likely, was made inevitable almost when the president pulled out, and we are where we are.
So what do you think happens now? And should the Iranians, can the Iranians actually trust the Trump administration, given they've been bombed twice since the negotiations started?
Well, again, I don't think either side is going to do something based on trust. There is no trust. It's not going to be there. You can't take the time to build it. You've got to make decisions now to deal with this crisis.
That was the former Secretary of State, John Kerry, speaking to Bloomberg's Francine Lacroix. So what does any of this mean for energy markets? Oil prices are steadying in an upward direction on signs that the US and Iran may extend a ceasefire and restart talks to end the war that's rocked energy markets. Bloomberg's EMEA News Director, Will Kennedy, is with us on set this morning to give us his thoughts. Will, good morning. What does this talk of a ceasefire, not confirmed, but that's what our reporting suggests, is being worked on, an extension, to the ceasefire, ceasefire. What does that mean for oil prices? We see them drift higher this morning.
Drift higher, but they're still well below $100, and they're well below the prices you would expect if the market still believed there was going to be a prolonged closure of the Strait of Hormuz. I think, to me, these prices suggest that the market expects the ceasefire to hold and for the situation in Hormuz to be resolved. These are futures prices. Look at what's going to happen in the future. It's worth pointing out that prices, physical prices, if you want oil right now, are much, much higher than this. And I think that most people you speak to in the oil markets would say that the risk of disruption remains until that strait is open. So the oil market, at least in the futures, seems to be pricing in that will get resolved.
Yeah, how much is that telling us the full story then, Will? I mean, we got this story quoting the boss of Diamondback Energy saying that the oil curve might be kind of lying about prices.
Yeah, I mean, that's one way of putting it. I think the oil curve is trying to balance expectations and how this might resolve itself. If there is a ceasefire agreement and Hormuz opens, then it's probably reasonable for the futures curve to price in lower oil prices. If it doesn't, then you'll see futures prices rise towards where the physical prices are today. Yeah. It's just a reflection of different possibilities at different stages of the future.
Out into the future. Will, thank you very much. Bloomberg's EMEA News Director Will Kennedy. For a further look at global energy markets, let's bring in Lydia Rainforth, who's head of European Energy and Energy Transition Research at Barclays. Lydia, really nice to speak to you, both on the subject of energy, traditional energy, and also the transition side and how much that is changing and thinking is changing. Let me start with the same sort of question I put to Will there. I mean, what's your expectation about where oil prices head? And do you share this view that the oil curve is sort of not telling the whole story?
Yeah, I think that's right. The physical market is really demanding much higher prices. And if we take a step back and look at previous crises that we've had, be it around Russia, Ukraine, prices spiked at that point, but we didn't actually lose any physical volumes. Equally, with Liberation Day, the expectation was that prices would move much lower, and we never actually did. And so I think there's a reaction to go, let's just wait and see. But actually on physical markets, on what producers are actually getting paid today, and then what refiners are having to pay for physical barrels to get them delivered to their refineries, it's much, much higher. And we've lost over 10 million barrels a day of supply. These are big, big numbers.
So where is the physical market right now, Lydia? Because I saw at the weekend stories talking about $140. There's other things I've read say $120. I mean, at some time, the gap between just even the front end of the futures curve and the physical market, it has to close if we get some sort of clarity on how long the strait will be closed.
Yeah, that's exactly it. It does have to close. So you're seeing dated Brent trade about 120, 125 at the moment, but the companies are actually getting premiums over and above that. So you're seeing 40s, as an example, go at 145, close to 150, but that's actually what you're paying to get it onto the ship. To get it to your refinery can cost you $10 to $20 more than that. So you're seeing really extreme pricing coming through, but we're having to price demand destruction, because ultimately we've lost 10 million barrels a day of supply. That's what demand was down at the peak of COVID. So there's that sort of scale that I don't think the markets are pricing. And how quickly does it take us to get Hormuz flows back up and running? That's going to take a little while as well.
I mean, we heard some quite, startlingly negative language from Qatar over the last 24 hours. I mean, clearly that's an economy that relies very much on energy, and so you'd expect them to be at the forefront of understanding what it does to their economy and be very negative about it. But clearly there's a sense in the Middle East that maybe the rest of the world is just not alive to the damage to the global economy that could be done here. Do you share that view from seeing what's happening in the energy market?
It's interesting that you're seeing at the moment the initial GDP data, the initial figures are coming out probably better than expected. But the reality is the physical prices don't hit you until April, May. So the markets were priced, what you were getting in March was what you'd already paid for in February when prices were lower. And I think the governments, in terms of the SPR release, the Strategic Petroleum releases, have done a great job in trying to manage supply to the market. But we are using up those inventories very, very quickly, and we're going to have to replace those inventories. And if we've lost the best part of 500 million barrels over the course of this, that's 3 years of more higher demand growth that we have to rebuild those.
OK, that's really interesting. So when we see the GDP data and other data for March, we shouldn't get too excited in thinking that that price is in war impact, because it might not necessarily. Let's pivot to thinking about energy transition, and the conversation here in the UK is perhaps helps to tell a bigger story. You hear both things at the same time. You hear, let's find more fossil fuels, and you also hear, let's speed up energy transition. How is this developing as a global narrative, do you think?
I think that's both, actually. So again, you go back to that idea of, will the flows ever be the same? Can we rely on the Middle East, or do we actually need to do our own energy security more? Particularly if you're being the Asian countries, do they look at developing more of their own resources? Do they look at going further down renewables? Have we pivoted back to coal? And the same is going to be true for the UK. So it's going to be more energy security, more domestic resources, and I think you'll see more exploration rounds, more licensing rounds on the oil and gas side, particularly in Asia. In the UK as well, I suspect we'll get that as well. But it's going to be, we need both. And I think that you will see a step up again in renewables as we try and go, what are the solutions to this long term?
What is the end game then, if we see a step up in the short term in both renewables and coal?
So it is probably less LNG through time. We've had 2 crises now where you've had the Russia-Ukraine crisis spiked gas prices. You've then had this crisis spiking gas prices and removing a really secure source of supply. Is that going to be something that when you're setting an economy up for where do I want my long-term power, where do I want my long-term energy from, can I trust LNG? So we may have taken down some of the growth forecasts on the gas side a little bit.
OK, that's interesting. So what about the impact of higher interest rates? I mean, we're worried about inflation. Interest rates rose in the initial period after the war started. Is that going to be something that dents appetite to doing investment in renewable energy or changes the pricing of it?
I think it's changing the pricing of it. So there was that wave immediately post-COVID when you still had very low interest rates where you could do a lot more. Now it is just costing you more, but that you've got to balance that cost versus what's the cost of your gas side and the cost of this sort of crisis. So it really is both, but the cost of energy being delivered to consumers, to being delivered to businesses, is going to be higher at the end of this than it was before.
And Lydia, what about the build-out of renewables in the Middle East, North Africa region? We've heard from the UAE, the Saudis, they're interested in solar, for example, and doing things with solar despite their, deliberately to try and diversify their energy sources and their economies. What's the prospect there?
We're still seeing a lot of investment there. And I think ultimately it was to allow more exports to come through. So the more that they can do domestically on replacing their own power generation. So Saudi still uses a lot of oil in its own power generation. If they can move that to solar, they can export more oil. And that's really why they were trying to transition the economy. And that doesn't change.
In the United States, of course, we've heard a lot about offshore wind. President Trump's very vocal in his dislike of offshore wind. What impact is that really having on the ground? Because sometimes the courts are moving in a different direction to the one that is indicated by the president.
You're seeing things stop, really. And we've seen TotalEnergies, as an example, pull out of their offshore wind contract, but they have then said we will invest that same amount into the oil and gas industry. And the US does seem advantaged on the energy supply side. Natural gas prices are still only trading at $3 per unit compared to what we'd be over in Europe at 16, 17. So there's still a big gap that there's not as much demand for offshore wind in the US as we have in Europe.
Yeah. Back to where we started the conversation, Lydia. We've talked about, we've seen Asian governments take seriously the prospect of shortages. So not just higher prices, but shortages of energy product. In Europe, the conversation has been about helping people with the price and not so much around shortages, except maybe people asking questions about jet fuel. I mean, what are your expectations for Europe and shortages?
So jet fuel is the part of the barrel that is most exposed at the moment, and you are seeing those warnings across the board. That the idea of we find through to the middle of May, but how do we get cargoes in from there? Diesel is the other area that is going to be tighter around that, but the governments have stocks to be able to manage this. And at some point you probably think, well, do you end up looking at introducing lower speed limits temporarily? Do you offer more advice to people as to how to save money on that side? I don't think we're in physical shortages at this point. Jet fuel is the one that we're more concerned about.
OK, yeah, interesting that the EasyJet CEO said this morning no concerns about jet fuel availability, but we'll certainly watch that with the percentage that comes from that Gulf region. Lydia, thank you very much for joining us. Lydia Rainforth, Head of Energy and Energy Transition Research over at Barclays. Now, emerging markets investing pioneer Mark Mobius has died at the age of 89. A partner at Mobius Investments says he passed away in Singapore. Mobius spent over 30 years with Franklin Templeton, championing opportunities in Africa, Asia, Eastern Europe and Latin America. He founded Mobius Capital Partners in 2018 and continued to seek out investing opportunities in recent years, including setting up a new venture in Dubai.
Welcome to Bloomberg This Weekend. I'm David Gura.
I'm Lisa Mateo.
And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington.
Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors.
We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
What is going to be the consequence for U.S. markets?
We are seeing modest gains across European equity markets.
Take a look at how we're faring when it comes to Asian markets.
From the beating heart of global finance, economics and politics, and wherever newsmakers are moving markets, Bloomberg brings you conversations that allow for deep discussions and important insights. What do you think the future is for inflation? Is this a new normal? Are markets too optimistic? How do you worry about the things that are outside your control? How does the current fighting completely stop? I'm Francine Lacroix, and this is The Pulse, every weekday only on Bloomberg.
We've opened this out to a number of organizations, including Microsoft, AWS, some financial institutions, a very small cohort. And essentially, Mythos has really showed us that there are a lot of very severe vulnerabilities right now. Mythos found vulnerabilities in every single operating system and in every single web browser. And so we wanted to build this small cohort first, basically learn from what they found in a very contained and controlled manner. But you're right, our intention is definitely to expand this out in a very intentional way.
To be clear, it hasn't been expanded to UK financial institutions yet?
No, but I think that is in the very near term. Like in the next
weeks away?
In the next week.
In the next week?
In the next week, yeah.
OK, and these are top UK financial institutions?
Yeah, we've been, I mean, as you would expect, the engagement that I've had from CEOs in the last week in the UK has been significant. Customers, firstly, want to say that they appreciate our very thoughtful approach to the way in which we have released Mythos. But secondly, of course, they want to understand the opportunity to be considered to gain access to that model in a controlled way. And so we've been having a lot of conversations with CEOs about the reason why, firstly, we did Project Glasswing and the way that we thought about that intentionally. And then secondly, being very clear and to understand exactly why they want to get access to Mythos, and then working in partnership with those customers to think about the next kind of phase 2 and 3 and 4.
That was Pip White, head of EMEA North at Anthropic, speaking exclusively on Bloomberg's opening trade a little bit earlier on this morning. Let's get more on the concerns and the very careful rollout of Mythos, Anthropic's new AI model, of course. Today's Bloomberg Big Take story reveals how the company came to realise it had created a model that was too dangerous to be widely released. Bloomberg senior strategist Neil Campling is with us. Neil, this is a really fascinating deep dive. So take us into the timeline then of when Anthropic really fully understood what it is that they had built and how powerful it could be.
We could go back to late 2024, actually, with Opus 3 from Claude, Anthropic, where they found the sort of original problems around some of the risks of some of the Chinese hackers could get into some of these AI protocols. With Mythos, it is the most advanced AI in the world as far as we know. And it appears, according to the Big Tech this morning, that they found in late February through their red team of 15, they call them ants, they're big developers, they're the super developers within the company, found that some lines of code even had that had been tested 5 million times. They found flaws in some of those systems. So this super powerful AI tool that they have here is basically not fit for public release.
Yeah.
It has to be tested, rigorously tested, before it can be
The line that stood out for me from the interview there with Pip over at Anthropic was that they found, using Mythos, they found problems with every single operating system that exists, which I thought was quite revealing, and hence the very careful rollout, releasing it to the defenders before it can get into the hands of the attackers. So where does that put us in terms of global tech security and what those who want to do bad things could use this tool for?
This is known as the technology paradox, where sort of bad actors can use a technology that's been designed for good that can be also powerful in the wrong hands. This is not a new thing, sort of specifically for Anthropic. We've seen this with every sort of tech advance over multiple years, decades, in fact. But what this clearly shows is that the risks and the flaws in something that is so powerful that it has taken mere days or even hours to find flaws that have gone undetected for as many as 40 years shows how powerful some of these tool sets are. So they have to be sort of very, very resilient before they get in the hands of many users.
OK, and in other tech news, we are following with great interest Elon Musk's attempts to start producing chips. And we have some really interesting news flow, sort of iterative progress on this story, but really interesting news flow that gives us a sense of how committed he still is to this project.
Very much so. The 1 terawatt of compute power he talks about with regards to this new fab is an incredible amount of compute power. What also we heard overnight is that the willingness to get this fab into fruition is that they are willing to pay over market prices for equipment, which is a major stumbling block, which even TSMC talked about this morning on their call. There's huge demand, obviously, for AI chips. That also requires, the leading edge equipment, and so Musk hasn't got necessarily the same same pricing power relative to some of the leading players, so he's going to have to overpay in order to kit out the fab.
OK, Neil, thank you very much. We'll watch that with interest. Neil Campling, senior strategist for Bloomberg News. And Neil was just talking there about the wider tech sector, and Bloomberg is hosting a live Q&A on Anthropic's Mythos. That takes place tomorrow. It is open to everyone to listen in. Terminal clients and digital subscribers have the opportunity to send questions for the team to answer in real time. That is tomorrow at 6:30 p.m. London time. And Neil was talking there about TSMC in passing, so let's go there to that story next. European chip stocks are rising this morning. That's as TSMC booked a 58% surge in profit, a sign that the Middle East war did not depress booming AI investment. It hasn't yet, at least. For more, let's speak to Charles Shum, Asia technology analyst at Bloomberg Intelligence, joins me on set this morning. Good morning to you, Charles. So what is your takeaway from these results? What did you make of them?
Honestly speaking, I think TSMC just delivered a very exceptionally well result for the first quarter. Not just that, it's the first quarter sales, gross margin, operating margin, all above the upper level of the guidance. But also look at its second quarter guidance. Actually, it's also beat the consensus. The gross margin after the first quarter hit a record high of 66.5%. Actually, the management team indicated that could actually going as strong as 67% in the second quarter. Actually, that's more than consensus expected. And also the sequential sales growth actually could be actually 10%, and more than the 8% that consensus is expecting. So that's a very good result. But The only thing that we should look into is was a little bit worrying about is the smartphone chip demand. Actually, it's down 11% sequentially. That's a little bit actually worse than what the management say in the last quarter. They say that there's no impact on the memory chip price highs, but we see that actually the decline in the smartphone chips actually is more than we expected.
Okay, and it's interesting. That's the area of weakness. The area of AI is clearly the area of growth. So how concerned should we be about the prospect that the Middle East conflict, as it becomes more prolonged, if it does, and we're in a ceasefire right now, but still with the Strait of Hormuz closed, how is that going to affect chip demand?
Honestly speaking, at this point, I actually have less concern on this based on what the management just told us this morning. Actually, usually if there's any disruption on the gas or the power delivery, you will see that from the guidance. But as I just said, that they actually project a strong guidance in the second quarter. So that's a supply chain side. And on the demand side, yes, you can say that the prolonged conflict actually will have a broader macro impact, like the high inflation, weaker consumer sentiments, but these are all the short terms. But look at the actually fundamentals of the growth driver these days for TSMC is AI chips. It actually accounts for more than 60% of the sales in the first quarter. It's going to be bigger in the coming quarters. So that part actually definitely will overcome the softness in these smartphone chips.
Okay, that's interesting, because my last question was going to be, can TSMC maintain this momentum? From what you've said, the answer is yes, is it?
Yes, correct. In the short term, definitely yes. We will see that already, that from what the analysts are questioning about, people is actually worrying that TSMC whether can provide enough capacity to meet all the demand, not just the advanced nodes process, but also the CoWoS, the advanced packaging capacity. That part actually is fine, but in the longer term, actually, I would be a little bit worrying about. Also, I want to highlight that actually CCY also mentioned that they will probably revise the 2026 sales target in the coming earnings call briefing. So that's a very positive sign. But a little bit, there's something I still want to reflect here. It's about not about the demand, it's about the execution. TSMC right now is actually building 6 fabs in 3 continents. That requires a lot of talents, a lot of engineer. Yes. So how can they find that many talents? That's a big question mark in my mind.
Yeah, it's really interesting how some of the very real-world requirements of fab production, of data center production, are the things that might slow down the AI push rather than other dynamics. Thank you very much for joining us, Charles. Good to have you on the program. Charles Shum, Asia Technology Analyst at Bloomberg Intelligence. European equity markets then overall pretty flat. The FTSE 100 is pretty flat. The CAC 40 goes a little higher, up by 0.3%, rebounding from some of the losses on luxury stocks yesterday, perhaps. It is the technology sector that is out front, and that has to do with that TSMC story we were just talking about. Food, beverage and tobacco, telecom and energy stocks are some of those that are in negative territory right now. I see the US futures are pointing a little higher, up 0.1% on E-minis, and NASDAQ futures up by 0.3%. We continue to monitor news out of the Middle East, of course, and also the latest AI developments. Up next, Bloomberg Brief. This is Bloomberg.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Tariffs, I think, are probably the first time in my career I've had to deal with like a fundamental change in government policy in terms of how we think about how markets work.
The challenge, especially within my supply chain, is now how do you have enough productivity initiatives to offset the increased cost of all the product?
Can you just move your supply chain out of China and into the US, or out of Mexico and up to Canada? Is it that easy?
It's not that easy, but we do have flexibility. And we had been, prior to tariffs, prior to any of this, we had been on a journey to diversify our footprint out of China. So probably 2-ish years ago, roughly 65% of our toy and game volume was coming from China. Today, as we entered into 2025, that was around 50%. All we've done is really accelerate the path to get down to roughly, call it 30% by the time we enter into 2027. For us, I mean, if tariffs stay, if tariffs go, it's never good to have so much of your manufacturing base centered on one geography. We think the diversification is good, but it does take a bit of time to get vendors and suppliers up to speed. Quality is a big deal, especially when you're dealing with toys and kids. It's not an instantaneous thing, but it's not also a 5-year, have to build a new plant from scratch.
The Middle East and Africa regions are home to some of the biggest deals and fastest growth in the world. Vibrant resources and high-yield investment opportunities abound. I'm Jemana Versace. Join me on Bloomberg Horizon's Middle East and Africa for the stories, newsmakers, and insights shaping the decisions of traders across this exciting region.
You had heightened levels of volatility.
There's still room to maneuver.
We do see opportunities.
It allows you to increase significantly your net income.
Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions. Bloomberg brings you breaking news 24 hours a day. Powered by more than 3,000 journalists and analysts in more than 100 bureaus across the globe. Bloomberg Television. Context changes everything.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories.
The economy has been doing well. That does not tell you what the future is going to be.
We are taking a step-by-step approach, a very systematic approach with India.
This is a time to put a little more defense into your portfolio.
Insight with Haslinda Amin, only on Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
the Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Bringing you up-to-the-minute news.
Geopolitical news.
Economic news.
Up-to-the-minute global news.
Whenever, and wherever.
Wherever
it happens.
In Washington. Buenos Aires, Argentina.
Sintra, Portugal.
Ottawa, Canada.
Bangkok.
Tehran.
Jackson Hole, Wyoming.
Windsor Castle, England.
The Circuit de la Sarthe in Le Mans.
And this.
And this.
And this is Bloomberg.
What you need to think about.
Good morning, good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg Tech.
This is the Asia Trade.
This is Wall Street Week.
Welcome to Balance of Power.
This is Bloomberg Television.
It's the most fascinating time for the global economy in years, and our conversations are front and center.
We're stress testing consequential ideas, and investors around the world are scoring them in real time, helping to translate the policies from Washington into actionable ideas for Wall Street.
It's the morning call you actually want to be a part of.
Separating the signal from the noise, with some fun along the way.
This is Bloomberg Surveillance.
Listen carefully.
Good morning. It's 5:06 a.m. in New York City, 10:06 in London. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Let's get you set up for the day. Taking a look at markets first, because we hit all new closing highs yesterday, finishing the cash session above 7,000 for the first time ever. S&P futures now up 0.1%. And to add more, NASDAQ futures gaining a third. Take a look at what's going on in treasuries right now. We don't see a lot of action there, to say the least. The two-year yield at 375 holding firm. The 10-year yield even less changed at 428.15, and the 30-year yield at 490. Brent is, as always, or as has been the case for the past 6 weeks, where the market is focused. We do see some slight gains, but NYMEX crude for May delivery still at $92.37 a barrel. Brent still at 96 and 30 cents a barrel. You see a slight creep higher in gold. For the individual stocks that we're watching, let's get out to London and Chloe Melee. Good morning, Chloe.
Good morning, Matt. The chip sector is in the green today after TSMC's very upbeat outlook, which really showed the resilience of this AI chip demand and those AI investments despite the macroeconomic fallout from the war in Iran. So that's helped to ease, at least for now, some of those concerns around the impact of higher energy costs on the AI sector. So we are up across the board there. Moving on to Hims and Hers, which is also moving higher this morning after the Health Secretary, RFK Jr., said that the FDA was looking to ease some restrictions around peptides. So peptides are increasingly popular. They help with things from muscle recovery to weight loss. And this is something that Hims and Hers can really capitalize on because they just acquired a new manufacturing facility that is dedicated to peptides in California. And so we're up almost 10% this morning. And finally, Voyager Technologies is also moving higher this morning because they signed quite a cool contract. They signed an order with NASA for the 7th private astronaut mission to the International Space Station. That's a mission that will happen at the earliest in 2028, and the prospect of that is really boosting those shares this morning. We're up more than 7% for that company.
Chloe, thanks very much. Chloe Melee joining us out of London with your single stock stories. Coming up this hour, more on the equity market with Robinhood CIO Stephanie Guild. We'll cover everything from energy to banks to tech with her. Right now, just taking a look at the broader market, stocks extending their highs as investors pile into equities on optimism over the ceasefire between the U.S. and Iran, along with corporate earnings. Joining us now is Bloomberg's Skylar Montgomery-Koenig. Skylar, it's interesting to see that, you know, even with a war in the Middle East and oil that is still trading for more than $90 a barrel on both of the major contracts, we see record highs again on the equity indexes. Why is that?
Yeah, absolutely. And it's really interesting because the market is very much banking on this idea that a ceasefire will eventually lead to a resolution, which will eventually lead to the Strait reopening. And in terms of how I'm thinking about it from a high level, it's really about timing the pain, right? So in the long term, the medium term, we need to be worried about the stagflationary impacts. I think the commodity curve in particular is still too optimistic about the decline that's expected in commodity prices. We certainly haven't priced this growth downgrade that we'll see, the inflation upgrade that we'll see. But right now, the near-term pain is this idea that if you're short, you're missing out on a very massive rally, or actually you're losing money on a massive rally. And if you're not allocated, there's that as well. And it really comes down to a timing issue where we'll have inflation surge before growth falters. And if you look at measures like CPI, that has risen quite substantially, but the only early indicators that we have are soft data. And what we've seen post-COVID is that soft data is very partisan. It's negatively correlated with inflation. And so it's been really inaccurate as a measure. And we're not going to see that growth falter until later down the line, especially because the starting point for a lot of these economies is very strong. And that's what we've seen in earnings season so far, with banks this week, for example, pointing to a resilient consumer.
So this is just, I mean, a lot of it is animal spirits, but a lot of it has to be expectations for continued strong growth in earnings. I mean, double-digit percentage gains in earnings again, and maybe even more than we saw last year, Skylar. Is that still expected?
Yeah, I mean, we have certain earnings expectations rise quite considerably. And on your point around kind of over-exuberance, I think this is something that maybe tests the market in the next week or two in terms of, we know that liquidity declines after tax day. We know that the pace of aggressive kind of buying that we've seen is very frothy, but there's still money on the sidelines that can be put to work, particularly, as you say, we're getting to earnings season and you've seen upgrades, which looks quite weird given what's happening from an economic perspective with regards to the war, but I don't think you see that impact really until second quarter earnings. And there also needs to be this differentiation within regions. So the U.S. as an energy exporter won't be hit as much as Europe will as an energy importer, as well as this kind of timing around the impact from right now we'll see an impact on companies that are directly impacted from higher energy prices. So the energy sector will benefit. Travel and airlines will be hit by higher input costs, but we haven't had enough time to see a greater demand destruction that will impact aggregate earnings, which you need to look further out for.
All right, Skylar, thanks so much for joining us. Bloomberg's Skylar Montgomery Koenig there on the MLive team. You can get her work and the work of her colleagues by typing MLIV GO on the Bloomberg terminal. One of the things that you'll see there is an upbeat forecast from TSMC, adding fuel to tech share rallies after expecting revenue growth of, saying it expects revenue growth of more than 30% this year. It had previously expected less than that. Joining us now is Bloomberg's Neil Campling. And Neil, you got to help me out here as you cover this on a daily basis. I feel like TSMC comes out with quarterly earnings every week. What's going on with this company?
Yeah, we had, so being a Taiwanese company, they come out with monthly sales data. So we had the monthly sales data for March just 2 weeks ago, and now we've got the full quarterly results, which show huge gross margins, huge profit growth. They're raising the guidance for the year as well on the sales line to be more than 30%. So it's incremental information with every single upgrade. But you've just been talking about earnings and earnings growth. As the market has reached an all-time high in the S&P, what hasn't reached an all-time high is the actual multiple applied to earnings of the S&P, and even more so in the NASDAQ 100, the tech-heavy NASDAQ. So there's big earnings growth coming through, driven obviously by the AI narrative. So TSMC, alongside NVIDIA and ASML, is one of the key enablers of the entire AI ecosystem. This is yet another great point that we've got super normal growth coming through in this market. There's very few mega cap companies that can deliver 30% plus growth on an ongoing basis. But TSM and NVIDIA are companies that can certainly do that from here.
Yeah, and TSM also saying, I think it's capital expenditures are going to be like $56 billion, which would be a number that's simply unbelievable if we hadn't seen the hyperscalers spending plans, Elon Musk's spending plans. Speaking of, Musk has reached out to Applied Materials, to Tokyo Electron, to Lam Research, to, I guess, tell them to hurry up in terms of his Terafab plan. What do we know about that massive factory?
I think there's two things that stand out for me in this great exclusive overnight. One is the size of the sheer compute power of this potential fab, which is, in terms of a terawatt of compute power, just phenomenal numbers. And the second thing is that Musk is saying he's prepared to pay over market price to kit out the fab quickly. It's telling you that chip equipment is in short supply, and he's going to have to pay over market prices in order to accelerate the expansion of that particular fab. And of course, whatever they're doing, the same thing is happening at TSMC and in other companies that are all racing to build out the infrastructure and the chips that are needed to power the incredible compute power of the AI ecosystem.
Neil, great to spend some time with you this morning again. Thanks so much for your coverage. Neil Campling covers the tech stocks for us out of London. Let's get to some of the other top stories trending on your terminal this morning. At least 2 Iran-linked ships that have been sanctioned by the U.S. made it through the Strait of Hormuz and into the Persian Gulf. The path shows a possible new route from the UAE in the face of the U.S. blockade. Ship owners, energy traders, investors all closely monitoring transits through the strait for indications of how U.S. and Iran are exercising control over one of the world's busiest shipping corridors. The CFTC is investigating a series of suspiciously well-timed trades in the oil futures market ahead of Trump policy pivots related to the Iran war. The agency is specifically looking into 2 instances over a period of 2 weeks where trading volumes on platforms belonging to the CME Group and Intercontinental Exchange surged shortly before major announcements. And Novo Nordisk has hired around 2,000 people this year in a move that reshapes its workforce after laying off about 10% of its staff last year The Wegovy drug maker is looking to make the organization faster and more aggressive after losing its lead in the obesity market to U.S. rival Eli Lilly. Coming up, a federal jury rules that Live Nation illegally monopolized the events industry. More on that next. This is Bloomberg.
Know how the market day started.
Find out how it finishes.
Public markets to private markets.
From the micro to the macro.
Covering retail, entertainment, the business of sports.
The supply chains, trade policy, how it all is impacting the U.S. equity market as we drive to the closing bell at 4 p.m.
A holistic approach to covering financial markets.
If it matters to your life, we're covering it. I'm Katie Greifeld.
And I'm Romaine Bostic, and this is The Close.
Live every weekday.
Only on Bloomberg. Context changes everything.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bringing you up-to-the-minute global news whenever and wherever it happens. I'm Hazlida Amin in Davos, Switzerland, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
This is Bloomberg Brief. I'm Matt Miller, New York City. A federal judge has ruled that Live Nation has illegally monopolized the events industry, opening up a possible breakup of America's largest and sometimes seemingly only ticket seller. A coalition of 33 states is seeking as much as $700 million in damages, with Live Nation issuing a statement this morning contesting the verdict. For more, Kate Ackley from Bloomberg Government joins us now from Washington. And you know, to say that Live Nation is a monopoly, Kate, isn't something that most people in America would think is at all surprising. How are they contesting this ruling?
Well, they said they're going to appeal. So that means this could drag out for years, you know, in the legal fight. Already after this, you know, kind of bombshell verdict, there's still, you know, the idea of what would be the penalties. And this is really not over yet.
In terms of the pricing, I thought it was almost laughable that the jury found Live Nation overcharged customers by less than $2. Have you bought a ticket lately?
You know, I don't remember the last time I bought a ticket, but yes, you're right. They said that this had resulted in an overcharge of $1.72 per ticket. Obviously, that adds up when you figure, you know, all the millions and millions of people buying their tickets via Ticketmaster. But, you know, this has really been a fascinating case to watch. There's obviously all the legal drama that has ensued. But in addition, there's been a lot of lobbying and influence going on, you know, over the years. During the Biden administration, when the Biden administration started looking at bringing this lawsuit, we saw a big ramp up in Live Nation's hiring of lobbyists here in Washington, D.C. And, you know, there's been a lot of talk about, you know, political influence. putting pressure on the Trump DOJ, which, as you know, did a settlement and so pulled out of this case. And then the 33 states and Washington, D.C. continued. So there's actually sort of an influence and lobbying campaign going on here as well, in addition to the legal case.
Right. I mean, it's hard to gain such incredible dominance in the market without spending that much money on lobbying. Kate Ackley in Washington, thanks so much for joining us. This is a story we will no doubt continue to talk about. This is Bloomberg Brief.
Have you ever thought about, or would you make a movie for a streaming service? Would you make a Netflix movie?
Man, that's a great question.
I mean, I'm waiting for one where I ask and you go, that was a shitty question.
Yeah. I mean, you good at your job, bro. Like, this is actually the first time anybody's ever asked me that. I'm not here to say what I would and wouldn't do in the future. But the theatrical experience is one that means a great deal to me. It means a great deal to us. Mm-hmm. I feel a certain responsibility. Like if Fruitville had happened a calendar year later, it probably would have come out on streaming. I've been fortunate enough that everything that I've written and directed has been a theatrical release. So I feel a duty to try to protect that. But that's where I'm at today.
We're at the epicenter of a global realignment on a scale not seen for decades. At the intersection between markets, economics, and geopolitics, a forum for sophisticated conversation. This is Bloomberg Surveillance.
Welcome to Bloomberg This Weekend. I'm David Murray.
I'm Lisa Mateo. And I'm Christina Ruffini. We're tracking breaking news today from Wall Street to Washington. Let's start overseas. The sector is really propelling this deal forward.
Yeah, the hope is this will open up new markets and provide some additional liquidity.
Of course, now they're going to have competitors. We got a big week coming up in politics.
Earnings season is underway. We're going to get some key reports.
Everything you need to know before the markets open on Monday.
Introducing Bloomberg This Weekend, bringing a little Bloomberg into your weekend routine.
Guys, buckle up.
Time now for your front page news. First up, on the Financial Times, Gulf states raising almost $10 billion in private sales of bonds this month. It's their first international borrowing spree since the Iran war hit their economies. The governments of Abu Dhabi, Qatar, and Kuwait did not respond to requests for comment. And finally, the Wall Street Journal leading with the Pentagon approaching automakers over American manufacturers boosting weapons production. As the wars in Ukraine and Iran deplete U.S. stocks, senior defense officials have held talks with several top executives, including General Motors and Ford, about whether they could shift to defense work. This is Bloomberg.
cidade estava sitiada.
Nisso eu começo, eu tremia, não sabia o que fazer.
Foi a mais terrível que eu passei na minha vida.
Eu temo, né, que o Brasil se torne, num futuro próximo, um narco-estado.
Porque no final, tudo é dinheiro.
People back home there, they are suffering. And someone is driving a Range Rover with their money.
Where is my money?
I think she's a scam up to now.
It's some of the world's most desperate people who are getting ripped off.
Repeat after me. I am a winner.
I didn't know how big it was. I didn't really understand what I was getting myself into.
If you tell me you have a vision of being $1 billion business, then you're going to have to do what it takes. And if you're not going to do that, everybody's going to suffer.
Una batalla a muerte.
Money can do a lot of good. It can really transform people's lives, but it can also hurt them.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade.
Watch Bloomberg 10.
This is the Asia trade.
This is Wall Street Week. Welcome to Balance of Power.
You're watching Bloomberg Deals.
Welcome to Bloomberg This Week. This is Bloomberg Television. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Good morning, 5:30 a.m. in New York, 10:30 in London. I'm Matt Miller in for Vonnie Quinn with your Bloomberg Brief. Let's get you set up for your trading day. Global stocks extend gains after hitting a record high, the S&P crossing the 7,000 mark and holding for the first time ever at the close. That rally gets a boost by TSMC's quarterly results. The chipmaker raises its outlook for the year, highlighting resilient AI demand and A federal jury rules that Live Nation illegally monopolized the events industry, something that we've all known, but people don't often, well, I guess everyone says that too. The company is preparing, though, for an appeal. Take a look at what's going on in markets in terms of futures. We still have gains set up, although slight on the S&P. The NASDAQ futures are up 1/3%. Small caps unchanged. Speaking of unchanged, Treasuries not doing much at all this morning. We'll show you the board anyway, but 375 on the 2-year, still 428 on the 10-year, and 490 on the 30-year. Feels like we've just been holding in that range forever. Brent crude rising a little bit, but still sticking at similar prices to what we saw yesterday. So 92 barrels and change for a barrel of West Texas Intermediate. Brent going for 96. Gold rising slightly to $4,811. For some of the individual stock stories that we're following for you this morning, let's get out to Chloe Melee. She's in London. Good morning, Chloe.
Good morning, Matt. Let's start with a positive day for the chip sector after TSMC raised its revenue outlook for 2026. And that really underscored the resilience of this AI demand, those AI investments, despite the macroeconomic fallout of the war in Iran. And so that's helping to ease some of those concerns around, higher energy costs potentially hitting demand for power-hungry data centers. And so we are seeing this TSMC read across into NVIDIA and Intel this morning. Moving on to Hims & Hers, which is moving also higher this morning after the Health Secretary RFK Jr. said the FDA was looking to ease restrictions and limits around peptides, around 12 different peptides. They are increasingly popular to help with things from weight loss to muscle recovery. And this is something that Hims & Hers can really capitalize on because they recently acquired last year a manufacturing facility in California that is dedicated to making those peptides. And so we are up about 6% this morning. And finally, let's end with another positive mover, and that is Voyager Technologies, which has signed a contract with NASA for the 7th private astronaut mission to the International Space Station. That's a mission that will happen at the earliest in 2028, and that's a prospect that is really boosting the shares in Voyager this morning. We are up almost 8%.
What are peptides? I thought peptides was something that you took if your stomach was upset, like Tums.
Yeah, but they are a sort of component, that you can use for different things like that for health, essentially. Some of them, some people are calling it a wellness fad, but
I didn't want to put you on. I don't want to put you on the spot, Chloe. You're not a pharmacist, obviously, and
I'm not a pharmacist.
I think the real answer is no one really knows. Chloe Melee there in London with a look at some of the single stock stories that we're following. Let's turn to the energy sector. Shares of major oil companies have gained more than 20% this year as the Iran war fuels crude prices higher. Joining us now is Bloomberg's Will Kennedy. And Will, we still see 90s prices in the 90s for WTI and Brent crude, but it looks like if you take a gander at CT on the Bloomberg terminal that those prices will come down relatively shortly. How does the futures curve look to you?
Well, the futures curve, I should say, Matt, is not a prediction of futures prices. It's just a measure of the value of oil in 1 month compared to future months. I do think what the current futures prices are telling us is that the market does expect some sort of resolution to the conflict in the Middle East and some expectation that the Strait of Hormuz will reopen and the energy market globally can begin the long process of getting back to normal. If the strait were to remain closed, I think it's fair to say that most people say that futures prices should be higher than this. And as we've discussed before, Matt, if you look at the prices people are paying day to day for physical cargoes of crude oil, physical cargoes of jet fuel and diesel around the world, that suggests that actually there is quite a lot of pain and distress in physical oil markets right now. So the market is really bought into this idea that there are going to be more talks, that there's going to be some resolution to this conflict.
Has that, the spread come down, Will? I'm looking at dated Brent on my Bloomberg terminal, $116, $117 a barrel. That's only 20 more than Brent futures for June delivery right now, and I feel like it was more like 30 or 40 over the past couple of weeks.
Yeah, that's right. And you're going to see things happen in either direction. Either those physical dated prices are going to come down and converge on the futures prices, which is basically the value a couple of months from now, or it's going to go in the other direction. So you're starting to see that happen on expectations that we're reaching the end game. But it could all change very quickly, and it's worth people bearing in mind that we still have all these ships, many ships stuck inside the Persian Gulf, many ships unable to get in, and there are oil fields, oil refineries in the Middle East that have been shut down by this war and have not restarted yet.
All right, Will, great to get some time with you. Never enough. I could talk about oil all day long, and so could you. Bloomberg's Will Kennedy, you've been covering the oil markets for, I think it's fair to say, a couple of decades at least at Bloomberg. Joining us now is Stephanie Guild, a CIO at Robinhood, and you know, energy providers have been a major driver of rallies that we've seen here and benchmarks in Europe as well. But we see crude coming down to more livable prices. We've seen prices at the pump come down a few cents across the national average. Is that what's behind that drop in oil, this rally up over 7,000 on the S&P 500?
I think it's partially about it. I mean, whenever you have an expectation that costs can come down, maybe not right away, but over time, the market will look through it and then can turn their attention toward earnings, which is what they can now do. And earnings expectations did come up over the month of March, and it probably wasn't paid attention to very much. That being said, those earnings expectations increases were very concentrated. So, and you see it reflected in the market in that, like, some of those more niche tech companies have been the ones that have bounced the most.
Where are the gains? Because it feels like it should be, you know, big tech, AI, with all of the, you know, TSMC raising its forecast, all of the CapEx numbers that we see day in and day out, deals with Broadcom and Meta, like, over and over again. We still see the Mag 7. I don't know if we're still using that. That acronym, it's not an acronym, that term. We still see the Mag 7 unchanged year to date. I mean, it's come back a little bit, but it is still not quite gaining.
I just think there's a lot of CapEx there, and I think the growth is probably, like, if you think about the rotation and everyone talks about, like, the different trades within AI, it's been more in the, like, the optical space. Like, if you look at, like, a Marvell or Cohere at Lumentum, like, those have been flying.
Yeah.
I mean, even before this conflict looked like it could be ending, those have continued to rally. And in the last couple of days, you've seen some of the Mag 7 go up, but not equally so. And that's why I actually don't believe in calling them the Mag 7. I think you just have to look at each individual one. So, like, you know, a couple of them were up yesterday, but Amazon was not.
Mag 7, I guess, is kind of passe at this point. You know what's insane? Allbirds at one point was up 876% yesterday. It closed up 600% to $16.99. This shoemaker, which had lost 95% of its value,
business was done,
decided it's going to make the pivot to a neo-cloud provider, essentially. It's going to take $50 million, and that buys you like 5 chips from NVIDIA. Why do investors fall for this hook, line, and sinker?
I mean, I think it ends up just being like a very short-term trade, like, oh, that looks cool, and we've seen this before. Like, I don't know if you remember back in, like, when, you know,
Long
Bitcoin,
Island iced tea?
Yes, that's the one that everyone's talking about. There were other ones I remember. I think I remember, like, a bakery company doing the same thing. But it does make me nervous because it tends to feel like it's the start of, like, bubble signs.
Yeah.
And then if you have a lot of IPOs, like, there's a couple of signs that are starting to flash yellow, not red yet, because I do think there's real growth in some things. But yeah, I mean, that kind of stuff, like, hopefully you get out.
It is maybe a sign of a little bit of froth. I want to take a look at the relative rotation graph I was showing you in the commercial break, and it's a fun function on the Bloomberg. I'm just looking at a 12-week snapshot of the S&P 500 divided by industry groups, broken down into the 11 GICS sectors. Now, if you switch from ticker to name, it's a little bit easier. Guys, Joe in the control room, just up in the upper right-hand corner on the drop-down menu, change it from ticker to name, and then you can see better. Energy, obviously, right up in the top there of the leading corner of the matrix. Consumer staples, utilities, real estate, industrials, all done well. Communication services, healthcare, not as well. But tech and financials especially are in the lagging sector.
Yeah.
What's wrong with financials this year?
Well, I think you've had probably a couple things. One is that one of the bets that we had last year in Robinhood Strategies was that you would have this curve that was helpful to banks, and you would see a lot of like deregulation and maybe M&A activity in the regionals. And there's been other things that have happened, but that hasn't necessarily come true. And I do think, the private credit issues probably are weighing on sentiment in the financials. And the curve hasn't looked as interesting, I think, as it maybe looked like the Fed could be cutting rates and kind of making it more steep. And I just think there's also just been like more interesting things to invest in. Financials had a big rally last year, and I just think it's time for, some other sectors to look to grow faster.
All right, Stephanie, great spending some time with you. And appreciate you coming to the studio so early in the morning. Stephanie Guild, the Chief Investment Officer over at Robinhood. Let's get to some of the other top stories trending on the terminal this morning. A federal jury ruled that Live Nation illegally monopolized the live events industry and overcharged fans for tickets. The landmark antitrust decision was a major win for 33 states and Washington, D.C. The states are seeking as much as $700 million in damages and additional penalties. The ruling sets the stage for a possible breakup of Live Nation and Ticketmaster. But in the meantime, Live Nation is going to appeal and try getting tickets somewhere else. Like, you can't. New Jersey Transit is expected to announce a $100 plus ticket for riders going to MetLife Stadium for the FIFA World Cup this summer. The ticket would take fans from New York's Penn Station to MetLife, and the fare is designed to make sure that everyday commuters don't have to bear the expense of the $48 million it's going to cost to run service to the 8 matches at MetLife Stadium. New York City doormen and other staff voted to authorize a strike, moving closer to a potential April 21st walkout. The move came after New York City Governor Zohran Mamdani held a rally supporting the workers. The walkout would disrupt operations at 3,500 co-ops, condos, and apartments. The doormen are seeking better pay, health care coverage, and pension funds in negotiations with an advisory board to property owners. Coming up, the resilience of the AI chip demand persists. A closer look at TSMC's outlook boost. Next, this is Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Power Players is back to take a look under the hood of the business of Formula One.
Hi, I'm here to see Pierre Gasly. Welcome to my workplace.
Do you feel pressure?
Massive pressure.
Ferrari is the best example that we can be very proud of the past to look after the future.
From the iconic brand setting the standard.
Oh boy.
Can you imagine Ferrari without racing?
No, and I say no, no, no.
To the newcomers forging ahead.
I grew up my whole life racing against the boys.
This global phenomenon continues to chart new territory.
This was a tennis court 8 days ago.
I can't even believe that.
And the speed of the business has never moved faster.
My career might stop, but I'll still be driving something.
Yeah. Probably very fast.
Yeah.
This is so exciting!
This season, we're along for the ride.
Good morning. This is Bloomberg Daybreak Europe. I'm Lizzie Burden in London, and these are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
This is Bloomberg Brief. I'm Matt Miller in New York. TSMC, it's raising its 2026 sales outlook. The CEO, C.C. Wei, saying, quote, AI-related demand continues to be extremely robust. Bloomberg's Neil Campling is back with us to talk about this. And as I said before, you know, it seems like they're raising their forecast or putting out numbers that no one thought they could last month every week. I guess this business is going gangbusters, but at that point, really, 30% doesn't sound like a terribly high amount to me.
Wow, Matt, I'm not sure what you're expecting, but I thought 30% was a pretty big number. The question is, I suppose, is that from here, there's every likelihood, given they only gave sort of the full-year guidance in January, that we could well actually end up maybe with a 4 handle at 40% by the end of the year. There's no sign of any slowdown in terms of margins, numbers, demand. I mean, all of the metrics that are there. We've seen Taiwanese export growth, which is very tech-heavy, continuing to ratchet higher. So I think that you know, there are high expectations, but they managed to meet those. And clearly, with demand being so strong, the focus will be on you know, likelihood of upside surprise going forward, because there's no sign of the hyperscalers obviously reducing any capex. So all of the sort of the earnings multiples, the growth rates are all very supportive to the AI narrative and to tech to continue the multi-year leadership it's enjoyed in the market, I think.
All right, an upside surprise that we're all expecting. Today's big take focuses on Anthropic's Mythos model. Very cool story, how potentially dangerous this model is. The U.S. government and other organizations are taking it seriously. Bloomberg spoke exclusively with Anthropic's EMEA North head Pip White.
We've opened this out to a number of organizations, including Microsoft, AWS, some financial institutions, a very small cohort. And essentially, Mythos has really showed us that there are a lot of very severe vulnerabilities right now. Mythos found vulnerabilities in every single
When news breaks,
A redhead across the Bloomberg terminal.
Bloomberg has you covered.
Trump's global tariffs are struck down by the U.S. Supreme Court.
For all the context and clarity you need,
There's going to be now tons of tariff headlines until midterm elections.
hear it first on Bloomberg. Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
U.S. exceptionalism is not going away.
There is an awful amount of good news already priced in.
Investors have been very cautious about missing this.
The earnings power are there. Estimates for cyclical earnings are most likely too high.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from the nation's capital this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday at fresh records, investors piling into equities, sending the S&P 500 to all-time highs, as TSMC's positive outlook is reinforcing confidence in AI chip demand, and the US and Iran considering a 2-week ceasefire extension. Stocks holding steady, Bramo, so far this morning.
Yeah, and frankly, the rally that we have seen is just tremendous. Bespoke Investment Group came out with a statistic that I thought was absolutely fantastic. Since 1928, this is the first time that the S&P 500 has made a new all-time high in 11 days or fewer after falling 5 to 10%. Just to give you a sense of how big this rally has been and how broad-based, it is not the Magnificent Seven. This is everything. The Russell 2000 is 0.2% away from an all-time high.
It has been absolutely phenomenal. We've talked about it repeatedly over the last week or so. The market reset, a 10% move off the lows for the equity market, a 20% move off the highs for the oil market. There's a feeling this is like April 2020. April 2025, where this market just moves on and looks through the risk and looks through everything on the horizon very quickly.
Well, that's what it's doing right now, because the market is basically pricing in that this war is over, even though yesterday Caroline Leavitt, the press secretary, says they haven't formally requested an extension of the ceasefire. She says this White House remains very much engaged with the mediators. Everyone is expecting that this ceasefire is going to go past the deadline of April 22nd. And at the same time, Reuters is reporting that the Iranians are coming to the table, but potentially saying some vessels can pass through the side of the Strait of Hormuz that goes out to Oman. So maybe on the horizon, we could see more oil flows.
Look at what we've heard from the companies so far. ASML out of Europe, raising its outlook. TSMC, Taiwan Semi, doing something very similar. Bramo, do you see this as confidence in the tech trade or comfort with the risk in the Middle East? Is it one or the other or both?
It seems like it's confidence that economic momentum can continue even though we have the Middle East situation where it is. And it is predicated on the tech trade, on this investment that is existential, that is ongoing regardless of what happens in the Middle East. But it's not just the tech trade. And I think that that's important. And what we heard from the banks is that consumers are resilient in the United States. People want to spend. It feels like as soon as you get the albatross off the neck of the economy that is the uncertainty in the Middle East, even if you just tamp down that uncertainty, you could get a rally, and that is what you're seeing.
Nice to be in Washington to cover the IMF World Bank spring meetings. Hardly talking about it because we're all focused on something else, somewhere else. I just wonder how consumed they are by the physical reality on the ground and how the tension continues to build between the conversations we're having about a better future the reality in the physical markets in oil. Every time we bring this up, it just feels like doom and gloom. And it feels like we're divorced from what everyone else is talking about. But the reality is, we've still got rationing in Asia. There's still the risk that we're going to see the same thing happen in Europe in the next few weeks if we don't reopen the Strait of Hormuz and get that energy flowing once again. And every time we talk about the extension of a 2-week ceasefire and those kind of things, I have one question, and only one question. Does that 2-week extension involve reopening the Strait of Hormuz or not? Because that seems to be the most important thing still this morning.
You have a blockade from the United States, and then you have Iran saying we're not going to let anything through. So it's a double blockade right now, even though you are seeing on the margins some ships start to enter the Persian Gulf, which is a good sign. You're right. And at the IMF meetings, people are coming out and warning about the gloom and doom. You guys are divorced from reality because the reality looks really concerning. And at the same time, people are saying, you're just that nerdy kid in the corner looking at the data. Stop it already. We're looking at how good things are. You guys always worry about stuff. We're moving on. And that dissonance can be felt that much more profoundly this week here.
All-time highs on the S&P 500 and the NASDAQ futures so far this morning, up 0.1%. Coming up this hour, we'll catch up with Max Kettner of HSBC with stocks rallying to all-time highs. We'll speak to General Karen Gibson of Academy Securities on a fragile ceasefire, and the IMF Director of Capital Markets, Tobias Adrian, on a risk to financial stability. We begin this hour with stocks extending gains after posting fresh record highs. Max Kettner of HSBC writing, what matters more than geopolitics is what's driving the global earnings outlook. The big question is whether US exceptionalism will make a proper comeback. Max joins us now for more. Max, you've been Max overweight for quite a while. We were talking about it at the top of the program here. Do you see this as comfort with the risk in the Middle East or renewed confidence in the US tech trade?
I think it's probably more the latter. In fact, I think I would argue, does the Iran war really matter that much to the global earnings outlook, particularly to the earnings outlook of the S&P? Bear in mind, when you look at the S&P, you look at US large caps, it's not like consumer cyclicals are 30, 40%. Absolutely not, right? Actually, you look at consumer discretionary, strip out Amazon and Tesla, you're talking about sort of 4.5% of the S&P. And even there, when you look within those, you look at the proper consumer cyclicals, you're talking something like 2 to 3% of the S&P. So even if, let's say, the lower end of the K of the slightly weaker households in terms of household health and financial health, if they are hurt the least, does it really matter for S&P earnings? I would argue no, because you look at tech, you look at the tech sector, you look at the AI sectors. Actually, when you look tech and AI together, that nowadays accounts for almost 50% of market cap. So to me, I don't think what we've seen in the last 11 trading sessions is the irrational reaction. I think what was irrational was the really sort of the 20% derating and compression that we've seen in S&P multiples at the beginning of the war.
Max, 2 points you made. S&P earnings, S&P multiples. Is the same true of the international backdrop, the global earnings story, the European equity story?
I think on the European earnings story is probably slightly more nuanced. When you look at stuff like chemicals, stuff like autos, they are going to be probably more affected. So I think where we're in right now, we're probably in the sort of global relief rally, not just because of US-Iran, but also because of things like interest rate volatility that have basically more than doubled, right, during March. That's now really, really come down quite a lot, and that helps pretty much everything. Now, when interest rate vol comes down, what helps that the most? That helps really the laggards from March. So what you want to do right now is basically flip the performance picture of March. So my advice to investors is very simple. You just download a performance picture across sectors, across regions, across asset classes in March, and you just flip it, right? You buy the stuff that didn't work in March, you sell the stuff that did work and protected you. I think in a second stage, the second trade, probably in a couple of weeks or a couple of months, that is probably then more going towards, okay, what's actually changed from the fundamental backdrop? A little bit like with Russia, Ukraine, where on a relative basis, then we're probably talking about, right, the AI outlook, the tech outlook is still strong. So probably then it's worth rotating from Europe to the US, but not right now. Right now, you're still playing that V-shaped recovery trade.
And how much, Max, is this really predicated on the idea that big tech suddenly is once again a haven trade after kind of being kicked around for a couple of months? Are we seeing anything fundamentally different now, given the pressures from higher commodity prices that will pressure certain consumers in some regions more than in others?
Yeah, look, I think I'm not disputing that it will hurt certain consumers, but at the end of the day, our job as analysts, our job as portfolio managers is to look at the aggregate number. We got to look at the aggregate PCE or retail sales number. What's that driven by? That's not driven by the lowest 20%, right? This is a very cynical thing to say. The lower end of the K that's been struggling already since COVID, that's been struggling even more with, stuff like food prices going up even more than core and headline CPI. They've been really struggling even more. They're now going to struggle even more. Now, from our perspective, does that matter for the PCE or for the headline retail sales numbers? No, they are not the main contributors to that. So therefore, that's why I'm saying, you know what, actually on the headline numbers, there's probably not going to be that awful much of change. And on the tech side of things, I think one thing has fundamentally changed in the last 2 quarters. Pretty much since November, since the Q3 reporting season, we've kind of given up on the AI earnings outlook, right? That was the first time where markets have actually not rewarded, but actually punished higher AI capex. The result of that was flat prices of AI, of hyperscalers, but earnings going through the roof still. And now relative tech valuations, if you look at S&P tech versus X tech or Max 7 valuations, you're close to 10-year lows. So that tech premium has almost entirely vanished. That really puts tech and US on a bit of a longer term perspective on a really, really, I would argue, even cheap foundation now.
Max, I feel like you should change your name from Max Kettner to Max Bullish, because you've been Max Bullish for quite a while, with one huge caveat, which is what the yield backdrop ends up looking like. That could be the fly in the ointment if you see that danger level, particularly with the 10-year yield. There's a lot of uncertainty around the Fed. The poly market trading betting odds now have the chances of Fed Chair Jay Powell leaving the board by May 30th at only 31%. I mean, how much do you see this as a real risk versus just some sort of theoretical risk out there, given the fact that a lot of inflationary metrics have been relatively under control?
Yeah, just to be clear, so we've not been sort of max bullish on equities for a year, and we don't see any risks at all. It was just more in mid-March that we saw, right, probably there's been enough happening now, and we're probably pretty close to particularly systematic positioning, very clean, which is still the case. And that has driven us to that max bullish stance. Am I still going to be that in 3 to 6 months' time? I think that's very questionable, because what you've been asking, I think that is not a theoretical risk. That is a real risk. Because at the end of the day, look, US earnings outlook is really strong. At the end of the day, actually Q1 reporting season, ahead of that, we've now seen the highest negative to positive pre-announcement ratio from US corporates. US corporates are telling us ahead of the Q1 reporting season, things are not only fine, they're even better than they themselves have expected by the most in 5 years. And that really, I think that is something that brings perhaps the danger back, that things are not going sort of Goldilocks, not too hot, not too cold, but then in a couple of months with sort of sticky inflation and with perhaps the unemployment rate going down even further because of that very low break-even payroll, and a really, really solid and accelerating earnings backdrop, that suddenly things are just too good. So I wouldn't pin it on Kevin Walsh. I would simply put it on the data, perhaps in a couple of months, just looking too hot. And therefore, the terminal rate may be having to move more towards 4%. And that, of course, would put pressure across all the asset classes, with the dollar the only safe haven again.
Well, Max, in that situation, could U.S. exceptionalism make a proper comeback? You say that's your third stage in your note.
I think that is then the case. Yeah, I absolutely think that's the case, because right now, what is U.S. exceptionalism, right? It is inflation is sort of sticky, and actually growth is kind of fine and is accelerating. It's particularly the superior profitability, right, against the rest of the world. Now, when you look at something like price-to-book ratios of the U.S. against the rest of the world, and you compare that to the return on equity on a relative basis between the US and the rest of the world, what you will see is that the compression, that relative compression, was way more, significantly more than is justified what's been happening on the relative profitability side. So I do think people have really, really overreacted to some sort of AI funding concern since Q4 last year. And I think that is then when we realize, you know what, maybe the US is, as stupid as that sounds, is even too cheap, given that superior profitability outlook. At some stage, I think given that sticky inflation backdrop, given that the top-down growth side also is more than fine, I think in a couple of months, we're talking probably about a bit more of a challenging rate outlook there.
Hey, Max, it's good to hear from you. It's good to see you. Max Kettner there of HSBC on the latest outlook. That's the bull case. Give him some credit. He's been bullish throughout this whole war. Give some credit as well to Venu Krishna over at Barclays, who raised his outlook, his price target on the S&P 500 in the middle of the war with crude at triple digits. And it's been so difficult to explain to people, maybe outside of financial markets and not following this every other day, that at the same time this war has been building and this ceasefire, before it even took place, and the Strait of Hormuz remained closed, we had earnings expectations getting better, not worse. Not the same, but getting better, not worse.
We all were just slightly skeptical when Venu Krishna came in, I will just say, when he raised his forecast. And at the same time, it seems like the rest of the market is catching up to him, because ultimately companies keep coming out and keep beating expectations.
Equity futures this morning positive by about 0.1% on the S&P 500. With an update on stories elsewhere this morning, with your Bloomberg Brief, Isabel Lee has more. Morning, Isabel.
Morning, John. At least 2 U.S.-sanctioned Iran-linked ships traveling through the Strait of Hormuz and into the Persian Gulf. The ships may have taken a new route from the UAE, passing between 2 Iranian islands as the U.S. blockade of the strait enters its 4th day. Talks are scheduled today between Israel and Lebanon. According to an Israeli official, the country's prime minister and the president of Lebanon will speak following ambassador-level talks in the U.S. earlier this week. Those were the first discussions between the two countries in more than 30 years. And the Trump administration looking to have U.S. car manufacturers play a larger role in making weapons. The Wall Street Journal reporting the Pentagon approached top executives at GM and Ford about producing military supplies. The talks come as U.S. officials grow more concerned about domestic manufacturing capacity. That's your Bloomberg Brief. John?
Isabel, thank you. Thank you for the update. Up next on the program, a looming ceasefire deadline.
I saw some reporting, again, bad reporting this morning, that we had formally requested an extension of the ceasefire. That is not true at this moment. We've remained very much engaged in these negotiations. These conversations are productive and ongoing.
Up next, we'll catch up with General Karen Gibson of Academy Securities. Live from Washington, D.C. this morning. Good morning.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
The trading day is about to start.
And you're already looking for that edge.
The opening trade brings you everything you need to know as markets open across Europe.
Let's talk about the significant risk transfers to find space in their balance sheet.
Hedging some of that risk.
You could look at it the other way. Obviously, this stuff is risk-weighted.
I would much rather be long than be short.
We're in a kind of sweet spot.
Very, very strong alignment.
3 revolutions in one.
I'm Guy Johnson.
I'm Anna Edwards.
And I'm Tom McKenzie.
This is your opening trade.
Every trading day, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
11-day winning run on the Nasdaq 100. What a rally we've seen for US tech stocks and for the whole global equity market, bouncing back from the lows of the last few weeks or so. On the Nasdaq, an 11-day winning run, the longest since December 2019. Futures this morning up again by 0.1% on the S&P 500. On the Nasdaq up by 0.3. Lisa, on the Russell, we're up by 0.1.
Yeah, really, to me, the Russell 2000 continuing to keep pace with the S&P 500 indicates that people don't just believe this is a tech story, even though it is going to be fueled by AI investment. It is a broad-based, beating expectations across the board with a consumer that's resilient, and that is the story that people are clinging to.
So we turn to crude. We've moved on. I still check it first thing every single morning. I'm not sure if anyone else still does. We're still in the 90s, and there's still this massive disconnect between the physical market, where things are really, really tight right now, Anne-Marie, and the paper market. The front month of the futures curve, 96 on Brent, WTI at 92.
Nothing has actually changed in the physical market. Actually, you can argue things are getting worse in the physical market. I saw that one country in Asia actually only received half of a full tanker because they were so desperate they said, bring whatever you can. That's the story in Asia, and then potentially it's going to get a little bit worse in Europe. But right now in the United States, we're semi-insulated. It is incredible to see the facts not changing on the ground, but yet the futures facts are changing. And they're just not pricing it in because they're pricing in peace.
Brent crude, 96.26. Under surveillance this morning, a looming ceasefire deadline.
I saw some reporting, again, bad reporting this morning, that we had formally requested an extension of the ceasefire. That is not true at this moment. We've remained very much engaged in these negotiations, in these talks. You heard from the Vice President directly and the President this week that these conversations are productive and ongoing, and that's where we are right now.
So here's the latest this morning. The US and Iran reportedly looking to extend their truce for an additional 2 weeks. Bloomberg's Tyler Kendall joins us now from the White House for more. Good morning, Tyler. What's true, what isn't true, and how close are we to extending this ceasefire?
Hey, John, good morning. Well, if we piece through the details, we can say that the White House at least says that these negotiations are ongoing, but at this point, no formal confirmation here that we're going to see an extension or even another round of in-person talks. Though White House Press Secretary Caroline Leavitt did go on to say that the U.S. feels good about the prospects for a deal, and also added that as Pakistan remains the main mediator in this conflict, we could likely expect Islamabad to host the next round of in-person talks if and when they happen. Plus, pair that with comments from Pakistan yesterday that a delegation had arrived in Iran in a bid to try to keep this momentum going, because Bloomberg News is one of those outlets now reporting that we could see this 2-week extension. And we have a little bit more of those finer details, including be geared towards letting negotiators at the technical level try to make some progress on the big sticking points before senior officials actually get back to being face-to-face, because at least publicly the sides still feel very far apart on some of those main points. Just yesterday, we heard from Iran's foreign minister saying that Iran's use of nuclear energy cannot be revoked, though he did seem to suggest that the level and type of enrichment may be up for negotiation. But still, that's testing this White House's at least public red line of no nuclear program. Then, of course, the issue of now the double blockade when it comes to reopening the Strait of Hormuz. And John, yesterday, the White House did detail that's not the only tool of economic pressure they would be willing to use. U.S. Treasury Secretary Scott Bessent saying that the U.S. is renewing efforts to work with Gulf partners on freezing additional assets of Iranian leaderships in their banking systems, and threatened those secondary sanctions on any financial institutions that help the country. on any financial institutions that help the country.
Tyler, we'll let you go. That sprinkler behind you is making me nervous. It's just coming around at the wrong time. No? You felt the same thing?
Well, I just love the lawn work that we get
always
every single in the morning. I mean, we should have all these clips
6:15
back to back
early.
of all the lawn work.
It's
on the White
because
House.
the press secretary saw some bad reporting, so you turn the sprinklers on. General Karen Gibson of Academy Securities, you think I'm joking? Maybe I'm not. Writing each day that the Gulf remains closed to business increases risk to the global economy. Iran benefits from a closed Gulf. We do not. General Gibson joins us now for more. General Gibson, good morning.
Good morning.
Welcome to the studio here in Washington. It's good to see you. Let's talk about the risks on the ground right now, the state of the ceasefire and the state of the blockade. What's your assessment of things?
The ceasefire is holding, which is a good sign. Establishing the ceasefire was a positive step by stepping off that escalatory kinetic ladder that we had been on, and an extension of a ceasefire, I think, is a sign that perhaps there's some productive dialogue going on in back channel. If it were increasingly frustrated, we would probably see bold action by the United States. In terms of the blockade, I think that's a very bold move, an attempt to decline or decrease some of Iran's leverage and to deny them revenue, whether that's from the they exact on passage of vessels or from their own exports. And ideally, that will bring them to the table to make additional concessions. I have no doubt about the U.S. Navy's ability to execute this mission with the same kind of competence, professionalism, and precision of all the missions they've performed throughout this campaign, but it does not solve the transit problem of vessels that remain stuck in the Gulf.
Well, in the past, we've seen the Fifth Fleet escort tankers through the Strait of Hormuz. Can we see that?
That is certainly possible. It's another feasible option. It's resource intensive. And so now there is another carrier, as I understand, steaming towards the Gulf. Both the blockade and escorts are resource intensive. It's not just the ships that are escorting them. Destroyers, fighter cap, combat air patrol, intelligence, surveillance, and reconnaissance, minesweepers. And even if we are escorting vessels, particularly if we're the only nation that's doing it, we can't escort the same number of vessels that previously were flowing through the Gulf prior to this conflict.
So the volume will be low. But if the U.S. Fifth Fleet were to do this, when could they actually start doing it?
I think if they want to impose both the blockade and escorts, we'd probably want to wait for the arrival of the additional carrier strike group that is understand it, is on its way there. I think it's important to note, though, that Iran's ability to choke off the Gulf is very broad. It's really based on a perception of risk. It doesn't take a lot of resources on their part. It's not hard to drop a mine or two, or even to say, we've dropped mines over here, and then someone has to verify it, demonstrate the feasibility of sailing through there. And the decision to flow through the Gulf, as you know well, it's not a military or a political decision. It's an economic decision based on commercial risk.
Unless there is a transformation in terms of the way that trips transit through the Strait of Hormuz, will things ever be the same again because of this perceived risk that is now in the forefront of every shipping company's minds?
Yeah, I think perceived risk is exactly what it boils down to. And so there's much that must happen to lower that perception. The ceasefire is an important step because right now we don't see anyone, taking any hits from drones and missiles, et cetera. Also, progress on the diplomatic front would be an important confidence builder. But this period of risk, or this perception of risk, extends beyond shipping. We've seen strikes against airfields, against, Dubai. There's much that will need to be done to lower that temperature across the region. And I know that our Gulf partners are very interested in seeing this resolved so that they can resume a normal commercial environment.
I think we all want to see the same thing, Lisa. Just how close are we to a diplomatic breakthrough? I think that's an important question. And are we just getting a one-sided serving of verbal intervention that implies things are better than they actually are in the negotiations?
One of the reasons why people are getting confidence is because even Iran has said that they're coming to the table, although they're also battling their internal PR battle, given the fact that people don't want to see that in the Islamic Republic. You are correct. How much is this a jawboning game that is one-sided as well and asymmetric in the same kind of way?
It's certainly been effective. Let's put it that way. General, thanks for being here. Thanks for making time for us. Thank you. That was General Karen Gibson of Academy Securities. Up next on the programme, we'll catch up with Bob McNally of Rapidon. With energy shortages looming, we've seen this story building across Asia. Is Europe up next? That conversation just around the corner.